Good morning. Just checking the sound. Scott, can you hear me? Mr. Connolly?
Yes, good morning, Senator. How are you going?
Very well.
Can you hear us?
We can hear you very, very well, and we can actually
Great.
see you. And it looks like you're sharing the screen
I
with
am. We managed.
Mr. Andrew Linden.
Yes.
That's great. It's only showing up on your screen as just you, Scott. That's fine, but we've got your nameplate here. Your alter ego's in Parliament, ready to go.
Fantastic. Thank you, Senator. I'm glad we were able to manage the technology this morning.
Fantastic. We're just waiting for...
Senator Scarr on Chorus Call, so just check if he's there.
Thank you. Senator Scarr, are you online on Chorus Call?
I am, Chair.
That's wonderful. Thank you very much. And I can see an image of the name Michael Murray. I'm assuming that might be for a later session. Correct. On the other screen. Okay, so we've got our witnesses here. We're just making sure that we've got...
Chair, I'm also online, just Alex Hawke here, just saying that.
Oh, Mr. Hawke?
Yeah.
Oh, that's fantastic. Thank you very much. In that case, we're ready to proceed. I declare open this hearing of the Parliamentary Joint Committee on Corporations and Financial Services into Corporate Insolvency in Australia. I begin by acknowledging the traditional custodians of the land on which we meet and pay my respects to their elders past and present. I extend that respect to Aboriginal and Torres Strait Islander peoples here today. The committee will be conducting today's hearing in person and via telephone and video link conference. These are public proceedings being video streamed live via the Parliament's website, and a Hansard transcript is being made. I remind all witnesses that in giving evidence to the committee, they are protected by parliamentary privilege. It is unlawful for anyone to threaten or disadvantage a witness on account of evidence given to a committee, and such action may be treated by the Senate as a contempt. It's also a contempt to give false or misleading evidence. Witnesses also have a right to request to be heard in camera. The Senate has resolved that an officer of a department or the Commonwealth or of a state shall not be asked to give opinions on matters of policy and should be given reasonable opportunity to refer questions asked of the officer to superior officers or to a minister. This resolution does not preclude questions asking for explanations of policies or factual questions about when and how policies were adopted. If a witness objects to answering a question, they should state the ground upon which the objection is made. The committee will determine whether it will insist on an answer, having regard to the ground which is claimed. If the committee determines to insist on an answer, a witness may request the answer be given in camera. Commonwealth officers appearing today are also reminded of the Senate order specifying the process by which a claim of public interest immunity should be raised. A copy of the order is available from the Secretariat. I remind committee members and witnesses who are appearing via tele or video conference and who are not speaking to mute their microphones. I now welcome the Australian Council of Trade Unions, who made submission number 75. I understand that information on parliamentary privilege and the protection of witnesses giving evidence to Senate committees has been provided to you. For the Hansard record, will you please state your names and the capacity in which you appear today?
Thank you, Senator and Committee. It's Scott Connolly. I'm Assistant Secretary of the Australian Council of Trade Unions, and with me is Mr Andrew Linden, who's a Workers' Capital Officer here in our team.
Thank you very much. I now invite you to make a short opening statement, and at the conclusion of any remarks, I will invite members of the committee to ask questions. And if you have a copy of that opening statement and you are willing to forward it to the Secretary, it would be helpful to be able to table it.
Thank you, Senator. We'll make a statement largely based on our submission. And,
thank you.
Go from there, but really appreciate the opportunity to talk to the committee today, and I welcome this inquiry. I'll make some initial remarks and then ask Andrew to make some supplementary remarks if that's okay for the committee. I think really this is an important issue from our perspective. It's one that we are keenly interested in seeing improvements to be made too, in terms of the significant impact that corporate insolvencies have on Australian businesses, communities and of course workers. From our perspective, I think we've got absolutely a shared interest across the political spectrum, but also the spectrum of the labour market and the players within it, that we have vital, sustainable and functioning over the long term businesses across our economy, both small, medium and large, regardless of how they're structured, from sole trader, independent operators to sort of large corporate entities. I think for us, of course, these are the vehicles of employment. They're the vehicles of people providing the opportunities for themselves and their families. And when businesses fail or they're insolvent, there's impacts, of course, on the business owners that have taken risk to establish business and go out there on their own. And that's negative, but similarly, that's absolutely a negative. But similarly, there's a negative impact on the business, the employees of the businesses, and increasingly related contractors and suppliers in very complex supply chains that are, of course, continuing to evolve and emerge. So, we feel keenly these issues and the impact of insolvency and business collapse. And from a worker's perspective, we sort of course, are closer to the impact of that across workers and their immediate families and communities, and what that means for them. And then, of course, those that are able to pick themselves up and find additional opportunities or forced to look for additional opportunities because of business failure, sort of see them through the journeys. Of course, in my time in the movement, I've seen far too many of these. I think had exposure to the collapse at Ansett and sort of saw, all ends of that collapse, from the financial largesse to a degree, arguments about, waste and things that could have been done differently, all of which I think have absolute merit. But saw very keenly equally the terrible impact it had on families and communities, from suicides to sort of just lives lost, communities devastated as a result of those consequences, that failure. And there's been far too many since then, of course. We've had Virgin just the last few years, Arium years ago. For me, again, it goes back to National Textiles and the start of the debate about national employment's entitlements protection schemes that various governments have now implemented, and of course we now see entrenched in the FEG. And of course, pertinently the collapse of Scott's Transport just yesterday. Again, I have a history in the transport sector and the Transport Union before coming to the ACTU, and can only sort of reflect on what those that employer and those people associated with that company, who has a long and proud history in the transport industry, it's been operating for decades, are now going through 1,500 workers. There's 500 trucks across the country stranded. There's massive impact across our retail supply chains because of the pressures that companies been facing and can't sustain going forward. So I made the decision it's made. So it is something that we are obviously very, very, very close to and invested in. And I guess when we reflect on sort of the issues here, it's discomforting to see how much hasn't changed over the course of the decades in terms of the exposures of corporate collapse. How there seems to be a trend to there's high risk industries here: construction, transport, hospitality, industries that face significant pressures, that are struggling for capitalisation, that are price setters or price takers, to a degree in terms of their places in the supply chain. Issues, of course, about the skill sets of the management class, the corporate skill sets that go to some of these businesses, all of which our sort of report, our submission sort of calls out that the longitudinal trends here suggest that there's not just an issue here. There's a specific issue in a number of industries that I think warrant some consideration about what can be done to sort of address this, be it with some of the recommendations we're making about improved training, improved standards, improved points of entry to try and assist business and enable business to be better and have protections. I think to sort of consideration given to requirements for capitalisation or a tightening up of how businesses start that journey before they're taking on risk. I think these are things that warrant consideration. Then, of course, to the other end about what we can do about tightening up FEG, providing additional access, and similarly do things at the far end of the spectrum in terms of the insolvency practitioners and the actuaries that play a role at the back end, and how we might think through more sustainable support through a state playing a role in terms of providing an insolvency bench or a panel, so we sort of don't have the experience where inordinate fees are sort of dragged out of these insolvencies. And, you know, I've seen the fee bills from Manset to Virgin to Arian, and they are extraordinary in terms of the bills that are pulled out of, ultimately out of the entitlements of the workers from our perspective, but equally the other investors and the other entities that have taken risk in these enterprises that have failed. So we think there's lots to do here, and I think it's also just sort of, before I throw to Andrew, just sort of reflecting on the size of this problem and sort of how significant it is in terms of its scale. If we think about it, the FEG, of course, you know, 1.3 billion, you know, so far to the taxpayer. We're recovering, you know, a really paltry amount coming back into general reserves. You know, that's a concern that we need to sort of think through. How do we solve that problem? Yeah, the debt owed from insolvency, you know, at a $8.4 billion, I think, is a significant figure. And then, of course, the small business sector, if we think about its exposure, it's responsible for, you know, 65% of the ATO's outstanding debt at close to $30 billion. They're extraordinary figures that I think we need to think about both the human cost of what's occurring, why it's continuing to occur, the impact on businesses, and then, of course, the wider community, and, of course, the sustainability of this. A concept from our perspective that we can just continue to accept that failure is part of this, and that's the way it's always been, and it always should be, is not a mindset that we accept. I think the cost of that is far too great and increasing, and it's not a model that internationally stacks up. You know, the global trends in terms of insolvencies, innovation and failure make us an outlier in contrast to some of the other countries that we would look to say that they're innovators, they've got a vibrant small business and emerging innovative sectors without the rates of insolvency and business failure that we do. So I think there's learnings here, and we welcome the Parliament's attention to this and the inquiries, investigations into this issue.
Thank you. Thank you, Mr Connolly. That whole ecosystem of everybody being in it together, I think, has been enlivened through the tragic reality of experiencing COVID, and everybody's understanding that we all benefit from great legislation that helps everyone get the best out of what's going on in our economy. I'm just mindful of time. Mr Linden, can I give you 3 minutes to give us your best thoughts, and then we'll go to questions?
Sure. Thanks, Senator. I think just for the committee's benefit, it's useful to think about the big picture context of the relative size of the problem in Australia and what are the trends over time. So as Scott mentioned, one of the interesting things when you look at a lot of the international research is that underneath the kind of the ups and downs of failures or insolvencies that are driven by the business cycle, there is a fairly well-established pattern of failure across different countries that, again, focuses on a number of particular industries that seem to have deep problems with the way they're structured and their culture, the kind of resort to sharp practices. So, you know, the patterns of insolvency in industries such as building and construction, hospitality, the kind of amorphous other services sector, is kind of a feature of patterns of failure in other countries as well. The other thing I think that is other interesting phenomena that's been happening over the last 2 decades or so is this shift away from people getting into business as sole traders and in partnerships. So being exposed in a full liability sense to when they enter business, to the incredible proliferation of limited liability, the use of limited liability business structures. Right, so this is kind of a really interesting phenomenon that not a lot of people have kind of picked up on, but I think is important. So you've got this kind of incredible growth in the use of proprietary companies. And again, I think the research that we've drawn on in our submission points to the fact that sole director proprietary companies are especially high risk when it comes to insolvency, and also the use of trusts. So that shift to away from unlimited liability entities, which incidentally have always had a lower rate of failure or distress than limited liability entities, kind of suggests that there's been a huge amount of risk sharing shifting happening. So people who are getting into business, forming proprietary companies and using trusts are essentially shifting risk onto other people. And by shifting risk, that is part of, obviously, it helps people get into business, but also when things go wrong, all those costs are externalised on other parties, whether it be workers, other creditors, unsecured creditors. And in that kind of basket of unsecured creditors, one of the big phenomenons that's happened in the workforce, so again over the last 2 decades, has been the shift to labour hire and dependent contracting. And again, a lot of workers that were formerly directly employed now find themselves as dependent contractors, and when companies fail, they're now unsecured creditors. So they lose double and triple in a way, because by often being coerced into a dependent contracting relationship, they lose out on all those leave entitlements that are partly covered off by the FEG. But then they're in a situation when the company becomes insolvent that they're completely exposed. And so that is a significant problem in the context where the number of companies in Australia has doubled in the last 2 decades. And that's running way ahead of growth in the labour force, and also population growth. And finally, another startling statistic that we picked up in our submission from the World Bank is that the rate of company formation in Australia is, in nominal terms, roughly equivalent to much larger economies like France and in excess of countries like Germany. And the density or the per capita rates of formation are very high by international standards. And that suggests that a lot of people are getting into business that at rates that are not seen elsewhere in the world. Perhaps the only other example is the UK, but there are special circumstances why there's a lot of companies that are registered in the UK. But so that kind of gives you a big picture overview, I think, of the problems and the recommendations the ACT is making in its submission, try and address those big systemic drivers.
Thank you very much, Mr. Linden, for that contribution, because there is that, the ecosystem that we were talking about, but a different one, the international one that you referred to there, that gives us a sense of the particular flavour of where we find Australia, and we've been asking questions about the Harmer Review in 35 years. You've spoken really about the outcome for creditors in an economy where only 1 in 14 corporations are filing for insolvency, compared to 13 out of 14 just letting a corporation be deregistered. 92% of unsecured creditors getting zero return in the event of collapse. It doesn't seem to be a functioning and fair system. You've put in a number of recommendations here. I just want to give you the chance to quickly highlight the critical ones. What more do you think needs to be done to protect workers and their legal entitlements in the event of a business insolvency?
Okay, so if you look at the recommendations we're suggesting, they kind of stretch. What we're looking at is trying to address the problem both at the back end when there are failures, but also systemically reducing the number of insolvencies and business failures by looking at what happens at the front end when people think about getting into business. Right, so when you look at the kind of things that we're suggesting at the front end relate to basically relate to the kind of trends that we just highlighted, but spelled out in our submission, and the international evidence and the local, both Australian and international research about the particular risks of sole director proprietary companies, what is driving failure rates in that particular cohort, and the research that's been in Australia and that's been again replicated overseas suggests that a lot of people who are accessing the proprietary company form are just not equipped to drive that complex bit of leverage machinery, right? So, we're making the suggestion that there be a basic business concepts test. So a lot of the ASIC insolvency data points to problems with directors of companies, of mainly sole proprietor companies, not keeping proper records, not understanding the basics, so they get into trouble, and that a lot of the causal drivers of failure for a lot of businesses get back to. I think there was again a really interesting insight from some Australian research where a good proportion of sole directors weren't confident in working with financial statements, and that's part of the problem, and that causes problems because, as the researchers noted, that if people aren't confident in using financial information, then they tend to not collect it, record it, as they're obliged to do as directors, and that creates problems. And then there's these sudden failures where then all those costs are then externalised onto other people, and that's an issue.
Senator, I might just sort of draw the committee's attention to the page 8 of our submission and the recommendations that we make around systemic reforms. I think if you ask us to list things, there's quite a big list, and I won't go through it, but I think sort of significantly, certainly for employees, of course, the issues around the FEG, seeing it uncapped and expanded, would be a significant reform from our perspective at the back end, like in terms of, obviously we want to stop it at the front end and do things there, absolutely. Yep. But for the employee's perspective, of course, we've got a vested interest there. That's a critical issue. I think the issue about security of entitlements for other employees and accessing trust is a significant gap in the system that needs consideration, whether we can look to portability schemes for entitlements that are lost through these experiences is worth warranting. And of course, there's a significant conversation, hopefully, has been happening for some years around payday super But in terms of that simple change to mandate real-time payments of superannuation would remove that gap from the system and ensure that that entitlement at least would be provided to the employees. There's additional points around adequacy that we think absolutely warrant consideration. Requirements for director skill sets before entry into business, all of which I think are about uplifting the capacity and the viability of our business sector to be more effective and more successful, and that's absolutely what we want to achieve by these reforms.
Thank you for those comments, and they do echo some of the evidence we've received in the last couple of days, and the tension between allowing people the opportunity to get a business up and running with all the blue sky hopes of it, but the reality of needing the skills. We heard yesterday about accountants being engaged by people at the beginning when they were capitalised and able to do that, but as things start to fall apart, the skill deficit that they had and they could formally rely on a skilled person to provide for them becomes less and less accessible, and that becomes part of the spiral. So there are a few structural things that we really need to look at. I have many more questions, and I know my colleagues on the line will have some as well. Could you just answer perhaps this one, and if we can, I'll come back around with another round of questioning. You support the role of a public liquidator, such as the Office of a Public Liquidator in the UK, and a Commonwealth Company Insolvency Service is mentioned in your submission as well. You also expressed some concern with the process of appointment of insolvency practitioners, a bit like choosing your own cop. So would you like to speak to those two issues, and then I'll move to one of the LNP senators and members here, if they can just indicate who wants to call. Mr Connolly, you want to take that first?
Yeah, thanks, Senator. I think sort of in terms of the public liquidator, we think there's a public need here, and a public would come from making an investment here. The reality of this is that there will be insolvencies going forward, and we accept that there'll always be a place for that in a market, inevitably, and rightly so. But I think recognising that what we can do as a community to offset the risks and the negative impact and ensure that the externalisation of risk and cost is minimised across the Commonwealth in this context, I think is in the interest of both business and the community, and for not significant, but in the grand scheme of a $30 billion debt currently that we probably have very little prospect of recovering back to the ATO. It's probably an investment that would make a significant difference in terms of seeing that debt reduced over time. In terms of a panel, I think my experience of there's a very small niche number of providers in this sector that seem to coalesce around big corporate insolvencies and small to a degree as well, that really have a cornered market, and that is not good in anyone's experience, and the fees are a test to that. There's a mountain of work here, absolutely. But as ultimately secured creditors in this process, they enter it with little risk and have a role in this ecosystem, as you describe it, that is really suffers little accountability given their status in the pecking order and the status of other creditors who are clamouring to recover often, the 1, 2, 3 to 5 cents that they have any prospect of getting out of their investment. And that imbalance of power and economics is not in the interests of the creditors and serves the interests of the big insolvency practitioners, and that's not in the public interest or the interest of the business ultimately, and from our perspective, obviously, the employees that work in business.
So one follow-up, we've had evidence from concerned participants forced into the insolvency space that the business model appears to be a public good provided by private entities where there is a cross-subsidisation of large entities being well, not to put too fine a point on it, fleeced, which would cover off the cost then of doing business with entities from which there can be no recompense gathered. So there's a very powerful argument for having a Commonwealth insolvency practitioner body established to deal with the public good. We heard from some others though, including I think at Chartered Accountants Australia New Zealand yesterday, that it's not a cross-subsidising model and that there's no, what should I say, there's no bad practice embedded in what's going on. It's simply mindful, good business that there will be bad debts. So the structure of the business takes into account that there are going to be bad debts in certain parts of it, and then they compensate in other ways. So there's two very different views of the practice of how the money's moving in the industry. So if you could comment on that and give us a sense also, finally, of your view about the need for a root and branch review and or some change going forward immediately to, critical things that need to be addressed while such a review was undertaken, or just leave it alone. They're your options A, B and C.
Yeah, I think we certainly have a view that there is cross-subsidising here, and that's been my experience, that it is sort of an issue that needs addressing, and would support a root and branch approach to this. There's some specific in our recommendation to go to what immediately could be done in terms of to try and tighten up. I think one of the critical things is, in my experience, has been just the assumption, and you called this out in your comments, Senator, that there's bad debt and there's going to be a failure. I think a precondition that there's going to be a recovery would be a better start, that we can actually get the enterprise back on its feet, rather than getting locked into the assumption that we're going to wind this place up. We're on a pathway to liquidation. That's not, unfortunately, the assumption that far too often we see starts the engagement of the practitioners. You're sort of on a pathway. There's a well and tested path in terms of the creditors, the attestation of debt, et cetera, rather than what can we do, as I'm sure that's happening at Scott's in the last 24, 48 hours, what can be done to put this business back on a right footing and ensure it remains solvent and viable, and flipping the priorities to that in all of the big insolvencies that I've been part of, from National Textiles to REM and Scott's today, to get that mindset change out of the experts or the practitioners is a battle. It's a battle to turn the dial that we can save this business, and sometimes you can't. But if you could quickly make that assumption, you can save. In the Virgin's case, it was $30 million going out the door a month. That's the level of costs often you see sort of to keep these places on foot. So burning cash hurts, absolutely, but the quicker you can get places reset and re-established, you're making the savings immediately, and that makes such a big difference.
And we did have evidence yesterday that it wouldn't be perhaps advantageous to have a reconstruction practitioner business and an insolvency business as two separate entities with clearly delineated roles, which might be a lot more, appealing to Australian business owners at whatever stage they find themselves. I'm going to go to Senator Scarr now for a series of questions, and I hope to come back around. Thank you. For those witnesses who are waiting online, can I just indicate that we are likely to run over time with this first session. I would hope to get back to you by 10 o'clock. Thank you.
Thank you, Chair. Can you hear me?
Yes, Senator Scarr, you have the call.
Excellent. I wanted, in the first instance, to drill down into the scope of our existing FEG scheme, and where our witnesses believe that the scope of FEG should be expanded. And I'm particularly mindful of the fact I'm trying to put myself in the position of the employees of Scott's, and it seems to me that they're going to be under great stress, and I think it's a great thing that we've got a FEG scheme. that at least gives them some level of comfort with respect to at least some of their entitlements. So I'm, in the first instance, what doesn't FEG cover in terms of an employee's entitlements? One of our, considering an employee in Scots who's currently concerned about their entitlements.
Yeah, I think the issue with the FEG is it's capped. So it's fixed 16 weeks, the cap currently now, I think. So the issue we've got is that, and I know many of the drivers at Scots, I've represented them in a former life. The majority are long-term employees that would have entitlements far exceeding that cap. So you'll see a proportion of recovery if there's worst case scenario here. But if you're a 30-year driver at Scots, and there'll be many of these examples, you'll see the overwhelming majority of your entitlements not provided in the case of a collapse in insolvency, and hopefully that's not the case here. But that's a life work of investment and commitment to a company that's gone through this system. And we understand there's a limit to what the Commonwealth can do, absolutely, and absolutely support the FEG, but its capping is significant in terms of its impact on long-term employees. So that's sort of the biggest. Super is another one that isn't fully recoverable under the scheme. And I think the other significant point I'd make here is that transport, like many industries, is one that's it's a heavily connected supply chain. So the collapse of Scots will impact, as Andrew made the point about labour hire, contractors that aren't employees of the Scots business that will potentially go into administration or insolvency, that have no rights, direct rights through the liquidation process as creditors. And that's, again, a significant cap. And I think as our businesses get more complex, more interconnected, and our supply chains are more connected, this issue of the portability of entitlements across enterprises is one that I think it warrants consideration in the context of what our workforce will be looking like on the current direct trajectory in a decade's time.
Okay, and I'll come to portability, but I want to drill down or really enhance the discussion around the position of a long-term employee, because I think that is a really important point, that you've got someone who's been a worker at a business for a lengthy period of time, as you said, could be 30 years or whatever it is. So they've built up a lot of entitlements from one employer, really because they've been loyal, they've been a mainstay of the business over many years, they've no doubt contributed to the business over a long period of time, and potentially they're not going to get any more out of the FEG scheme than someone who's been there for a much shorter period of time because of the operation of the cap. Is that correct?
That's exactly correct. And I think the issue in industries like trucking is that they don't take leave because they can't get it. That's the nature of the industry. So it's they're loyal and committed, but trucking moves 24/7. There's not many truck drivers that take 4 weeks annual leave or ever have taken 4 weeks annual leave. So the nature of their industry they're in means that they accumulate leave balances and long service leave if they're lucky, but leave inevitably because of the nature of the sector they're in. And the industries that we're calling out here, particularly hospitality, construction, personal services, they're similar in terms of the nature of their place in our labour market, where they're highly intensive, highly functioning, labour intensive. So the capacity of, particularly in a compressed labour market, for them to access leave and take their full entitlements and see them expired year on year is not a reality. They're not banking leave. They're just trying to get by in an industry that they've made the decision to commit themselves to. And because of the nature of the scheme, because of the caps that are in place, they're disadvantaged by that in these worst case scenarios. And that's a glaring inequity in our minds that obviously we seek to be addressed. And, I think if I reflect on the drama I went through with Ansett, those workers ultimately got 99 cents in the dollar of all of their entitlements. It took 12 years for that to occur.
Oh, well, congratulations on your efforts in that regard. 12 years, goodness me. And the issue in terms of say the truck driver, say the person who's not taking leave, they're actually doing that to assist the business.
Absolutely.
And yet they can be penalised at the back end through the operation of the FEG scheme. Is that correct?
That's correct.
Yeah. So just in terms of removing the cap altogether, one of the concerns I have is how you draw a distinction between the example of our truck drivers given great service loyal service over 30 years, hasn't taken leave even maybe because they wanted to, because there's a shortage of drivers, etc., as opposed to someone who's in a very senior management position. And it concerns me somewhat that there'd be no cap at all, because this is a taxpayer-funded scheme, and I think certainly in my mind, I'm just telling you, I'm being open with you how I'm thinking with respect to this. There should be some level, at very high rates of remuneration where there should be some limit, I would have thought. Can I just get your response in relation to that?
I think it's a legitimate point you make, Senator, that warrants consideration about where's the most need, and how the taxpayer's contribution here is targeted to those that are most in need. And I don't discount the work or the role of senior management or highly paid executives in any companies. They're a critical part of I'll say, most businesses. But I think at a cap at a level that's appropriate, that targets those most in need, I think is worth considering. You know, we absolutely acknowledge the limit to the Commonwealth's capacity to support here. There's been, there's decades plus debate about these schemes. I think it's a great initiative, but it's not quite where it needs to be. And if it could be improved to make a difference to those most in need, that would be a positive change. Equally cognizant that what can we do about recovery? What can we do about levies or other mechanisms to have contributions on the way through to support the scheme that we don't do now, given the poor rate of recovery.
Okay, and do we have any figures? And I think we've had a submission from FEG, but I'm interested from the ACTU and broader trade union movement with respect to any figures you have with respect to the extent to which employees aren't recovering their entitlements because of the operation of the existing FEG scheme. Is there any data that can give us a better appreciation of this sort of issue?
We can take on notice, and if that's okay. I don't have any to hand, but we've obviously thought about this for a while, and I think there may be something we can access, and if that's the case, we're happy to provide it to the committee.
And look, one of the things which I think would be useful in terms of our consideration as a committee, if we could even have some case studies. So, let's have an example of say a truck driver who's been working in the same company for say 25 years, who's only taken say 1 week of leave for 20 of those years and has accrued long service leave, just to get a feel for the quantum we're talking about and the real world impact this would have on that employee, especially as they're coming to the end of their working life.
Happy to.
Is that something which would be possible?
Yeah, I think that if you also look at some of our affiliate submissions to the committee, they provide some really in-depth and excellent particular case study examples of some of the problems when companies fall over and what happens when and the impact on their entitlements. So I think the AMWU submission and the ETU submission focus particularly on lost entitlements where people have there are agreements, for example, on entitlements that are above the cap and they lose those.
And we'll do what we can.
No,
Come back to you.
That's very useful, and we'll I'll go back and refer to those. Chair, I've got some other issues on other questions on another topic dealing with capital adequacy, but I might just share the call, given we've got limited time, and I know you've got further questions.
It's okay if you want to go for another 4 or 5 minutes. I think we can manage that.
Oh, okay, all right, I will. Look, just moving to capital adequacy, and just to give you an insight into my background, I used to be a company secretary in a mid-tier mining company, and I was involved in setting up a lot of subsidiaries for overseas investments, etc. So I've got some real working knowledge in relation to the sorts of issues that go into capital adequacy, and I really do. I understand the point which you're making. Absolutely understand the point, and feel free to take some of these questions on notice. One of the handbrakes, if you like, stopping Australian subsidiaries of overseas corporations, and it occurs when Australian companies invest overseas, taxation rules relating to thin capitalisation, which basically means you can't get a deduction for loans unless you've got sufficient capital invested in the company. Has the ACTU considered how the operation of those thin capitalisation rules in practice may assist in making sure that operating subsidiaries in particular of companies have a significant level of capital, and does that give you some comfort?
So I think one of the issues that we, particularly while we made that recommendation around onshore Australian subsidiaries of offshore entities, is particularly in the labour hire space, and this is related to issues of, for example, modern slavery abuses in industries like horticulture and phoenixing, that there's a problem where the onshore subsidiary is being loaded up with a lot of liabilities without any capital, and then there's no comeback because the parent is located in a low transparency jurisdiction, and when the onshore entity falls over, then there's a problem with workers and other creditors chasing the foreign entity because it's out of reach. And that, I think in a number of the peer-reviewed academic papers over the last couple of decades have pointed out that this is an issue. So it's probably a feature of some of the smaller operators as opposed to perhaps the larger, better capital, bigger operators that operate across jurisdictions.
Okay, so you're raising these issues legitimately in the context of a particular method you're seeing or practice in specific areas, and you've mentioned those specific areas. Is that correct?
Yeah. So an offshore parent will set up dozens and dozens of proprietary companies in Australia, and they'll all be either have no assets, or they'll be encumbered with even offshore liabilities, and then they fall over, and then there's zero recovery for anybody.
Okay, I understand. At the same time, though, do you recognise that at the other end of the spectrum, there can be legitimate reasons why bona fide companies are setting up corporate structures with intermediate holding companies? It can sometimes assist in order to get project finance for projects. It can assist in terms of if you want to sell an interest or sell down an interest in an asset, you can do it through intermediate holding companies, and you're not you're not trying to do anything at all to disadvantage employees or workers. You're actually just trying to structure your investment in a way that makes it as easy as possible to bring in equity, bring in debt, and maintain flexibility. Do you see that perspective as well?
Absolutely, Senator. I think we acknowledge that, and I think businesses making decisions about their corporate structures, be it for tax or finance considerations, are all legitimate, and they're sort of the nature of business. It's sort of part of it. I think the question of where's the balance here is probably where this goes to. Is there a practice which we say is concerning because it's leading to it's designed to have an impact that externalises risk, as opposed to a legitimate practice to provide sustainability and viability, and getting the balance right in that regard, I think is appropriate.
Okay. Can I ask you to take on notice, and again, it might be touched on, we've received this has been a very successful inquiry so far. There's been lots of submissions received. So there might have been some discussion of this in some of the other submissions. I'm just going back in my mind's eye trying to remember from the AMWU and ETU and others, but and CFMEU. It would be helpful for me if you could provide some examples or case studies on notice of things which have happened in practice where these specific issues have arisen, just to perhaps give me and other members of the committee a greater appreciation of what it is that we should be reflecting on in order to stop illegitimate practices. Would that be possible?
Yes, Senator, happy to undertake to do that.
Okay, thank you, Chair.
Thank you very much. Can I just ask two more questions, and then I know that Mr. Georganas, who's with us, has a couple to finish. I note in your submission that you refer to the Australian National Audit Office report number 32 of 2018-2019, which reviewed the Phoenix Task Force effectiveness, showing that in a single disclosure, they identified 110 persons of interest who were involved in the creation of 4,412 companies and trusts. Can I just give you the opportunity to put on the record your view about what more needs to be done to halt, this pernicious spread of phoenixing and its practitioners, the impact it has on workers and legal entitlements, and what do you believe should happen to directors who start and run companies of this kind?
Andrew?
Yeah, I think that reference in the in the audit office report is incredibly, it's incredibly startling, but it just emphasises the problem of ease of access to forming proprietary companies, the problem that creates, and that's why we've in the context of phoenixing, ease of creating successor structures is what enables the phoenixing business model to happen. So we, for example, see our recommendations around minimum capitalisation as a way of director duties as a way of actually slowing people who are engaged in phoenixing down. The other big avenue of attack is via director banning. So again, there's an issue. I think we point out that bankrupts can't run companies, but if you run multiple companies into the ground, in fact, it's the Australian and international statistics show that there's a much higher likelihood of directors who of sole proprietor companies failing again. And so that brings into the picture what ASIC is doing about and their scope to actually ban directors where they in liquidator reports or administrator reports there's evidence that they breach their duties, and that there should be a provision to see automatic disqualification, because that would, all those things together would actually slow down the problem of phoenixing, which is in the industries. It's not surprising that the industries with high rates of insolvency, like building and construction, hospitality, also have problems with phoenixing, so the issues are not unrelated.
Thank you. And just finally, do you think corporate trusts should be regulated?
Yeah, well, I know, looking at some of the other evidence given during at the committee, that this
We
is
had a remarkable submission yesterday from Mr. D'Angelo.
Yeah, it's a huge issue, and look, again, the proliferation in corporate trusts in Australia is again points to a problem with trading trusts, and again, they should be regulated and treated. Again, just getting back to Senator Scarr's question about it's the conduct. So this idea of the use of trusts as a creditor defeating vehicle. So it's the conduct of the trustees. So this whole area is, I wouldn't like to try and become a super expert in trust law, but it's an area that needs to be fixed, because trusts are often embedded in complex corporate structures, including structures that are being used to with phoenixing and other problematic activities that we've highlighted in our submission.
Yeah, maybe that's some of the matters that might need some attention prior to the delivery of a fulsome root and branch review.
Yeah, I think Senator, just to reflect on this, I think we sort of absolutely think, it sort of goes to the evolution of our laws here, and, the thinking about trusts and how they've been evolved and how they're sort of another vehicle that are now being used to enable externalising risk or minimising liabilities, however you want to put it. But it sort of goes to, we've sort of introduced FEG, but it's always the opportunity cost of non-compliance, and the benefit is sort of that trade-off that, unfortunately, there's operators out there that are making strategic decisions about how they're going to structure their business to externalise risk, put it on someone else's onus. So we need to think about how we evolve our law continually to keep tidying up the loopholes, and I think that's appropriate that we think about trusts in that context, because clearly the evidence suggests that they are becoming a vehicle for avoidance and non-compliance.
And I think that's the critical terminology that you've brought to the committee, is the cost externalised to other parties of failures of our structures at the moment. I think you've made that very clear. I think Mr. Georganas has a few questions, and then we'll complete and move to our next witnesses. Thank you.
Thank you, Chair, and thank you to both of you for appearing before us today. It was on submission 66 about IncoLink, which recommended that workers' entitlement accounts are ring-fenced, so they're not available to other creditors in the instance of insolvency. So I'd like to know your views on the entitlement schemes like IncoLink, but more importantly, do schemes like IncoLink actually protect employees in labour hire companies and independent contracting?
We think these schemes are significant improvements in the industries that they operate, and what they've been able to do industrially, frankly, is a credit to those that have established them, generally in partnership, in terms of identifying a problem and identifying and solving it together cooperatively, industry and employers. So we think these schemes work well. We think the connection of them more broadly to something viable as a national scheme. Obviously we're saying, look, this model of portability, continuity of entitlements has merit and should apply to all workers. So I think should we be successful with that, then consideration of how that intersects with the existing schemes is something that we need to think about, because the schemes clearly have made a significant difference in the industries that they operate, as has the other schemes that the Victorian government's introduced in the cleaning and waste industries. The ACT government's made some steps here in the contracting sectors as well, all of which are not just successful in terms of remediating and negating negative impact on employees, but my understanding is they're assisting with revenue.
And in terms of employees in labour hire companies or contracting, would there be any difficulties in that, or would they be able to assist?
We don't see any difficulties on the basis of an employee is an employee. The issue here is they get caught up and disadvantaged because of the nature of who their employer is. But if the entitlement is generic to all employees, regardless of employer, then that's how we close that loophole in our minds.
The other one I've got, if we've got time, it's been suggested that unions have the automatic power to represent their members in creditors' meetings and to seek compensation on behalf of members. And I was just wondering what your views are on this, and what would there be any unintended consequences and the positive side of it?
I can't see any negative consequences. I think, frankly, the imperative of unions to do right for members in this context is paramount. These are workers in crisis, up against it. I've known far too many of them. So there's nothing other than ensuring that they get the best, preferably a viable job going forward. That's overwhelmingly the priority, I think, of our unions when they're entering these situations. And I know it's the conversation happening at Scott's right now. But if that fails, then that they're recovering as much of their entitlements as they practically can. And I think absolutely providing standing or expediting, if that's not possible, then expediting the capacity for employees to be represented and unions to be given standard would absolutely assist in the process. I made a point earlier about the time that's lost here in the bureaucracy of the process, the 30 days, the 60 days, the 90 days to get standing, a test debt, all of which just adds to cash burn at one end, but also the pressure, negative impact on workers and communities. And if we can do anything to minimise impacts, as this change would do, that would be a positive thing that we'd welcome.
Thank you. Thanks.
We've got time for one more.
Okay, excellent. We saw in submission 68 from the CFMEU, which recommended payments, the payment trusts to protect the subcontractor retentions. What are your views on that, and how would that work?
If I can take it on notice, if that's okay. I haven't looked at that recommendation, and
It's,
I don't.
Submission 68, page 9 to 10.
Okay, well, why don't we take on notice and come back to you? I suspect it's pretty simple, but I'm just hesitant to give you an answer authoritatively without checking the particular trust they're talking about.
Thank you. Thank you very much. Thank you, Mr. Georgianis. That concludes the session of today's hearing, this session. Thank you to the ACTU representatives, Mr. Linden and Mr. Connolly, and thank you to all those who prepared a very thorough submission. The deadline for questions on notice for this committee is Thursday, the 23rd of March. There's a couple that have been indicated, and there may be a few more. Hopefully you can assist the committee in that way. Thanks again.
Thank you, Zach. No, thank you, committee. Thank you.
I now welcome our illustrious academic panel. I invite you to come forward. Apologies for the delay, but I hope that you agree with me that it was worth taking that evidence while we had the opportunity from the ACTU, seeing as they interact with so many businesses and workers right across the country. Thank you. I now welcome by teleconference Professor Jenny Buchan, Miss Catherine Robinson, who made submission number 41, Associate Professor Mark Wellard, who made submission number 51, and Professor Anil Hargovan, I hope that's correct, who contributed to submission 37, submission 1 to the ASIC Oversight Inquiry, and provided an article on small business insolvency reforms, which has been published as additional information for this inquiry. I understand that information on parliamentary privilege and the protection of witnesses giving evidence to Senate committees has been provided to you. For the Hansard record, would you please state your full names, the capacity in which you appear today? Start with Professor Hargovan.
Thank you. My name is Anil Hargovan, and I'm representing the Society of Corporate Law Academics, otherwise known as SCOLA.
Thank you.
My name is Catherine Robinson. I'm appearing in a private capacity.
Mark Wellard, Associate Professor at Southern Cross University, but I am here in my capacity as an independent academic.
Thank you very much. And I invite each of you, if you have an opening statement, to put that on the record, and of course senators and members will have questions following. We might start with Associate Professor Hargovan.
Thank you.
We haven't heard from, sorry, I was remiss then in getting Emeritus Professor Jenny Buchan to put her name and details on the record.
Thanks. Emeritus Professor Jenny Buchan. I am a franchise researcher who is submitting in an independent capacity.
And we found Professor Buchan's work on franchising extremely helpful in a previous inquiry of this committee, so we appreciate your investment in the national interest again. We'll start with Professor...
Thank you very much.
It's wonderful. Thank you, Associate Professor Hargovan. If we go first with you.
Okay, thank you. SCOLA welcomes the opportunity to address the committee today on insolvency law reform. SCOLA is a peak body for corporate law academics. It has a role in fostering debate and discussion about corporate law reform, including corporate insolvency law reform. The submission that I will speak to today has been prepared by a committee of SCOLA insolvency experts. It's very noteworthy that there appears to be a large appetite for a root and branch review of Australian insolvency law. Now, that call may mean different things to different people, and I'd be happy to expand on this during Q&A. We advocate for a major inquiry, one that examines both policy and technical aspects of insolvency law. So in this regard, SCOLA joins a steady chorus led by law reform bodies, judges, academics. We commend to the committee the review of the Safe Harbour Insolvent Trading Report tabled in 24th March 2022, commissioned by Treasury. In our view, that report offers compelling reasons for a comprehensive review of Australia's insolvency laws from an economic, legal, and social perspective. We observe the steady drumbeat for wholesale review of our insolvency law is unsurprising, given that such a large review was commissioned some 39 years ago and subsequently undertaken by the ALRC, which produced the Harmer Report, a document that remains of great significance, stands as a beacon, made incisive comments on Australia's restructuring reform options, and culminated in cutting-edge reform, and was influential in other countries like England and New Zealand. However, the world has changed since then, and we say a golden opportunity should be seized on this occasion to re-evaluate if our current insolvent system remains fit for purpose and remains competitive with other nations that have re-examined their insolvency systems. We see the need to break the cycle of ad hoc reforms that has occurred over the last 30 years since implementation of the Harmer Report. The risk to reform without paying sufficient attention to adopting a holistic approach are well documented. Piecemeal tinkering often gives rise to unintentional, unwelcome consequences, and I think these points are well as illustrated with examples given in the Safe Harbour report of March 2022. We express caution on rushing through reforms and adopting a spot fire mentality or cherry picking on issues. A prime and recent example being the passage of the small business restructuring provisions, the new Part 5.B, which came into effect on 1 January 2021. Stakeholders only had 5 days to make submissions on the exposure draft of the bill, which dealt with a complex, momentous, and intricate area of law. We welcome that law reform initiative, but query whether the end product is fit for purpose. I have circulated an article critiquing the small business restructuring, but I should add that that's been written in my individual capacity. I'm happy to take questions on our submissions.
Thank you very much, Professor Hargovan. We'll go to Ms Robinson now.
Thank you. Thank you for the opportunity to appear today and assist in your inquiry. Through my research, I've worked closely with the regulators, the profession, and consumer groups representing debtors and creditors. I'm indebted to them for their insight, which has drawn out themes such as the role and barriers of insolvency practitioners, the opportunities to improve our regulatory regime, and incentives, or rather strengths-based approaches, which was mentioned in yesterday's hearing briefly. What stands out the most is while there are competing interests, there is this collective goal to prioritise vulnerable clients and this profound awareness that everyone has a role in insolvency regulation. I suggest that this collaborative regulation, like the approach in personal insolvency, is something that is non-legislative, can be implemented in the short term, and is the best way forward to manage the risk and harms in the insolvency industry and support those administering the process. Yet at the same time, there are these important partnerships being explored. It is largely invisible in the public discourse. A limitation of corporate insolvency in Australia continues to be the stigma of insolvency and the perception of those in the system. Along with best practice regulation, one aspect of building confidence in the system, which many submissions and indeed this committee have already addressed, is the issue of data provision. While data is only one story of the regulator's performance, to stakeholders, it is the only snapshot we see of insolvency, of how our insolvency system is regulated. Being transparent, publishing and speaking to this data consistently is critical to not guessing if ASIC is under-resourced or is inactive, or whether there are low or high levels of misconduct in the profession. As ASIC acknowledged before this committee, the practitioners want to see that. But not only that, it goes to the very objective of the Insolvency Law Reform Act to improve overall confidence in the profession and to the government's focus on untrustworthy advisors and ensuring that financially distressed consumers are seeking early help from registered practitioners. Thank you.
Thank you very much, Ms Robinson. Associate Professor Mark Wellard.
Thank you, Senator. Thank you, Chair. And I'd like to thank the committee for the opportunity to appear here today, and I'd like to thank the members of the committee and the committee staff for all you're doing, the work you're doing to engage with the range of perspectives and commentary on the inquiry's terms of reference. It's important work. My credentials are laid out in my submission briefly, and just in the interest of transparency. I am an insolvency law academic. I've been an academic for 10 years. Prior to that, I was a legal practitioner, an insolvency lawyer, and I am also a former legal director of ARETA, the professional body from whom you've received submissions in this inquiry. An optimum insolvency law regime is all about getting the balance right. That is a task that has been made more difficult as the law has become more complex. I support a root and branch review of our insolvency regime, largely due to the complexity of our insolvency laws today and the cost associated with applying many of them. I support the idea of a single insolvency statute for the same reasons. My submission throws some light and emphasis on a few issues.
Mr Weller, just to clarify, single insolvency system, are you referring to the fusion of personal insolvency and corporate insolvency?
Correct, Chair.
Thank you very much. Yes. Please continue.
Thank you. I support a root and branch review of our insolvency regime, largely due to the complexity of it. As I said, my submission throws some light and emphasis on a few issues I think should carry more weight and attention than perhaps they have in the past rounds of insolvency law reform. Principally, the focus of my submission is the responsibility of directors for the state of a company's balance sheet at the time an external administrator is appointed. This inquiry has heard perspectives on insolvency practitioner firms' business models and, predictably, liquidator remuneration. Of more pressing concern, in my view, is a common practice, I won't call it a business model, of company directors trading and incurring debt when their company is insolvent for a period of months or years prior to a liquidation and well past the point at which the business has ceased to be viable. This practice, which is borne out by ASIC statistics, comes at great cost to unsecured creditors who are often themselves SMEs. The statistics referred to in my submission of 30 November last year were the most recent that had been released at that time. Since then, in January this year, just 2 months ago, ASIC released new Series 3 statistics for subsequent years. In preparation for today, I reviewed the statistics for the year 2021/22. These are initial statutory reports of external administrators, for the purposes of confirming, which I can, that the trends and conclusions I drew from the 2018/19 statistics are equally borne out or demonstrated by the 2021/22 statistics. Those most recent statistics for the year 2021/22 demonstrate that and reflect, in fact disclose, that 71% of initial statutory reports of external administrators reported suspected insolvent trading. Of those cases, in 45% of cases where insolvent trading was alleged, the external administrator assessed the onset of insolvency to have occurred more than 2 years prior to the appointment of an external administrator. In 29% of cases, up to $250,000 worth of debt had been incurred compared to the reported estimated asset position of less than $10,000. In 13% of cases, between $250,000 and $1 million worth of debt had been incurred compared to, again, an estimated asset position of less than $10,000.
Sorry, could you just state those numbers again for the 13%?
Yeah, in
Mr.
13% of cases, between $250,000 and $1 million of debts were incurred.
Thank you.
Compared to an estimated asset position of less than $10,000. It's hardly surprising then that 90% of all reports estimated dividend payable to unsecured creditors of less than 11 cents in the dollar, and 85% of reports estimated no, that is 0 cents in the dollar dividend payable to unsecured creditors. My point is, in the ordinary course, one might expect across all the liquidations that occur each year a spread of dividend returns from, say, X percent yielding 90 cents in the dollar down to 60 cents in the dollar down to 5 cents in the dollar or nil. However, that is not what we see. Nearly all liquidations return nothing to general unsecured creditors. In my submission, our economy needs our company directors, but use of the corporate form has to be for reasonable risk-taking, not excessive or reckless incurring of debt. In my view, the disenchantment we often hear about our insolvency system, whether it's liquidator remuneration or proceeds of preference claims not getting to creditors, is caused more by the reality that many company balance sheets are leveraged into oblivion well before a liquidator arrives on the scene. In short, you cannot get something from nothing. If we want to improve returns to unsecured creditors, the prevalence of insolvent trading might be a good place to start. At the very least, in my view, it has to be front and centre in a root and branch review, and it is an issue that, in my view, now extends beyond the mere enforcement outcomes of regulators. For financially distressed SMEs that end up in liquidation, antecedent, that's pre-appointment insolvent trading, appears to be mainstream rather than exceptional. Whether it's because directors don't know how or where to get the relevant advice they need, whether it's because they're unaware of the duties that are owed by a company director, whether it's simply human nature in some cases to ignore the inevitable, or whether it's genuine hardship cases the committee heard about yesterday, the reality is that many directors are trading on their companies and incurring debt at a point long past when the business has ceased to be viable. This is bad for creditors, it's bad for our economy. As the committee heard yesterday, sometimes it's bad for the well-being of the directors themselves. Safe Harbour, in my view, was a sensible and worthwhile reform to assist diligent directors of larger financially distressed companies. However, for many SME directors, it appears insolvent trading remains an ineffective and irrelevant deterrent. ASIC time series statistics suggest this was the case before the introduction of the Safe Harbour from insolvent trading in 2017. My submission proposes some ideas for how we can better calibrate our laws to introduce more accountability of directors for low returns to unsecured creditors. We could, for instance, consider legislating consequences for directors whose companies generate minimal returns to general unsecured creditors. Something similar is actually now in the Act since 2019 in respect of the FEG scheme and FEG advances, where there is a minimal return to the FEG, where the FEG has made advances for employee entitlements. Directors are open to the prospect of disqualification, the minimal return being 10 cents in the dollar or less. Perhaps an automatic disqualification for 3 or 6 months in the event of minimal returns in 2 liquidations might give the directors concerned a brief opportunity to consider and reflect upon what has happened. I don't think that's an extreme proposition or one that sits at odds with notions of entrepreneurship or reasonable risk-taking. None of these perspectives is a silver bullet or panacea, but it's one part of our system that I do think warrants serious reflection, alongside a number of other excellent suggestions for improving our regime that have emerged from the submissions to the inquiry, including a unified insolvency statute and regulatory framework to reduce unnecessary complexity and improve efficiency, straightforward amendments to the legislation to reduce time and cost of insolvency procedures, for example, providing liquidators with the power they should already have to wind up a single capacity trustee company just like any other company without having to go and make an application to court. Also, a root and branch review of our regime. This would, in my view, be a worthwhile opportunity to delve into some of the legal technicalities and complexities which drive a lot of the outcomes. On that note, can I conclude by giving one example of how our present insolvency laws work and what value a root and branch review might bring? My example goes again to insolvent trading. One of the reasons insolvent trading claims, along with other liquidator recovery claims, are often difficult to bring is because of the significant time and cost in proving one necessary element of an insolvent trading claim, namely that the company was actually insolvent on a cash flow basis at the time the debts are alleged to have been incurred in breach of the duty. The solvency or insolvency of the company at that past point in time is often contested and results in tens of thousands of dollars, if not more, of litigation costs. It is a narrower cash flow test of insolvency that applies before a liquidation commences. But once a company is being wound up, it is the balance sheet that determines the ultimate returns to creditors. This disconnect between the cash flow test for insolvency and what I describe as the balance sheet outcomes for creditors might be something a root and branch review could focus on. It has always seemed odd to me that we have liquidations where the balance sheet on day one can only deliver a minimal return for creditors, yet a liquidator pursuing insolvent trading has to spend $50,000 or $100,000 proving the company was insolvent on a cash flow basis prior to liquidation. There are no easy answers or obvious answers to this.
Just before you move on, Professor Wellard, is that, just because I'm not in this industry all the time, is that the point at which they have to determine the level of peak indebtedness? Is that the bit that's tied to that?
No, Chair. That peak debt rule applies to preferences.
Okay, thank you
mind
very
you,
much.
with any voidable transaction claim or insolvent trading claim, an element the liquidator often has to prove as a matter of law is that at the time the transaction occurred that you're seeking to challenge, the company was actually insolvent at that date. That's an element, and that exercise is complex and very difficult because one has to go.
That all makes sense now.
One has
Thank
to
you
go
very
back in
much.
time and look at, on a narrower cash flow basis, whether the company was insolvent at that time, which is difficult. It's contested, obviously, because it's a necessary element of the claim, and it's expensive.
Thank you. That's very helpful for me to get some of the wool out of the
Happy to take
thinking
more questions on that. I was anticipating possibly having raised the issue. You might ask a few questions on that.
That's great. If you want to finish your statement,
very much
you're
about
done.
to finish.
Thank
I
you.
apologise for the length of it, but thank you.
No, good.
As I said, there are no easy answers or obvious answers to that disconnect, but in my view, a root and branch review could examine these sorts of issues about the more nuanced complexity of our law. The issues surrounding unfair preferences, which I know has interested the committee members and was the subject of discussion yesterday, is in my view another prime target of, or subject matter of a root and branch review. I've got views on those as well, but I'll close my opening address there. Thank you for listening and considering my submission, and I'm of course happy to take questions.
Thank you, Associate Professor Wellard. And now to Emeritus Professor Jenny Buchan.
Thanks very much for the invitation to make a submission. My area is franchising. There are probably hundreds of thousands of franchisees in Australia. I think we can all think of them quite off the top of our heads. Each franchisee signs a contract with a franchisor, typically for between 5 years and 20 years. And through franchising, a franchisor is able to pass liability for the full suite of obligations that an employer would incur if it had employees. So basically it's externalised a lot of costs and responsibilities to franchisees. Now, talking about this review on insolvency, franchisors typically fail because of their own issues. They seldom fail because their franchisees have behaved badly. So it'd be really hard for a badly behaved franchisee to take down a system. I've submitted 2 articles to the committee which flesh out in more detail the difference between franchisees and employees. And I'd just like to mention 9 problem areas which are relevant to this inquiry. Franchising is currently regulated as a simple relationship with a contract between a franchisor and a franchisee. It has become vastly more complex as companies, trusts, venture capital owners and public companies have become owners or part owners as either a franchisor or a franchisee. Now, there's nothing to protect franchisees whose franchisor was already insolvent when they bought their franchise. And this is something that Associate Professor Weller touched on. Companies can trade while insolvent for quite a long time before they hold up their hands. And of course, selling more franchises is a very comfortable way to keep padding the balance sheet while receiving franchise fees if you can't deliver on what you've sold. So, for example, and these are not necessarily failed businesses, but just as a financial example, Aussie Home Loans franchisees have to pay $45,000 to buy a franchise, United Petroleum $145,000 and a goodwill payment of $225,000. It's really easy money for a franchisor who is struggling to just fob off their creditors. The third point is that franchisees currently have no standing in a creditors meeting of their franchisor. The next point, exempt proprietary companies, which I think might now be called grandfathered proprietary companies, are still allowed to operate to retain that categorisation under Section 3194 of the Corporations Act. And an example is the 7-Eleven Master Franchise for Australia. That means that basically franchisees buying into 7-Eleven are unable to find out the financial standing of an exempt proprietary company that is operating as a franchisor. That's a real problem. The next problem is that the marketing funds are not currently required to be held in trust. Alan Wine made a recommendation in his review a few years ago that all marketing funds should be held in trust. We simply ended up with the fact that all marketing funds would be held in a separate account, and the Commonwealth successfully exposed the weakness of that system in the Stay in Bed case. The Commonwealth opposed paying the unspent marketing fund back to the franchisees, and their justification was that it would, to do that, would put a drain on the FEG. Now, the franchisees were losing everything, and the FEG was supported by the Commonwealth. So it's really essential that marketing funds be held in trust for the people, that, including a franchisor, who contribute to them. The next problem is the extended time for the administrator to conduct an administration. Obviously, normally there are time limits, and the time limits in insolvency and administration are pretty tight, but the administrator naturally and correctly can go to the court to seek more time in a complex administration. And in franchising, the administrator will sometimes seek extended time up to even 9 months so that it can make the franchisees dispose of rubbish stock that the franchisor has acquired and hasn't found a way of getting rid of. So the franchisees continue to be fully liable under their franchise agreement. The franchisor stops all support, and the franchisees are in a really difficult situation because they have to continue to pay all their normal outgoings They may be at risk of losing their lease because oftentimes, or usually I would suggest, the franchisor has the head lease and the franchisor has failed to meet its obligations under the head lease. So the franchisee can risk losing their premises while the administration is rolling out.
Professor Buchan, can I just ask what number of your 9 are you up to?
2 to go.
Great, okay, because we've only got half an hour for questions, so thank you.
Okay,
Continue.
I'll be really quick. Ipso facto clauses, now that they're void in Australia, apart from a few financial products, they cause real problems because a franchisee can actually be a viable business if it's allowed to cut loose from its franchisor, but it can't walk away because it's not allowed to include an ipso facto clause. And yes, that's it, really. Oh, my final point, sorry. Trademarks are a real issue because of the complexity of ownership. Typically, the trademark and the intellectual property for a franchisor is owned by a separate entity to the franchisor, and therefore the administrator can sell the valuable trademark to a company which, in theory and in practice in one situation in the US, has simply prevented the franchisees from using the trademark, and effectively the whole, their system has closed down. So a competitor purchased the trademarks from the franchisor's administrator.
So I thought I'd sort of heard everything during the franchising inquiry, but you've just put a further level of concern and alarm into my heart and soul.
Sorry.
Mr. Georgianis is having the same response. Thank you very much for your insightful opening remarks, and I believe that I think Senator Scarr might have some questions, and I'll seek further advice through the phone about who else wants to ask questions. Over to you, Senator Scarr.
Okay, thank you very much, Chair, and thank you to all the witnesses for attending today. I'm sorry I can't be there in person, and a broader thank you for all the work you're doing in this space, because I think we as a committee really draw upon the work of our academics in terms of the intellectual rigour they apply to these issues. So thank you very much for all the work that you're doing. My first question is a general question. It's a tension, I think, between the very persuasive case for a root and branch review of all of Australia's insolvency laws, including our bankruptcy laws, so personal insolvency laws and corporate insolvency laws, potentially looking at one unified law. So the merits of that approach, as against the pressing need to make a number of changes to particular discrete laws to address a number of issues which I think could be addressed without that overall root and branch, or before that overall root and branch review is completed. But I note the comment about the dangers of ad hocery and unintended consequences. I'm just looking for some general comments, I guess, in relation to whether or not we could proceed on the basis of making particular recommendations that could be implemented in the shorter term, as well as having the overall root and branch review, which would obviously take some time. So interested in our panellists' views in that regard.
All right, perhaps I could start off by responding. Thank you for your question, Senator. Indeed, I think there are some, for want of a better expression, low-hanging fruit items that can be addressed perhaps almost immediately. The context I have here is that notoriously difficult and complex area of trading trusts. Now, I readily concede that to reform the entire area of trusts is a Herculean task, and a lot of technical and complexity bedevils that whole area. That said, there are some subsets, if you like, or sub-issues that can be addressed, I think, quite readily or easily. So what I have in mind is some of those submissions made by the Australian Law Reform Commission about how having or introducing searchable registers is a good idea. It'll be enormously helpful for stakeholders who use trusts, so that they have better awareness of the entities that they are dealing with, and what are the possible implications. So that would be one example. Creating transparency would be another benefit in doing that. And then there's the prospect of the idea of banning auto ejection of trustees upon insolvency. And that, if implemented, could minimize court applications, multiple court applications, and it could drive down costs. I draw attention to a recent federal court judgment in the Ratner case by Justice Beach, and a reading of that judgment suggests that some law reform here could be possible, and it could be done more quicker than anticipated, where his judgment suggests that a carve-out can exist for the plain vanilla trust. Now, plain, I never knew until then, trust came in different flavors. And excuse the pun, you can trust me on that. I read the judgment. So by plain vanilla, I think another way of describing it is to talk about simple trading trusts. And so this is covering a situation where the company has acted as corporate trustee for one trust only, as opposed to, say, multiple trusts. And in those type of specific scenarios, if the statute automatically invalidates auto-injection clauses, then that should curtail the need for multiple court applications. It could result in cost savings. Now, without that reform, I think as people in the room understand, there's a major cost and time impediment to wind up a corporate trustee. Liquidators have to go to court to appoint a receiver with power of sale, and that is to avoid liability for breach. So I think that is an idea worth exploring.
Yes, so sorry to interrupt, but I think you're essentially making a very persuasive case then that there are areas where we could actually make some reform in the short term that would address a number of issues. And I think Associate Professor Wellard, you had some examples in your submission as well.
That's right, Senator. Mark Wellard here. I agree. I largely endorse what Associate Professor Hargovan has just said, particularly with, as I mentioned in my opening statement, the power liquidators already should have to wind up the single capacity trustee corporation, which is the garden variety scenario in trusts. I'm not going to pretend to come anywhere near Dr. D'Angelo's level of expertise on trusts, but I think there is some low-hanging fruit. And you're right, Senator, in my submission I pointed out some quick fixes and indeed long-standing errors, technical errors in the legislative drafting of the Insolvency Law Reform Act suite of reforms, which, and it is a level of frustration, to be blunt, haven't been fixed, even though in some cases they were communicated to Treasury before the commencement of those reforms in 2017. So I think there are some quick fixes, some low-hanging fruit in the short term. I agree.
Okay, excellent. I've got two other areas of questions, and I'm just keen to make sure I provide other senators with the call. The next area is, and maybe staying with you, Associate Professor Wellard, is this area of director disqualification. I think you've made the case extremely well around instances of insolvent trading and how they can be longer term instances as well, cover months, potentially years. I'm interested in your thoughts that one of the ways in which appropriate action can be taken in this regard is to have automatic disqualification of directors. At the same time, I'm mindful that we need to balance that with firstly a right for the individual director to perhaps put their case as to why something has happened in a bona fide sense. Something's happened outside of their control, or more outside of their control than perhaps other instances where a company has gone into liquidation and creditors haven't received substantial return? And secondly, at what stage would that disqualification apply? So clearly, I would have thought there has to be some flex in terms of a director going into a insolvent situation for the first time, but then if it happens the next time or even the time after that, that's when I think the argument becomes stronger that there should be some disqualification. So interested in your thoughts with respect to the tension between those concepts.
Thank you, Senator. You're absolutely right. We've got to get the balance right. My view, if we were to go down the path of an automatic disqualification consequence for directors, and I hasten to add, what I'm proposing is where there's a minimal return, so say 10 cents in the dollar or less. Indeed, I would agree there has to be a safety valve in there for the director in certain exceptional circumstances to explain or make the case that something out of the ordinary has happened and there shouldn't be that consequence. So I'm all for safety valves in an automatic disqualification process. And I agree that, and indeed what I propose is something along the lines of what we already have in the Act. I mentioned in my opening statement, section it's 206 EAB, and this is a good example of the complexity of our legislation, and 206 GAA, which was put in there to prevent misuse of the FEG scheme. It's two failures, not just one. So I would propose that consequence in the event of a director of two corporate failures yielding less than, say, 10 cents in the dollar.
And if you, just on this point, before I move on to my next area of questions, when we talk about two failures, there can, as you well know, there can be a situation where you've got a group of companies. There might be 2 or 3 companies, 4 or 5 companies in a group, and they all go down at once. Would that be counted as one failure?
That issue is already, as I understand it, I've taken on notice or referred to the provision, that's already crafted into the sections I just mentioned as a carve-out effectively. So the short answer would be no. You would count effectively a group scenario as one failure. And there's legislation currently that achieves that balance.
Okay, thank you.
That's a good point.
If you could just take that on notice and give us just a guide.
My understanding.
I could find it, but I'm sure I could find it far quicker with your assistance.
That was an issue.
My last area of questions in relation to the so-called, and I'll call it so-called, simplified liquidation process, and also the simplified small business restructuring, so-called reforms. It seems to me that these reforms haven't worked in practice, notwithstanding the fact that a lot of concerns had been raised prior to their introduction. So my question is, could these reforms be rehabilitated and made more practical with a number of tweaks, or is that something which should go into the mix of a broader root and branch review of insolvency law? So I put that question up there for all of our witnesses.
Thank you, Senator, for that question.
Professor Hargreaves.
Thank you. Before I answer your immediate question, if you don't mind, I'd just like to make some supplementary remarks on your first question in terms of what can be done immediately. Another example that comes to mind that could fall into that category of low-hanging fruit is in relation to the operation of voluntary administration, in particular the second creditors meeting, where time and time again you see court application being made by the administrator requesting a time extension, and to the best of my knowledge that's almost routinely granted by the court. And so one has to query whether that procedural aspect, which involves obviously lots of resources and costs and time, whether that can be revisited and perhaps have a better system in place where it become more of an administrative matter rather than a court matter. That said, obviously with safeguards built in for creditors who may seek to object, and they could have an opportunity to do so. And perhaps at that time, the court can be invited to adjudicate.
Professor Buchan? Professor Buchan?
Thank you. I've got a couple of suggestions for quick fixes. In relation to what Anil Hargavan has just mentioned, that's absolutely right. However, in relation to franchising it, it would be really good if there was a limit on the amount of time that the extension could be granted for if the administrator was unsuccessful in finding a replacement franchisor who could take on the whole system. Because then the franchisees should be able to be cut loose to pursue their own businesses, which may be completely successful with the no burden of the franchisor. Obviously, the marketing fund should be held in trust, and that could be enacted through the franchising code of conduct, which is pretty easy to amend. It's only a code of conduct. And the franchisees ought to be allowed to have standing in a meeting of the franchisors of the creditors. And the fourth thing that should change is that as soon as an exempt or grandfathered proprietary company becomes a franchisor or master franchisee, it should lose its exempt proprietary company status.
Thanks very much. Ms. Robinson, did you want to say anything?
Do we have time? Because I understand Senator Scott was talking about the small business.
Yes.
Yeah.
Or if you would like, I could address that question by Senator on the small business restructuring. And if I recall your question correctly, it was along the lines of, is there any quick fix that can be applied to that? I think, yes, there are some aspects that are amenable to a quick fix. The one that readily comes to mind would be the eligibility criteria. Currently, it's capped at $1 million. I think there's a case to be made for that to be increased. As to what amount should be increased, you could look, for example, to the US experience, where there's currently 2.7 million, increased to 7.5 million, but that's only temporary until 2024. What's difficult here is there's no fixed definition of what is an SME. I think as the Australian Bureau of Statistics has confirmed. But I think still, notwithstanding that difficulty, I think there is general consensus that the amount can be increased. I only note, to my mind, only one dissenting, if you like, submission on that point, and that's by Arita, that actually called for a much lower amount than $1 million. So perhaps there's a debate to be had there. The other matter that could be revisited, now this is in light of the late-breaking news in terms of ASIC's release of statistics in January 2023 on the operation of this small business restructuring, and it was quite enlightening to see that the majority of the major creditor is the ATO in the majority of cases. Now, if that trend were to continue, then I think there's a case to revisit. Do you really want to put in an external administrator and incur all those expenditures when you're dealing with the ATO for most, if not all of the time? So there's got to be a better way there. And I note that Professor Harris and Michael Murray addressed that in their submission, and they make the suggestion that there could be a good faith commercial arrangement, like a workout reached with the Commissioner of Tax, and that might be more productive. So in a manner of speaking, if you can cut out the middle person, then that'll be desirable.
Thank you very much. Thanks for your questions. Was there a short comment from Ms. Robinson or Professor Willard?
I thought Ms. Robinson should have a...
Yes, thank you, Ms. Robinson.
It's her turn.
Thank you, Chair. Thank you, Senator. Very quickly, I should declare on the record a conflict. I have undertaken funded research for our personal insolvency regulator, AFSA, but the point of declaring that is hopefully that the comments that I make have been informed by someone who understands the limitations and inner workings of a regulatory agency. Just speaking to the recommendation about a single insolvency regime, look, the structural and operational issues are bigger. My quick fix is there any regulatory best practice we can undertake? We've heard during the inquiry witnesses talking about the process, the time with doing just basic offence referrals. And I note that ASIC had made a recommendation about having misconduct thresholds. So just some immediate term things that can give clarity around the role of IPs so that their time and its not incurring costs can be best spent elsewhere.
Thank you. And Mr Wellard for the final comment.
Thank you, Chair. Just a short comment on Senator Scarr's question about small business restructuring and simplified liquidation. I mean, I think there's always open for quick fixes that are going to make a real impact if there's some obvious error, but I just want to make the observation on the whole.
Perhaps not too quick, given your earlier evidence.
I think those two procedures were legislated in an awful rush, and I think it shows. So my instinctive view would be to, I think, park that for a more considered review. But
we did have evidence yesterday that there might be some merit in fusing the two elements and reviewing the amounts that might necessarily trigger engagement.
The concept is great, because the problem with our insolvency regime has often been this one-size-fits-all system that we have. So I think the concept and the approach of having simplified or small business procedures is a good one. I just think it was done in a rush, and perhaps we just need to take our time in getting it right next time.
Thank you very much. I'm going to go to Mr Georgianis for a couple of questions.
Thank you. I think my question's to Ms Catherine Robinson. On page 3 of your submission, you note that the previous suggestions for a single insolvency regulator have been rejected by the previous governments. Are you able to indicate to the committee the reasons for the rejections, and were they correct? Yep.
Thank you very much, Mr Georgianis, for your question. On the record, this is the 4th time it's been considered. So the previous 3 times was the Harmer report, the 2004 PJC and the 2010 Senate inquiry. It's not evidently clear why it's been rejected. In the 2010 inquiry, the Productivity Commission actually recommended that a task force be commissioned to examine this issue, and we've not heard further from it. I should note in that inquiry, both ITSA, as AFSA was then, and ASIC raised some operational issues around it. The merger, so the budget allocation from ASIC, it was ensuring that the new staff of any merged regulatory agency had sufficient expertise. And the third one was the complaints portal, that there would no longer be the liquidators complaints portal, but acknowledging that the new agency could have that. And that's all I really know to the extent of that. Thank you, Mr Georgianis.
The other one I've got on page 2 of your submission, you recommended that ASIC restart its reporting of statistics on regulation of registered liquidators. Are you aware of why ASIC stopped such reports? I think it was 2019, or any impediment, I suppose, to future publication?
Thank you very much for the question. That's a very good question. I believe that the explanation at the time was they're updating how they're producing data and updating the systems, and that information would be released in the future.
That was back in 2019.
Correct.
There's been no release since then.
That's correct.
And my last question on page 3 submission, you mentioned your 2021 research into key insolvency stakeholders' views on harmonisation of the insolvency regimes in Australia. And before I ask you to summarise your main findings, something that feeds into it earlier, you said that we don't actually require legislation to be implemented. It can be done in the short term. If you can elaborate on that, and I think it fits in with this question.
Absolutely. Thank you very much for your questions and your interest in my research. So the 2021 project was basically looking at the role of practitioners and maybe regulating in a way that supports them, so strengths-based. And it's funny, we were talking yesterday about incentives. We're not talking about prizes. It's funny that throughout the duration of the inquiry, we've heard about, what are we trying to achieve here? insolvency practitioners, if we accept that they are the gatekeepers, well, the analogy is if I'm in a car accident, I don't want my surgeon to say, I'm underfunded, everyone has a bad view of me. Your right arm is optional, Ms. Robinson. So that's what it was looking at. It was looking at stakeholder views of the role of practitioners and the barriers. And really what came out of that, Mr. Georganas, was that everyone wants to support practitioners to compliance. What that role is, be it with the consumer groups, ensuring that their clients are aware of the complexity of the process, which feeds into their complaints. So making sure that your complaints have basis, whether that be for the regulators engaging in regulatory best practice, or the profession, a role in better advocating their services and values out to the public. So that's what came out of that everyone is getting behind this idea of supporting practitioners to reach the new ceilings, and that is building their confidence, building their strengths so that they can solve problems. One example of a problem I'll give you that practitioners could solve is the issue of untrustworthy advisors. And we heard in the inquiry yesterday that the best people to know who the untrustworthy advisors are the practitioners. So if we build their strength and we can they can solve that problem collectively, and that reduces regulatory burden on the regulators, and improves that confidence in the profession. That would be the main key points from that. Sorry, what was your second question again?
Thanks.
That's fine.
Oh, that's fine.
Yeah, you put it all together.
Yep.
Could I just ask a couple of questions of Associate Professor Buchan? What proportion of small business insolvencies are franchisees? Do you have that data?
I don't have that data. It's extremely difficult data to find, because there's nothing in the ASIC records that requires a franchisee to state what they are.
So I've got a question, I think, that sort of follows on from that. I'll go to Associate Professor Hargavan for that and then come back to you. So some submitters to this inquiry suggested that ASIC may collect and hold data on corporate insolvency that might assist in the public understanding how current systems are working. In its answer to a question on notice 007 from this committee, ASIC stated it would welcome further information from submitters about the information or data they consider ASIC collects that may assist, and maybe that's some refinement of what is actually asked, Professor Buchan. My question to you, Professor Hargavan, is it sounds like some consultation needs to occur between those who need the data and agencies like ASIC and ASFA who have the data. What organisations do you think are best need to be engaged to discuss a way to facilitate the better collection of data and its accessibility? Who would you recommend?
Thank you, Senator, for your question. Look, undoubtedly, ASIC has a treasure trove of documents that they hold that can be very useful. And I think if we can mine the data from their collection, there's rich and fertile ground there, I think, to have informed policy decisions. I think it can lead to evidence-based and better outcomes.
The evidence would be good.
Accessing it is an issue. There's a price point that presents a stumbling block for say academic researchers, and here I must say there's a very well articulated argument put forward again by Harris and Murray that perhaps we should consider a carve out for researchers or based on public interest, because here's the thing. To have this root and branch inquiry that we all call for, it's got to be grounded, to have sound policy, to have sound outcomes. It's got to be grounded in, the policy has to be grounded.
In reality.
In reality, precisely. Thank you. I was struggling for those words. It's got to be, to the extent possible, evidence-based. I mean, let me take an example. I mean,
I'm sorry, we're not going to have enough time. But if you want to give that to us on notice, that'd be great. I've got a couple of quick questions just to finish with with Professor Buchan. Are insolvencies more or less common for franchisees than other small businesses? Because there's a lot of discussion about, how much of an advantage it is to get a franchise rather than a small business. What are the main differences for franchisees that go through insolvency compared to other small business, in addition to what you've already put on the record in your opening statement? and then I might have to ask another couple on notice.
Senator O'Neill, sorry, I had a coughing fit at your first question.
Oh.
I missed your first question.
Okay, so I've just got a couple. Are insolvencies more or less common for franchisees than other small businesses? What are the main differences for franchisees as they go through insolvencies, if there's anything to add to your opening statement? I think you've indicated in your opening statement an answer to a question I've got here about large franchisors becoming insolvent, but I'll give you a question on notice on that. And finally, can I just add in, if there's a written branch review of Australia, our insolvency laws, as some submitters, and I think this panel have indicated, how should franchising be taken into account? Now, if you want to take those on notice, Professor Buchan, that's fine, because it looks like we've got you at a moment when you're a little indisposed.
Yeah, oh, yes, this was my effort this morning, and they did warn me that it might make me drowsy, so I didn't take it, because I thought I should stay awake, but that means that I have a rotten throat that's causing me to cough like crazy. So, first question I think was about, are the franchisees sort of more likely or to fail than regular small businesses?
Yes.
I guess the problem is they don't see it coming, because if the franchisor has failed or fails to support them, they basically run out of money.
So there's information black holes, and they are not privy to information in a timely way. Okay.
Correct. I'd like to take your other two questions on notice, if I may.
That would be very helpful for the committee too. So I look forward to your response, Professor Buchan. I note that we didn't have a submission from you, but you gave us quite an extensive opening statement. If you have any documentation you'd like to provide us with to fill out your evidence today, the committee would be most welcome of that being sent to us.
Thank you.
Can I thank each of the participants for this morning? And if there is anything in addition that you consider you want to put to us after our questioning today, could I ask you to try and get that to us by March the 23rd? The committee will suspend to go to a very short private meeting. So could I ask participants to leave the room promptly?
Thank you, Chair.
Thank you.
very much.
Submission 74, Professor Rosalind Mason, who co-authored submission 17, and Mr Michael Murray, who co-authored submissions 17 and 18. Good to see you again, Mr Murray.
Thank you.
I understand that information on parliamentary privilege and the protection of witnesses giving advice to Senate committees has been provided to you for that. For the Hansard record, will you please state your names and the capacities in which you appear? We'll start with you, Mr Murray.
Michael Murray is my name from Murray's Legal, in my private capacity as a researcher. Thank you.
Dr Mason.
My name is Rosalind Mason, and I'm appearing in a private capacity.
Thank you. And Professor Taylor.
My name is Lynn Taylor, and I am also appearing in a private capacity.
Thank you very much. Now I'll invite each of you to make a short opening statement, and we might go in reverse order. So we'll start with you, Professor Taylor.
Thank you. Thank you very much for the opportunity to appear and speak to the committee. I am a New Zealand-based academic with a research interest in corporate insolvency law, and I'm here today to offer my perspective on the things that New Zealand does a little bit differently in its corporate insolvency law framework and how they might assist in the development of Australian law. Thank you.
Thank you. Did you want to put any particular items on the record? Professor Taylor?
The committee has my
Submission.
submission, and I'm happy to speak to those.
Thank you. We'll go now to Dr Mason.
Thank you. Thank you for the opportunity to make a submission to this inquiry. I'm an adjunct professor of law at QUT, who during my career specialised in insolvency law, in particular international insolvency and personal insolvency. And you will be aware of the credentials of my colleague, Mr Michael Murray, who has appeared at this inquiry on prior occasions. Our submission of the 29th of November 2022 falls under the Any Other Matters heading of the Terms of Reference. It concerns the extent of enforcement of responsibilities of directors of insolvent companies in comparison with the enforcement of responsibilities of bankrupt individuals. We say there is too much of a disparity between the lesser sanctions imposed on a non-compliant director of a company which goes into liquidation and the greater sanctions imposed on a recalcitrant individual who becomes bankrupt. In either case, the adverse consequences of non-compliance for the insolvency practitioner concerned are the same. Severe limitations in not knowing the extent of the company's or the individual's assets and liabilities, the location of the business or assets, and much other information upon which the insolvency practitioner relies to promptly administer the insolvency. We raise this disparity as a point of principle where we say that the law requires alignment, in particular in relation to micro and small enterprises, which comprise both small companies and sole traders. Insolvency law treats each category quite differently despite the same adverse consequences of non-compliance for the insolvency practitioner and the insolvent estate. We draw attention to the fact that this issue of recalcitrant directors was raised in the explanatory memorandum to the Insolvency Law Reform Act of 2015, with its final determination deferred. It was to be jointly reviewed by Treasury, Attorney Generals, ASIC and AFSA, and we believe that review has not occurred. A corollary to this is that the present disparity is in effect supported by the fact that personal insolvency is handled by the Attorney General's Department and corporate insolvency by Treasury. We consider that personal insolvency should be transferred to Treasury. This issue is a good example of a problem that requires a common approach, something which is difficult to achieve if insolvency is spread across two departments. In conclusion, while the enforcement of responsibilities of directors comes within the terms of reference of this committee, the alignment of those responsibilities with personal insolvency brings in the enforcement of responsibilities of individual debtors. This is more suitable as an issue for any root and branch review of the insolvency system. Thank you.
Thank you very much, Dr. Mason. And Mr. Murray, do you have an opening statement today?
I don't, in the sense that Dr. Mason has spoken on behalf of both of us in that opening statement. Thank you.
Thank you very much. Can I just go to a couple of questions directly to Professor Taylor? Thank you for your submission. Indeed, thank you to all of you for your vital contribution to the considerations of this committee. Professor Taylor, in paragraphs 2.2 to 2.4 of your submission, you identified that the corporate insolvency system is not well suited to SME companies. We've been hearing SMSE companies here, which are the largest users of the system. So does that suggest that the corporate insolvency framework should be separated into two types, one for large companies and another for SME companies that's greatly simplified? And I'm mindful of asking that question in the context of just hearing the need for alignment between the current structures that we're operating with two separate departments and personal insolvency and corporate insolvency separated out. Over to you, Professor Taylor.
Thank you. Yes, I think that proposal has some merit, but the difficulty, as always, is actually fixing on the entry criteria to a specific system for small and medium enterprises. And to the extent who makes that decision, is it the insolvency practitioner who determines whether an enterprise is suitable for some kind of simplified procedure, as is the case with the Australian Simplified Liquidation Procedure, or is it up to the entity or the controller's entities? So I think there are difficulties there. I guess from my perspective, I think there is some merit in having one system that can accommodate and make special provision or simplification for small to medium enterprises. I think that just is simpler overall and more accessible rather than having multiple systems that are difficult for people and particularly owner-operators of small to medium enterprises to navigate.
So if I was trying to consider this analogically with something we might be more familiar with, that, you know, there's a crisis in health, people attend an emergency department and there's a triage process about which path then might follow. Are you giving us something equivalent to that to consider?
No, I don't believe I am, because the difficulties in the insolvency system was who would actually do that triage and who, and I guess my perspective is that most insolvencies are small to medium enterprises, and so there needs to be a system that allows for their wash up, if you like, the liquidation, releasing any assets that are available, putting an end to it. But I'm just not sure that the complexities associated with some kind of triage system are necessarily appropriate.
And that might go to the reality of the unknown nature of much of what's going on with business and the current delays that we're hearing about. Before somebody could make an assessment, they would still have to go through all of that processing.
Yeah, that's it. And I think the reality in both jurisdictions is that use of formal corporate insolvency procedures is undertaken by a minority of companies that are actually coming to the end of their existence. That there are far more company deregistrations in New Zealand than there are, for example, company liquidations. But if there's some monitoring of that process, because I think really what one of the purposes of the insolvency framework ought to be able to do is to identify misconduct, is to identify perhaps repeat offenders and being able to address that, but not to introduce lots and lots of further complexity about how an enterprise is going to be triaged and who within the enterprise is going to make that decision. And yeah, I'm a great believer in simplicity.
Can I go to your submission where you say that from an outsider's perspective, the Australian rules are more complex and are likely to be inaccessible for many SMSE stakeholders without professional assistance? In your view, because you've got that long distance across the ditch to give you perspective, how can we make the Australian rules less complex without removing any important safeguards for creditors? And what can Australia learn from recent reforms in New Zealand to streamline the insolvency framework?
Well, my submission was mainly directed at company liquidations, but New Zealand has had a streamlined process there for coming up 30 years. When I started to look at this issue, because I'm quite interested in the overall efficacy of the New Zealand framework, and it's helpful to have a point of comparison. Of course, Australia is our closest neighbour and operates, and our economies and the makeup of businesses are very similar. But coming to the Australian one, with the various forms of liquidation and the various parts of the Corporations Act that relate to each, and some rules in the Corporations Act that apply to all. From an outsider's perspective, looking at that, I wasn't confident after reading Michael Murray's excellent book on corporate insolvency law in some detail that I actually I actually had it in my head. And whereas in contrast, the New Zealand system, it does recognise that liquidation commences in various ways. So shareholders can resolve to appoint a liquidator, the court can appoint a liquidator, but then the system converges and there's just one system. There's just one set of liquidators' duties. There's one set of rules relating to creditors' powers, and one process that liquidators have to follow. And I think that is far more accessible for people coming to the legislation cold.
That's a very helpful observation for the committee. We've had some debate or some commentary in the last couple of days as we've been undertaking these hearings that the access to signing up as a proprietary limited company is happening at a scale that is extraordinary by comparison to others on a per capita basis, and that there's actually no prerequisites of education or liquidity or skill or understanding of directors' responsibilities that is required before you can set up something, either by yourself or by advice of an accountant or a financial provider. Financial advice provider. Do you have any sort of prerequisites for signing up as a Pty Ltd company in New Zealand?
No, and I believe it's actually easier to incorporate and cheaper to incorporate in New Zealand than it is in Australia. It's only around 120 New Zealand dollars to incorporate, and it's an online process. You can do it without having any advice. But I, again, don't have so much of a problem with that, and we don't have any education or experience requirements for company directors. But I think if you were to try and introduce those, how would you police it? And the difficulty I also have with that is that it then restricts the availability of the corporate form to those who can meet the entry criteria, even if they can be properly policed. And I don't have problems with people using the corporate form to carry on business, even if they fail, because in New Zealand, and I'm not sure to what extent this is true in Australia, but in New Zealand, if you adopt the corporate form, you're subject to some degree of oversight. And if your business fails, or even if your company is deregistered, there's a record of that. On the company's register. Your company may have been removed, or it may have been deregistered, or it may be in liquidation, but that's there for all time. So there's a bit of buyer beware in the sense that people can look at an individual, and it will be easier when we have director identification numbers to be certain that you're looking at the same individual. It's going to be possible to see what kind of failed companies they have been associated with. I think if you make it harder to adopt the corporate form, you're essentially forcing people into undertaking sole traderships or partnerships. And in New Zealand, at least, there isn't the same degree of regulatory oversight. A sole trader may become insolvent, but they may not necessarily be adjudicated bankrupt or enter into a personal insolvency procedure, so there's no record of that. But if you're a director of a company that's gone into liquidation or even been deregistered, there is a record that people can search.
Thank you for those insights. And we're on the cusp of what the hope of director identification numbers might provide in terms of data and some more transparency in the very opaque movement of people through different companies at this point of time, including those who are phoenixing. What do you believe Australia would need to change to implement the New Zealand liquidation scheme for SMSEs, which you discuss in your submission at paragraphs 3.4 and 5.4?
Well, I guess my submission is it time for Australia to consider a streamlined liquidation model for all liquidations, or possibly SME liquidations? So I think there's a problem there about identifying what is an SME liquidation for this purpose and who makes the decision as to whether it enters into this process. But prior to New Zealand adopting its streamlined liquidation system, we had a system that is very similar to your current one. We had lots of different ways of winding a company up, and that was what we inherited from the English model. But in the time that I've been involved in insolvency law research, although there was a significant change with that simplification when it was enacted back in 1993, there's never been any comment or quibble or discussion about how it's deficient in comparison to the procedure that it replaced. So I suspect that if a simplified liquidation scheme was adopted for all companies in Australia, it might take a bit of getting used to, but I think it can accommodate all the intricacies and special requirements of insolvency law, but just in one system that's applicable to all liquidations.
So that harmonising into a single act with a single regulator, being considered by Australia, that is the model that you've got operating in New Zealand, is that correct?
Yes, it is.
And the single or separate, who's the regulator for it? Is it a single regulator, or is there a multiplicity of regulators?
No, well, we've got separate corporate and personal insolvency regimes as you do in Australia. There is one regulator for insolvency law under the Companies Act, which is the Registrar of Companies. We have a separate regulator, the Insolvency and Trustee Service, the official assignee for personal insolvency law.
Okay, so that has been critiqued by some here, saying that the divisions make it more and more complex, and it would be better to have some unification in oversight across both personal and corporate insolvency.
Yes, and I've seen and read those submissions, and it does seem to be a theme in this hearing. There isn't the same discussion in New Zealand, and there's not really been any move to unify personal and corporate insolvency law. I certainly do take the point that Dr. Mason and Mr. Murray have made about perhaps the consequences for a director of a solvent company or a company in liquidation are less than those of an individual who goes bankrupt. But I think there's a lot of data that needs to be gathered to be, I guess, to be certain that that is the right move, and I guess that's an issue with insolvency law generally. One thing that we do have in New Zealand with our personal insolvency law that Australia doesn't have is like a mini bankruptcy. It's called the no asset procedure. And it's available to debtors who have assets of $50,000 or less and or debts of $50,000 or less, no assets and no means of repayment of their debts. They have to apply to enter that procedure, so there's a check on whether they actually meet the entry criteria. But if they do, the procedure lasts 1 year. They're subject to some restrictions on the credit that they can obtain, but at the end of that 1 year, their debts are wiped. So there's not the same 3-year period of bankruptcy as there is in Australia. And in New Zealand, the numbers of people entering that no asset procedure are roughly the same as the number of people who are being adjudicated bankrupt. And so I think it takes out quite a large lump, if you like, of low asset personal insolvents who may be business insolvents or consumer insolvents. But it's I guess it's another streamlined system. It's not so onerous as bankruptcy. So I guess that's a difference to consider, and whether you're looking at unifying personal insolvency law. Does there need to be some amendment of Australian personal insolvency law?
Mm-hmm.
It's also my sense that the numbers of directors of insolvent companies are going to be far more than the people who are actually adjudicated bankrupt. I did some empirical work just on a very small scale some years ago, and there were far more directors of companies in liquidation, but very few of them were adjudicated bankrupt. So I guess I'm not sure of what the connection is between business failure and also having a consequence in terms of becoming subject to a personal insolvency procedure.
Mm. Thank you. I may have some more questions on notice, and I'm sure other colleagues will have questions as well. Just before I move on to one of my colleagues to ask some questions, I might just give Dr. Mason and or Mr. Murray the opportunity to respond with your insights into what we've just heard from Professor Taylor from an Australian contextual point of view.
Just briefly, from my point of view, the notion of simplification, I very much agree with that, and I think that aligns with some of the information coming from the Australian Law Reform Commission in the way in which they're looking at our very complex corporations legislation. Also, the contract, I know that's beyond the remit of this committee, but that would be part of any root and branch review to look at that. On some of the more specific practical matters, I might hand over then to Mr. Murray.
Mr. Murray. I think you might be on mute, Mr. Murray. You might be on mute. Thank you. We can hear you now.
Thank you, Chair. And thank you very much, Professor Taylor, for speaking well of my co-authored textbook. And in that respect, you refer to our liquidation regime in Australia and compare it, I suppose, a little unfavourably with that in New Zealand. I have regard generally to New Zealand law very favourably, and it seems to me that we tend to overcomplicate things in Australia in comparison with New Zealand. And the chapter that you are referring to, Chapter 5 of our Corporations Act, and that's one of the chapters in our book, dates, I think, in its language and its concepts back to the 19th century. And it's one of these areas, Chair, when you are talking to others about what might be called low-hanging fruit, I think a revision of Chapter 5 would be one of my early priorities, irrespective of any root and branch inquiry. But I think what I'm saying is generally that New Zealand, the simplicity of a lot of New Zealand law has much to commend it to this inquiry. Thank you.
Thanks very much indeed. If I could ask you, Mr. Murray, you note that directors and shareholders are treated more sympathetically than individuals subject to insolvency. Could you expand on why that's the case? And is it possibly a significant factor in why SMEs choose or are being directed to choose a company structure rather than operating as a sole trader?
Well, there's a bit of a fine distinction to be made here, of course. When one operates as a company and has shares in that company and is a director of that company, it is the company itself that incurs the liabilities and is responsible for the debt. But we make a separate point that when that company goes into liquidation, there are then responsibilities imposed personally on the director. And we then say, well, there is a need for, obviously, the director to assist the liquidator in providing books and records and statement of assets and liabilities. But that is rather what we might call a reactive obligation, which requires, enforcement by the liquidator or by ASIC. Whereas in bankruptcy, there's a severe and immediate consequence of a bankrupt not having prepared their statement of affairs or provided their books and records. We just raise this as an example generally of how, in respect of the same sort of circumstances where the consequences for the liquidator or the trustee are the same, different consequences follow, one rather more severely in personal insolvency than in corporate insolvency. Also, and I know Professor Taylor, queried the actual extent to which directors do go bankrupt in respect of their failed company. But there are a lot of, as I understand it, personal liabilities assumed by directors in respect of their corporate business operations, even though the company itself might have its separate liabilities. But nevertheless, that really highlights that if the director is bankrupt, there's one set of obligations in respect of the liquidator, and there's another set of obligations which are quite different in respect of the trustee. As a matter of principle, we see that as requiring attention, but as being an example, I think, of many other such inconsistencies between corporate and personal insolvency, which we say should be remedied in any root and branch review.
And may I just...
Dr. Mason.
Yes, thank you. Perhaps going back to the reason why is it perhaps different. I think that goes back to the origins of the law, and that the bankruptcy law has been around since the 1200s and began with worrying about absconding individuals, whereas our corporate insolvency provisions were introduced through the Corporations Act, which came about in the late, in the 1800s, and for different reasons. And that just underpins for me the importance of looking at insolvency as a whole, and not perhaps some of this just having arisen out of historical circumstance, for us to look at for Australia to look at a more policy-driven and more data-driven, thought-through approach to looking at this aspect of the cycle of business, and for individuals who are, given that we are very much reliant on a credit economy.
I asked some questions of Professor Buchan about the rate of failure of franchisee or franchisor business structures as opposed to otherwise established small businesses, whether they were director-controlled or sole businesses, sole traders or partnerships. She pointed out that the information was unavailable, and then I asked further questions about information. So I want to put the same question to you, because a number of submitters have said that ASIC may collect and hold a lot of data on corporate insolvency that could inform policy making that is evidence-based and critically important to reveal the reality for any type of review, whether that's root and branch or a more hasty, let's not call it hasty, a more timely but carefully considered review of Chapter 5 of the Corporations Act as advised by you, Mr Murray. So who needs to be consulted to create a framework of data collection and revelation that would give us what we need and get it to the people who are needed? Who needs to be on that kind of a consultation panel? Would you be able to name some entities? We'll start with you, Mr Murray.
Well, certainly the regulators in terms of their collection of a lot of information. But I've also said rather bluntly that the professional bodies, in other words, the practitioners themselves, hold a lot of the core data as to how the insolvency system works. And if the professional bodies could be enlisted to take part in that data collection, that would be very valuable. I think we're on the cusp of much better data collection when we have the director identity number. I think that will provide a lot of transparency in respect of, as I think Professor Taylor was referring to, in respect of the individuals behind companies. And I'm not saying that in any sort of threatening way, but I think it's just a matter of necessary transparency that we should be able to track through who has been responsible for good companies and bad by way of a director identity number. And we heard yesterday about registering trusts, for example. Whether we could go further and register franchises or franchise agreements, that's another step again. But I've got great faith. I hope it's not misplaced in terms of artificial intelligence and information technology, which the government seems to be gearing up for. And I can see a lot of that information being available, if not in the immediate future, certainly within the next 5 years or so.
Thank you. Thank you very much. Dr. Mason?
Just briefly also, I think going back to why do sometimes people form companies, it may well be that in business, sometimes the tax regime has an influence on business obviously on business decisions, and whether or not any other government, in addition to the regulators, but whether there is other government departments where the information is collected about business that is able to be made available, but not just at the federal level, but also at state, because there are certain entities that are regulated in industries at state level, and there would be state regulatory bodies or government bodies perhaps that might have information which just sits around business. Business is complex, and we talk about companies and individuals, but within that there are many different permutations and combinations. And so I suppose looking broadly at that, just in addition to what's been mentioned.
Thank you. Professor Taylor, yes, you've been listening to this discussion. What views have you got at this point?
Well, I would just offer a plug to coordinate with the New Zealand Registrar of Companies, the New Zealand regulator. Since 2021, New Zealand liquidators have been required to file quite detailed 6-monthly and final reports about their remuneration, about returns to creditors. And I think it would be absolutely fascinating to be able to do a comparison as to whether ultimately returns to creditors are better in New Zealand's light regulatory system, or whether in fact Australia's far more onerous regulatory system is the winner.
So, Professor Taylor, I'm sure that you're aware of that, but creditors in the economy in Australia are seeing 1 in 14 businesses currently filing for insolvency, compared to 13 out of 14 just letting the business be deregistered. 92% of unsecured creditors getting 0% return in the event of collapse. It doesn't appear to be functioning or fair. What are the comparable statistics for New Zealand?
We don't have any. As far as I'm aware, I think Australia is actually better served in the information, the data that's released on a regular basis by ASIC than we are in New Zealand. As I said, that new information has been collected in New Zealand. I believe it's just sitting in the company's office. I don't think anything has happened with it, but to be fair, it is data that's tainted by the COVID pandemic. It's hard to know whether it's actually going to be a reflection of what is going to happen on an ongoing basis. But I still think there's a basis for useful comparison, given the differences in the systems, as to which one actually benefits creditors. And as with the director identification numbers in company liquidations, at least, being able to monitor company abandonments and seeing who's associated with those, and whether that's a matter in which the regulator can take action in terms of disqualifications or prohibitions.
Thank you very much. I may well have more questions on notice, but I'm going to go to Senator Scarr for the next line of questioning.
Thank you, Chair, and thank you to all the witnesses. My first question was actually to Professor Taylor, just in relation to the New Zealand scheme, and I was interested to see that New Zealand doesn't have the equivalent of a FEG in relation to employee claims, which I guess surprised me to some extent. Could you just give some insight into the position of employees under the New Zealand law and whether or not New Zealand is looking to move towards a FEG equivalent?
Well, I don't believe there's any move for New Zealand to move to a FEG equivalent. It's one of the differences or great differences between New Zealand and Australia in the treatment of employees. Employees of insolvent companies do have priority status. They are a preferential creditor, but only up to around 25,000 New Zealand dollars, and that covers everything: unpaid wages, redundancy payments, and the like. So when you look at the situation in Australia where employees have unlimited priority, I guess I see that as more of an incentive for them to band together and possibly take enforcement action. And also they've got the benefit of FEG, and we just don't have anything like that. There was a move, goodness, several decades ago now to essentially, well, not break the unions, but move towards the individual employment contracts as opposed to union-led collective agreements. It's moving back towards that system, I guess, now more with the current Labor government, but it's just one of the big differences between the two jurisdictions.
Okay. And this question's for all the witnesses, and I think just from the commentary you've provided, testimony the witnesses have provided, is it correct to say that whilst there is a very, very strong case, I think, for a root and branch review of all of our insolvency laws in Australia, including personal insolvency laws and corporate insolvency laws, there's also another category of reform that could be introduced in a shorter term to address some issues and make the current system we have work better. Is that a fair proposition?
Yes. From my point of view, yes, there's the short term and there's the long term, because for a root and branch review and to look at the ecosystem and not purely looking to say lawyers and accountants only to get the information in, that's the long term. But there are things that could be addressed sooner, but I defer to the submissions of others who've come before you with more detail on that. Other than our recommendation about, at least in the short term, having the policy within the one government department.
And just in relation to that one government department issue, which I noted you raised in your testimony earlier, why should it be Treasury, not the Attorney General Department, or is it just needs to be one or the other? I'm just interested in your view as to where it should sit.
I could speak, maybe Mr Murray would have something to add. I would see it would be Treasury. This is very much linked to the fact that we have a credit. Credit is so important within our economy, and it's not necessarily looking to whether it's a person or whether it is a company. And yeah, so as far as the department is concerned, that's where I would see that.
Yes, I would agree with that. Professor Mason referred earlier to the history of bankruptcy, which is started off with an emphasis on its criminality. That has long since disappeared. And I think that it belongs more in an economics-focused agency rather than where it presently sits within Attorney General. And I certainly think both corporate and personal need to be considered together in the one agency.
Okay, thank you. I'd like to move on to the issue of the unfair preferences regime, and this committee has received evidence from a lot of stakeholders, including from subcontractors in the construction industry, with respect to how the unfair preferences regime is operating in practice. And some of the suggestions that have been provided to this committee include, with respect to the caps that apply before so-called unfair preferences can be clawed back, the time period which should be in which unfair preferences can be called back unless there are extenuating circumstances. Perhaps that should be decreased to 12 months. And thirdly, the knowledge that a creditor should have to have the level of knowledge with respect to the situation of the debtor, in particular the question whether or not the reasonable suspicion of insolvency should be lifted to actual knowledge of insolvency. And I think the fourth point I'd note is the phenomenon of so-called mothership proceedings, and I understand the logic behind those from a liquidator perspective, but the concern that this picks up so many smaller creditors in one large mothership legal proceedings. So we've heard just to give a bit more context to the discussion, we've heard very strong testimony from those representing smaller businesses that the current regime imposes pressures on smaller businesses who maybe have done a diligent job in terms of getting their debts in, but then find they're being chased sometimes years after the event to disgorge those monies from intimidating court proceedings. So very interested in terms of the witnesses' perspectives in relation to that issue, and whether or not there are any reforms that can be made in the short term or should be considered in the short term, or whether the whole issue should be left to a root and branch review. Thank you.
That's a very broad question, Senator, and if I give a brief answer, and I'm happy to take more on notice. The concept of preferences is sort of one that is, in theory, fundamental to insolvency law, that some creditors have received their payment in advance of others or in priority to others, and they should pay that back so that all can share in the assets of the company or the individual. One point I make about preferences is the cost of bringing them, in the sense that matters that have to be proved, to which you've referred, and then ultimately how that cost bears up in terms of what might be recovered. I have asked at times, for example, in respect of preferences, for data on what money actually goes back to creditors if there is a successful recovery. And I won't say a suspicion, but I consider that there may be many cases where preferences are being used in order to recoup unmet remuneration of the liquidator. Now, the courts endorse that in certain circumstances, and I'm not saying that's a wrong practice, but if that is the case, it then goes against the whole idea of what a preference is about, to share, for all creditors to share equally in the proceeds. When I looked at this in detail some little while ago and saw the need for the practitioner to prove so many items of that were in existence, for example, the state of solvency of the company, etc., and the defences that were available, I came to an initial view that maybe they should be strict liability if we want to do it that way. And that was something that a colleague of mine, Professor Andrew Key in the UK, suggested years ago for the same reason, that there should be simply a repayment within a certain period of time of any monies that have already been paid out by the company to its creditors. That might seem very unfair, but as is often said about insolvency, it's expedient, and it would limit the time and cost, sometimes very unproductively spent by the liquidator or the trustee and the creditor in arguing about fine points that are required to be proved. I think I take up your final point there, which was, I think that really is, as a matter of principle and detail, a matter for any root and branch review.
Okay, just on that, the proposition of a strict liability, and I think I'm tending towards your view that it is perhaps more better put within a root and branch review context. But the issue of strict liability, we've heard evidence from contractors, in particular subcontractors in the construction industry, that they're out of pocket for all sorts of inputs into a construction project. They might be dedicating a lot of their time and resources to a single project. It's not feasible for them to use mechanisms such as the PPSA with respect to taking security over inputs which become part of a larger construction project. And the clawing back of a preference can actually have devastating impacts on their own business. So they're proceeding on the basis that the cash they have in is the cash that they can continue to use to provide cash flows for their business. So do you recognise that a strict liability approach could potentially have drastic consequences on particular classes of creditors in some situations?
I recognise that, and insolvency law involves much balancing of many interests, and often with unsatisfactory outcomes all round. But it's a factor of dealing with limited assets and a greater number of debts that are owed. The alternative, Senator, is to do away with preferences altogether, which is also another law reform proposal I've read of in the past. Maybe for the reasons you're mentioning, or maybe for the reasons I mentioned, that the cost of bringing them is prohibitive or is fundamentally unfair. Now, as I said, you'd have to overcome that fundamental policy reason in insolvency that everyone should share equally and no one should jump the queue. But again, you know, that has to be balanced against the sort of, what you might say, injustice that you're describing in that sort of situation you mentioned.
Well, you're left to ponder whether or not the theoretical perfection, when it hits reality, it can produce some very hard consequences. I'm interested in other witnesses' views with respect to whether or not the issue of unfair preferences, the whole regime should really be part of the root and branch review, as opposed to any reforms being implemented without having done that root and branch review, please.
Professor Taylor, do you have a view?
I'm not aware of the intricacies of the practical operation of the Australian avoidable preferences regime, but I don't think that New Zealand can offer any lessons here. It's been a problematic area. There have been three significant changes, or three significant sets of rules in relation to avoidable preferences enforced in New Zealand in the last 30 years. What we currently have now is pretty much an adoption of the Australian rules. We haven't had any kind of insolvency review where there has been the submissions bringing forward the actual experiences of people who are having to deal with them. But picking up on what Mr. Murray said, I guess it's one of the difficulties for insolvency practitioners if they're looking to recover something in order to be paid for all of the work that they do. Often the avoidable preferences are a more attractive option because enforcement action against company insiders is so difficult, and you've got to have a viable defendant, and often that's not the case, and often there's no money in the liquidation to bring complex proceedings, whereas the rules with respect to offsetting or upsetting avoidable preference are much easier to employ. So if that's an issue in terms of the balancing of what's actually happening in insolvencies, then yes, it would be appropriate as part of a root and branch review.
And Dr. Mason.
Just briefly, I think preferences highlights the policy question about contractual certainty, and to what extent does law undo other areas of law by looking backwards and undoing some transactions that have otherwise people have got commercial expectations about. Hence my looking more to it as a root and branch review on the basis that that does not take as long as the Harmer report from commencement to implementation would have taken.
Thank you.
And just on that point, how long did the Harmer report process take in terms of a process and then implementation? And I should say we've received some testimony that some of the recommendations in Harmer, particularly with respect to trusts, haven't been implemented at all, and that's an area which needs to be looked at. But how long did that process take, and how long do the witnesses envisage that a Harmer 2.0 process would take in the current context, especially if it were to look at both personal insolvency and corporate insolvency.
I'm not quite sure how long it took. My memory is something like 5 years, but I do remember hearing Ron Harmer talk about 1993 and the big changes that came through there with the discussions with the tax office, etc., and with voluntary administration coming in. So it would be at least 5 years for some of the most significant reforms, as far as I'm aware, but Mr Murray would may be able to help you in more detail.
I have the Harmer report here, but I'd be happy to take that query on notice if you like and find out when it was first commissioned and when the report was handed down, and then following that, when the laws were introduced.
I think, well, I'd be very pleased for you to take that on notice if you could, because we have heard in the context of the Whittaker Review done in relation to the PPSA that review was completed in 2015 or 16, and there's a lot of helpful recommendations in that review which haven't been implemented, and we're sitting here at 2023. So I tend to think if a root and branch review is undertaken, there needs to be a really considered timetable in terms of implementing any recommendations from that review that are adopted by the government of the day. So I'd find that timetable to be very useful as the committee forms its views. So if you could take that on notice, and if any of the other witnesses have views with respect to timing and process of any root and branch review, happy for them to take that on notice as well. Thank you, Chair. That's all my questions.
Thank you very much, Senator Scarr. And I'll go now to Mr Georgianis for some questions.
Thank you, Chair. And being aware of the time, I'll be, I've got a series of questions, but I'll be quite direct with them. My first question is, how do you feel we should deal with the assetless liquidations, and should that public service work be undertaken by a public liquidator?
Mr Murray?
If I may just initially say that that's been part of my submission with Professor Harris, that there should be a government liquidator to at least monitor the deregistered companies that occur in large volume.
Dr Mason?
My comment is probably still based in looking at personal and corporate together, and what can the ASIC processes currently in place with your corporate regulator learn from what the personal regulator already does. I don't have a specific view on it because obviously funding is an issue, but there have been suggestions put forward as to how that might happen.
And Professor Taylor, I know in your earlier evidence you talked about the no asset procedure, and you had an arbitrary $50,000 New Zealand, which I think you argued took a lot of the participants out of the formal structures of insolvency.
For personal insolvency, it's an alternative to bankruptcy. And in New Zealand, it is a public official, the official assignee, that administers all personal insolvency. But the official assignee also is able to act as a liquidator of last resort when no private liquidator is prepared to act because it's assetless, but only in the case of court-appointed liquidators.
But it does cross over into the corporate liquidation space.
Yes. So they have that small role, but they, in fact, historically they've undertaken very few liquidations, but you're probably aware that New Zealand has adopted finally a robust regulatory system for insolvency practitioners. But prior to that, based on my own work, around 25% of company liquidations were actually administered by non-qualified individuals. We didn't have any qualifications or experience required to be a company liquidator. And so what I'm wondering now, and it's murky because of the effect of the COVID-19 pandemic, but whether the professional insolvency profession that we now have in terms of administering corporate insolvency procedures is actually able to properly service the small to medium enterprise market, given the exit of these unqualified individuals who were undertaking quite a few of those liquidations.
So you may have a workforce issue. Do you have any reflections on that evidence, Mr Murray?
Yes, I have to defer obviously to Professor Taylor's knowledge of the New Zealand system, and this is a matter of history, that both England and New Zealand adopted official receivers in both in bankruptcy and in corporate insolvency from the early days of last century. And it's a historical quirk that Australia has not had an official receiver in corporate insolvency. And it seems to me that a role of the official assignee in New Zealand would be to oversight the large number of deregistered companies that seem to occur there as they do here.
Thank you, Mr. Murray.
Currently,
Yep. Professor Taylor?
currently that's the purview of the company law regulator, the registrar of companies.
Right, thank you.
Thank you. Back to you, Mr. Georgianis.
Thank you. Thanks. Just something came up earlier. How do you think corporate trusts be regulated? And we've spoken about a lot of that, but also in that, how would you, how should franchisees be regulated as well? Do you have any opinion on that?
I myself don't, if I may say. It's not my area, but I do acknowledge and support the idea of the registration of trusts. And as I said earlier, maybe there's a way of registering other bodies under ASIC law that would assist in business transparency, like franchisees.
Would anyone else have any opinion on the franchisees? No.
No.
I suppose just to gauge your opinion of the small business restructuring reform and what your opinion is. I know we've spoken a bit about it, but how would you, I suppose, restructure the small businesses from the big businesses? And we heard that New Zealand has a way of doing that by having a cap on the turnover or what they're worth. You spoke earlier, Professor Taylor, about some figures.
That relates to personal insolvency and the mini bankruptcy procedure. But yes. What we don't have in New Zealand is anything like the small business restructuring scheme that Australia has recently adopted. And I think that is problematic because voluntary administration isn't often practicable for small to medium enterprises. We do have I guess a company control mechanism known as a compromise that a company or company's directors can put up, and if a majority of creditors in number and 75% in value agree to it, it can be crammed down and it can bind all creditors, but it's not frequently utilised. But I guess I keep coming back to the fact that the very nature of the owner-operators of many small to medium enterprise companies is such that to be for a small business restructuring procedure to be effective, they need to know about it and they need to know the entry criteria and they need to act before time is lost, and that just seems to be a problem. And I'm not quite sure what the way around that is.
Thank you. Thanks.
Thank you. Could I just go to your submission, Mr. Murray? You talk about how the new procedure in point 5.3b involves three phases. The restructuring phase, the acceptance phase, and the planning implementation phase. We've had some evidence to suggest that there should be a separation in the insolvency space between those who are dedicated to the task of restructuring and those who are dedicated to the phase of the insolvency in practice. It's quite appealing to me, given the level of mistrust that there is about the sector, that it might give some freshness to people who did want to push past the stigma of my business is failing to say, I need to remodel my business and I can get some assistance. What are your views about the technical and sociological elements of that proposal?
If I may say, that's a very big question and an interesting one, and I can only give a broad answer. In fact, I've mainly heard about that through this inquiry, that suggestion has been made. I myself would be reluctant to split up professional advice between one group and another. I think for the sake of independence is one reason it might be suggested. I'd really have to give some thought to that on notice, if I may.
Absolutely. I'd be very happy to receive that from you on notice. Anything from either you, Professor Taylor, or Dr. Mason? Head shaking. Okay. So could I go then to the acceptance phase? This morning we heard evidence from the ACTU in response to questions. I'm trying to remember if I asked them or somebody else asked them about the right for unions to actually represent workers at meetings. What's your view about at accreditors' meetings? Was that you, Mr. Georgianis? I thought it was. Okay. So the acceptance phase, that's where that would really kick in. What's your view about that ACTU proposition, Mr. Murray?
That unions be entitled to represent workers?
Yes.
Look, I'm sorry, I did hear that suggestion today. And I do know the low rate of union membership in Australia. I think that would be a rather contentious issue. Nevertheless, employees might be better placed in having a representative at a meeting rather than attending en masse. Again, if I might take that on notice, it's not something I'd considered before in my researches.
So we'll make sure we get you the relevant question and the response from the ACTU. I guess there is always, in these matters, the contested or the capacity where a power differential exists and a knowledge deficit exists for who might be the best person to be in the room. We don't have everybody show up without a lawyer at courts. Showing up to participate in the acceptance phase of a process that's been defined by 5.3b of the law is not something that many workers in these businesses would have much familiarity with. And that is the work of unions, is to represent workers and collectively give them the capacity to have knowledge and participate. So I just offer you that sort of frame of the way in which we receive the information. We've discussed a little the relationship between corporate and personal insolvency. Do you have any insights you can offer the committee about what you've seen of the lack of harmony between those two systems that manifests in ways that are very problematic for the Australian population?
Is this for myself? Thank you.
Yes, yes.
Yeah. They've each developed in their own separate way, each Act of Parliament, and they're drafted quite differently. When we've talked earlier about low-hanging fruit in respect of corporate insolvency, there are many processes in personal insolvency that have been adopted over the years that are quite beneficial. In other words, for example, there's what are called, and I'll just read the numbers, 139 ZQ notices that allow a demand to be made short of litigation being pursued by the trustee. And there are other mechanisms, for example, in respect of examinations, that are a lot more accessible and less costly in personal insolvency. So what I'm saying is there's a two-track system out there that means that, for one thing, there's inconsistency, which doesn't lead to efficiency, and one is lagging behind the other, in my view. Also, in corporate insolvency, for whatever reason, the permission of the court is required in many cases, and Dr. D'Angelo yesterday referred to the need to get court approval in many respects of the law of trusts. Well, that's not the end of it. There are other permissions that liquidators need to get in corporate insolvency that are not needed in personal insolvency. So my broad answer is there are two systems there, one arguably more efficient than the other, and that in itself is disadvantageous.
So in summary, what's your view of the capacity for us as legislators to fuse the insolvency frameworks of corporate and personal insolvency. Wise move and easy to achieve, or unwise move and way too complex to consider as possible in any sort of reasonable time frame?
Well, Dr. Mason might like to add to this, but we prepared a paper some little while ago where we concluded that it wasn't satisfactory to have a separate Bankruptcy Act under AFSA and Attorney Generals and a separate Corporations Act under ASIC and Treasury, but that we acknowledged the legal difficulties of unwinding 100 years of not having a joint system. And what we suggested was, which we would have thought is a fairly readily achievable aim, is to simply transfer the bankruptcy policy from Attorney Generals to Treasury. Now, the benefit of that is, at least, even if the law isn't changed, there's then, within the one department, sort of joint consideration of both personal and corporate insolvency, which we call it soft law, in the sense that we're not looking at legislative change for the moment, but at least to get the two in the one department would be an achievement.
Dr. Mason, did you want to add anything there?
Yes. Yes, I think going back to this lack of harmony for the Australian population and coming to this as well, is that the complexity of having the fact that there is an issue around insolvency having to be thought of from so many different perspectives causes, I think, an issue for the general population. They're not necessarily understanding perhaps the full legalities of having established a company, etc. But really what the issue is, they're worrying about going concern and being insolvent, and to have the complexity of a system that has different laws and either a trustee or a liquidator appointed, to the extent to which that can be brought together. And there are essential similarities about gathering an estate, gathering the information, realising an estate if there is one, and then the distribution. There are things that are in common. And to have advice being given to debtors which doesn't have the complexities that currently exist because of two different systems, I think would be of assistance to the Australian population.
Thank you. Can I refer to submission 18, Professor Harris and Mr. Murray's piece, the 2021 Australian Journal of Corporate Law article. I'm not quite sure. Page 184, it's indicated here that the former Treasurer has promised that this will be, and I'm quoting now, a single, simpler, faster, more cost-effective insolvency process for small business, and a move to a more flexible debtor in possession model, enabling small business owners to remain in control while providing them with an opportunity to restructure. You critique that at page 186 of the article, and you say, arguably the new procedure is not sufficiently simple or streamlined as suggested by the explanatory material. This means it will be costly for companies, risky for practitioners, and potentially unrewarding for creditors to be involved. Could I ask, given it's 2023 now, for your opinion of the small business restructuring reform, your opinion of the simplified liquidation reforms, and anything you wish to add to what's on the record already in that journal article? Start with you, Mr. Murray.
That journal article, I beg your pardon, I did not hear the authors of it.
Harris and Murray. Submission 18, I think it's come to us as submission 18.
Oh yes, it's part of our submission.
Yes.
Look, I don't think we would have anything further to add to what we've said in the submission, and also in response to the answers to questions on notice. One thing I might add, and it comes back to something that Dr. Mason and I raised earlier, this is talking about small business restructuring. That assumes that the business is a company, and it assumes that it's a company and that the directors have no personal liabilities. But the personal liabilities that can occur, and often occur in respect of a small business, are not touched by the small business restructuring. And that's typical of corporate insolvency law. It just does not seek to meet or address any personal liabilities that might arise as well. So to my mind, it's a little one-sided, and in the sense that it leaves hanging any personal liabilities that might occur arising out of that small business restructure.
You also make an observation about the new Part 5.3b aimed at simply presenting a restructuring plan to creditors rather than formulating a sustainable restructuring plan that's in the best interest of creditors. You say that it's not going to engender confidence within the creditor body. You indicate that it's not supported by the number and complexity of provisions being inserted into the legislation. We've heard some evidence this morning about the haste with which these new reforms were implemented. Is your assessment in this journal article of the Australian Journal of Corporate Law a reflection of a failure of good government, and what should we learn from that as we undertake a forward movement to better outcomes for creditors, both secured and unsecured?
Well, you use the word good government, and I'll respond carefully, but as I recall, and I think we say this in our submissions at maybe another point, that small business restructuring was introduced with a very, very limited time period for consultation. As I recall, sometime in October 2020, and it was introduced from the beginning of 2021. Although we'd like to see laws consulted upon and introduced with some expedition, I think the general consensus is that it required far more time to be considered. And I just mentioned, just by way of contrast, that was pushed through very quickly, but small business reforms in personal insolvency were first mooted, I think, in 2020 or thereabouts, and nothing has ever progressed in respect of those. Although I do mention that I am attending the Attorney General's roundtable tomorrow in respect of personal insolvency reform.
Thank you. We are at a very interesting juncture with regard to insolvency, both corporate and personal. I want to thank you all for your participation in the committee's inquiry. I invite you to provide any further information that you think may be of use to the committee in its considerations as we move to hopefully delivering a report in the not too distant future. If there are questions on notice, you'll be advised by the Secretariat, and responses to those questions, if possible, if they could be provided by the 23rd of March, that would be most helpful for the committee. Good luck with, keeping the New Zealanders in good shape over there, Professor Taylor. Thank you for the comparative insights. The more we look around the world, the better it helps us, I think, move forward together in the right direction more quickly, certainly in the democratic nations where we share values and principles and acceptance for the rule of law. Once again, thank you, and the committee will now move to our next witnesses. We'll suspend briefly. Thank you.
Thank you.
Thank you.
Of the Australian Securities and Investment Commission and the Australian Taxation Office. I understand that information on parliamentary privilege and the protection of witnesses giving evidence to Senate committees has been provided to you. For the Hansard record, could you please state your names and the capacity in which you appear today? We might start with you, Mr Yanko.
Greg Yanko, Executive Director, Markets, ASIC.
Thea Essany, Senior Executive Leader, Registered Liquidators and Financial Reporting and Audit, ASIC.
Warren Day, Chief Operating Officer at ASIC.
Gary Busby, Senior Insolvency Advisor, Lodge and Pay, Australian Taxation Office.
Gillian Kitto, Assistant Commissioner, Lodge and Pay, ATO.
George Montanez, Assistant Commissioner, Phoenix Program, ATO.
Thank you very much. I now invite you to make the short opening statements. Thank you for providing hard copies for the committee, but I'll let you put it on the record because I know there's a lot of interest and people are listening. So, Mr Busby, are you, or Ms Kitto? Thank you, Ms Kitto. I was trying to read the body language to see who's ready to jump, but I missed it. So, Ms Kitto, thank you for the ATO.
Thank you, Senator. I'd like to firstly thank the committee for inviting the ATO back to the inquiry for a second time. I would like to just talk briefly about the ATO's post-COVID approach to debt recovery. A key consideration for all ATO actions is to protect the integrity of the tax and super systems. We want to help those who genuinely need it, whilst addressing the unfair financial advantage gained by those who don't comply and don't engage. We recognise the critical role small businesses play in the economy. As a major employer and contributor to the tax and super systems, we also understand that the nature of small business leaves them particularly vulnerable to external shocks, which we have witnessed over the last 4 years, beginning with the bushfires in 2019 and continuing throughout COVID-19. Our focus throughout this time was and continues to be providing support and assistance. We saw significant out-of-pattern growth in collectible debt throughout the years of the pandemic, and whilst it has continued to increase, the rate of growth has slowed, and we are seeing positive signs of recovery. Currently, 90% of tax liabilities are paid on time and in full, and almost 95% is paid within 90 days. Nearly 50% of all collectible debt, though, is over 12 months old, and 30% is over 2 years old. Our experience shows that the longer a debt is left unaddressed, the more the debt continues to grow and may ultimately become unmanageable. Conversely, the earlier a debt is addressed, the more likely the business is to get back on track. And this is why our overarching message is always to engage with us as early as possible. To encourage engagement, we send SMS reminders, letters and attempt phone contact with all clients who owe a tax debt. We undertake millions of these activities every year to offer businesses our help and assistance. We recommenced debt recovery actions over a year ago now, but it is important to note that the support we provide to businesses who are struggling has not stopped. Our first step is always to engage with our clients to help them get back on track. Our approach to debt recovery and insolvency is measured and cautious. However, for the small percentage who do not engage or respond despite our efforts, we may take firmer actions, such as garnishees or director penalty notices. And we recognise that these actions can have the serious effect of underlining for a business the reality of their financial situation. If payment still remains outstanding, even after these additional firmer action steps, then it may be that the business is actually insolvent. It is important to note that the state of insolvency arises when a company or person cannot pay their debts when they fall due. An unmanaged tax debt is often a symptom of insolvency rather than the cause. It is only after attempts to engage have failed that we may consider taking wind-up action, noting that when we do not do so lightly. We reserve these actions for businesses who refuse to engage, who present a real and significant risk, credit risk, to others, or who exhibit high-risk behaviours such as fraud or illegal phoenixing. In closing, I would like to emphasise that it is never too late to engage with us, noting that the earlier businesses do so, the more likely it is that they'll be able to get back on track and stay on track. Thank you.
And Mr Day, I understand you're going to...
I do, Chair, and in the interest of time I will try and truncate what we've provided up
Thank you.
to the committee.
Thank you.
We would like to comment on two issues raised by witnesses at on the previous hearings last year, but also inform the committee about the publication in January of an updated series of insolvency statistics and a report that we've also released on the small business restructuring regime.
I think that's interacted with some of the submissions we've had who declared that there was not data that has now been released and has been referred to this morning.
Correct.
Okay, thank you.
First, regarding the issues from the December public hearings, in relation to the matter of the gender gap, we note that witnesses to the inquiry indicated that low representation of women at senior levels in insolvency and restructuring firms, with only about 9% of registered liquidators being women, does not reflect society or the significant role women fulfil in other areas of the business endeavour. One reason cited for this was the need to demonstrate at least 4,000 hours of insolvency experience within the 5 years prior to making the application to become a registered liquidator. We acknowledge this requirement can be challenging for applicants who have or anticipate having parental leave or other carers duties, and it was suggested that this acted as a barrier to suitable female applicants from applying for registration. We would state that more can be done, and ASIC is doing more to promote diversity in the role of women in the insolvency and restructuring profession. We do note that from 1 January 2021, amendments to the registration requirements provide members of the liquidator registration committees greater scope when considering what work experience is relevant and will be considered when deciding if an applicant has the required relevant work experience to be a registered liquidator. We do continue to engage with registered liquidators, encouraging them to sponsor their senior female staff, who are great candidates for registration as a liquidator, to lodge an application for registration. We do note that some successful applicants, both male and female, that applied following the 2021 amendments did not have 4,000 hours experience directly related to formal external administration and controller appointments during the previous 5 years, but in fact were otherwise suitable applicants for registration, and the committee's decided they should be registered as a liquidator. The second point we want to raise from the December public hearings is in regards to the simplified liquidation process. We understand witnesses generally support the underlying policy objective of the simplified liquidation process that commenced on 1 January 2021, but noted the very low uptake of this reform. Some reasons cited for this were that the process is not simple enough, it does not reduce cost, the timeframes to adopt the simplified liquidation process are tight, and the eligibility criteria limit its application to many small businesses. We do note that the decision to adopt the simplified liquidation process is made by the registered liquidator, not the directors, after they have been appointed as liquidator of the company in a creditor's voluntary winding up. Consideration might be given to the directors electing whether the appointment should commence using the simplified liquidation process with the appointed liquidator, then converting it to a full liquidation if the director's judgment that the company satisfies the eligibility criteria for simplified liquidation is incorrect. We also wanted to let the committee know that since our appearance before this committee in December, we've released our latest insolvency statistics and a report on small business restructuring. On the 13th of January this year, we released on our website Excel workbooks covering the 3-year period 19 to 20, 20 to 21 and 21 to 22, updating existing published statistical series data. The workbooks profile corporate insolvency in Australia from initial reports lodged by external administrators and receivers from March 2020, which is Form EX01 up to the 27th of March 2020, which then became the initial statutory report, or ISR, from the 28th of March 2020. The statistical series provides information to the market about such things as the industries in which companies operated, the size of the company assets and liabilities, including amounts owed for unpaid employee entitlements and unpaid taxes, the reasons for failure and the nature of any alleged misconduct. In regards to the small business restructuring report, on the 17th of January this year, we published report 756 entitled Review of Small Business Restructuring Process. The report outlines the findings from ASIC's review of lodgements data for all 82 small business restructuring practitioner appointments, which commenced in the period from 1 January 21 to 30 June 2022, and the outcomes of those restructurings up until 30 September 2022. We note that during the period 1 July 22 to 30 January 2023, there were a further 197 appointments of a restructuring practitioner to a company. Chair, you'll be happy to know we're more than happy then to assist you with your questions.
Thank you very much, Mr Day. And I'm going to go to the first couple of questions from Mr Georgianis.
Thank you. I'll just start off. In your opinion, either ATO or ASIC, who's best placed to undertake this review that we've been talking about?
Mr Georgianis, you mean, say, in relation to the Productivity Commission or the ALRC? You mean in terms of the root and branch
Harmer-style root and branch review of Australia's insolvency laws?
I'd nearly answer it by saying it's probably above my pay grade. Okay. But I understand you've got this afternoon the Attorney General's Department and Treasury. I think it's probably It's probably a bit. I mean, I think it's maybe a combination of both the Productivity Commission and the ALRC, because I think some of the things that are being suggested probably are about economic efficiency and price efficiency in some areas, which would obviously fall under the Productivity Commission. Others are really in relation to the impact and the process of the laws, which means there might be some things that the ALRC might be a better place. But again, as I said, it's not something that I'm an expert in, which way that would go. I mean, I don't know if my friends at the ATO have a view, but my view would be you'd be best asking your representatives appearing this afternoon.
I'll take that on board, and I'll just ask the same question to the ATO, if you had any views or any ideas.
We would share Mr Day's views around it's above my pay grade as well, and not within something that the ATO considers.
Thank you. Again, just on the same sort of matter, no, you may not, I'm just asking for, as an agency, whether there's any views or whether you basically might be able to assist in terms of this review. And I know that there's other agencies as well. But so far in the inquiry, some departments and agencies have been fairly generous with their submissions, providing suggestions for reforms. However, others have declined to put anything forward for their suggestions for insolvency reform. What do you think is needed to ensure that important information would be available to a root and branch review that perhaps your agencies would be able to assist in?
Well, if I speak on our behalf at ASIC, I would say, I mean, a lot of those insolvency statistics I just mentioned are obviously really important. I think there's probably a whole lot of other information about our own experiences in relation to, if you like, enforcing and applying the laws as we've got at the moment. I mean, obviously we have a lot of practitioner information and feedback we would give, so I can see that there's a range of things we'd be able to contribute to that. I mean, a lot of the things also, I think, are, if you look at the last 3 years, there's now a number of reforms that have come into the system, and the report we released is sort of an indicator of one of those. So, I mean, I think some of it also, Mr Georgianis, is you may want to let some of those flow through. So by the time such a review might happen, if it happens, I think we'd also be able to provide better detail about how some of these more recent, I'll use the phrase innovations, have gone and what they've actually provided in an Australian context. So I think there's a whole range of those things that we could provide to assist such a review. But I think there may be other things that, say, the Productivity Commission might want, that probably there's a broader set of data from somewhere like the ATO or others that might assist in that.
Thanks. And the ATO?
Probably just add, and I'm sure the committee is well aware that the ATO in this space is not a regulator and is not the policy agency for insolvency. So I think we would largely refer you to our colleagues in Treasury for any root and branch policy reform ideas. What I would say, though, is that we have had discussions with Treasury as a major creditor in this space and raised some of the issues, observations, I suppose, that we do see in this space. But I'm hesitant to raise them, I suppose, for the public record, because I wouldn't want to be seen as the ATO advocating for certain policy reform. I'd rather raise it directly with our policy arm in Treasury and seek their views on it first. And if they think it's a good idea, then we're happy to support them in progressing it.
Thank you.
Can I ask a clarifying question there? I guess at the heart of the question, I understand a very, very sage response, but the data and access for academics to interrogate the data is really part of the question. So providing the data to a policy body is one way of garnering the expertise of a particular group of people, but academics are indicating that there are barriers to them accessing information that would allow them to do work and then feed into that ecosystem of thinking and evidence that would then inform policy using the expertise of our amazing minds around the country and perhaps internationally too. How much info from the ATO is packaged in a way that's accessible to academics, and how dedicated is the ATO to engaging with academics and providing access to that information?
So the ATO holds a lot of data. We don't make a lot of it publicly available for privacy reasons, obviously, although from an aggregate perspective, of course,
de-identified data we'd be talking about here, nothing of detail. Yeah.
So if there's any specific data that you're referring to or that there's been evidence in prior submissions or at prior hearings, we'd be happy to hear those. We do also have, plenty of data that we can provide on notice to the committee. And I will just add to say, when we were talking about policy ideas or issues that we're facing as a creditor and raising those ideas with Treasury, it was probably more around, I guess, observations that we see when we are interacting with debtors in applying those, particularly around the small business restructuring reforms, for example, just to give you a flavour of the kind of things we see. So we're obviously involved in the insolvency regime more broadly, and then the small business restructuring laws as well. So things like harmonising those laws would certainly provide, as a creditor, ease of administration from an ATO perspective.
So to be clear, harmonising, which particular laws are you referring to there, Ms Kitto?
I'm probably treading on dangerous ground there, Senator, that I'd probably prefer to leave it there, if I may.
I think you're reflecting that sense of there has been some change heralded and there's a policy objective that was set that's largely been agreed, yet the implementation has failed to deliver in the way that might have been hoped. And that's a matter of public discussion now, that these things have started the ball rolling, but there are some sticky bits in it that aren't working.
I think what I'm sort of alluding to there is there were some things that were implemented in the small business restructuring laws that perhaps could be offered as improvements for the broader insolvency regime, and we've certainly sort of got a body of evidence now that suggests that that seems to be operating quite smoothly. I don't know if my colleague Mr Busby would like to add anything in that regard.
Well, I think what I can say is that we've also observed the increase in the number of small business restructurings that ASIC referred to earlier today, and we are a creditor in most of those, so we do have first-hand experience of the work that the practitioners do and the plans that are put forward by the directors. And we've seen that, at this stage anyway, that most of those plans have been accepted by creditors, including the ATO. And it has provided a relatively straightforward mechanism for approval that provides probably greater certainty around outcomes than say, for example, a deed of voluntary administration and deed of company arrangement might do.
That's quite helpful. Just because of where we are, where we've landed at this, I do have one question before I go to Senator Scarr. Yesterday we received evidence that's noted in the submission number 39 from the Chartered Accountants Australia and New Zealand. They assert that while the ATO works hard to encourage businesses to work with them to address debt for those who enter payment plans, the debt due remains as the original date due. This can be a disincentive to enter a plan, as until it is paid in full, the business could be considered trading while insolvent. So the construction of trading while insolvent because of that due date was quite a concern that was raised. And the suggestion was that consideration be given to adjusting the due date for the ATO taxation debt to the dates under the payment plan, and that also probably should be referenced to a recommendation that if we've had 3 years of businesses getting themselves into a pretty tricky situation, that sometimes a 1 year and a 2 year agreement might not meet the 3 years that they would need to get to a better trading position. So I'll just give you the chance to respond to those observations of the last couple of days, Ms Kitto.
Thank you, Senator, and I am aware of that recommendation in the submission and the evidence provided yesterday, so I do appreciate the opportunity to respond to that suggestion. Can I just make the observation that payment plans are a really critical tool that we use, that we offer our clients, particularly our small business clients, to manage their debts, manage their cash flow. And we have seen an increase in payment arrangements over the last 2 years in particular. So just to give you a sense of scale, if I can, as at the end of 2022, so 31 December 2022, we have 403,459 active payment plans, and small businesses account for 72% of those active payment plans. So we would attribute the growth in those payment plans to, higher levels of debt that are under management. I will note that 20% of the ATO's collectible debt book is under a payment plan right now. That represents approximately $9.6 billion. It's also partly attributable to the increase in the ATO's engagement activities, including awareness campaigns, and I think improving business circumstances and willingness to address the debt as well. So further, in 2021, we've also made improvements to our online services payment plans availability. So payment plans can actually be amended now rather than just cancelled and a new one created. And currently, online services can be used by businesses to enter into payment plans for debts up to $100,000. Now, our payment...
So to just understand that from a practical point of view, that you might owe the Australian Taxation Office up to $100,000, you may have made an arrangement to pay, you need to make an amendment. You can go online now and recommend such an amendment. Is that, am I hearing you correctly, Ms Kiddo?
Previously, if you wanted to change or amend a payment plan, you actually had to cancel your payment plan and then get a new one approved or agreed to. And now the functionality is available in our systems to amend those within, set parameters. So, for example, my understanding is that the maximum amount of time that can be entered into is 24 months for that up to $100,000 debt. So there are parameters, but yes, as long as you are within those parameters, you can amend.
Just very quickly on that point, since this new system's come in, what percentage of amendments have been granted? Would you have any figures?
Oh, I would have to take that one on notice. My apologies.
It'd be good if you could, just so we can see how many actually do get granted. And
absolutely, we can take that one.
And I'm keen to come to Senator Scarr, but can I just take you back to the due date?
Yes. So
versus the agreed date of payment and tipping businesses into insolvency and then trading while insolvent. Is that
just
correct?
Apologies, Chair. So our payment plans are generally not offered on an interest-free basis. So the due date of the original tax liability will determine when general interest charge is payable on that debt. If the due date is to be deferred to a future time, that means that GIC will not start to accrue on that debt until the deferred due date. So there is a level playing field argument there to say that those who do actually pay their tax liabilities on time and in full would be disadvantaged as compared to those who received a deferment in their due date under a payment arrangement.
Yep.
Having said that, I do note that we do offer payment deferrals as well as payment plans as an effective way of providing short-term support to small businesses. So that actually has the effect of delaying their payment obligations to the ATO. And just to give you, I guess, a snapshot of our payment deferrals granted, in the first 6 months of this year, so July to December 2022, the ATO granted 520,351 payment deferrals to small businesses, which is up from 366,561 for the same period the year before.
Okay.
Would COVID have had anything to do with those figures going up? Because there was obviously there was a stop on recoveries, etc.
I think that would certainly be one factor, yes.
Thank you very much. I'll go to Senator sorry, I don't know if I'm really still clear exactly about whether the system is unintentionally putting people into a position where they could be technically trading insolvent if they don't get a deferral. I'm not advocating for a better treatment of those who owe interest. I'm just asking for a technical answer to, does that actually tip people into insolvency practically or not? Is there a mismatch there? Did you want to?
I can probably add some observations to that. Look, if the directors are considering they're in a position that if they cannot defer the debt and it is due and payable, they would be insolvent at that stage, then that's the time where they need to get some expert independent advice over the future of the business.
Which could be seek a deferral from the ATO or commence engagement with an insolvency practitioner for restructuring or a movement towards insolvency.
It could do that, yes.
They would be the two most obvious paths to me. Is there anything else?
They would. I mean, a closer look might actually give them the comfort to know that no, it's not an insolvency. It's a temporary cash flow issue. They're only seeking a short-term repayment plan. They then expect to get back on track and go beyond that. But the ATO itself doesn't generally have the visibility of the company's overall financial position when we deal with payment plans.
Okay. There may be some more questions on notice, just to try and really get to that at the bottom of that. Thank you very much. Senator Scarr.
Thank you very much. I have some questions for ASIC first, if I could. We heard some evidence from the AMWU, Australian Metal Workers Union, with respect to a scheme of arrangement that was entered into by Ovato, and the concern raised by the AMWU was that the position of some of their members, employees, was compromised through the scheme of arrangement process. And my question to ASIC in the first instance is whether or not you, ASIC, has followed that scheme of arrangement process, has considered the views of important stakeholders such as the AMWU, and whether or not ASIC is looking to publish any guidance, regulatory guidance, or any thoughts more generally with respect to the scheme of arrangement process being used in that context. And since it was raised, I should say I've looked at some of the commentary in relation to the scheme of arrangement, and a number of experts in the field say it was a somewhat novel process or novel application of the process, in particular how it sought to bind trade creditors. So interested in ASIC's views in that regard.
It's Warren Day. Thanks, Senator Scarr, for that question. I mean, I think I might indicate just simply that, yeah, I think there's some interesting things there. We're not really well briefed about that for today. More than happy to take those good questions on notice. I know that there is one of our specialist teams, thinking about that matter and considering it. So I'd really like to take it on notice so I can give you a better answer.
Happy for you to take it on notice, Mr. Day. And if in the course of taking it on notice, one of the issues which particularly concerned me is that it appeared the AMWU had received advice that they didn't have standing to actually turn up at the court proceeding and provide the concerns of their members to the judge who was considering application of the scheme of arrangement provisions. So in terms of providing a response on notice, could you please consider that aspect as well, please?
Yeah, I can say I'm not surprised that their advice says they don't have standing, but more than happy to take that on notice and give you our thoughts about that.
Okay, well, I note your comment. I must say I was reflecting whether or not I would have just turned up and made myself known to the judge and thought, how do we go? But because it did seem to me to be important issues for consideration of the judge.
Yep. Senator Scarr, you reveal yourself as a Queenslander frequently.
There's too too much formality in the world.
I've got to say I'm a bit surprised that you're representing, potential interests of a union, Senator Scarbour. That's just a
Well, this committee works in the national interest. It's doing a good job.
I can see.
Absolutely. I'm a very complicated individual, Mr. Day. The issue with respect to reports of misconduct and the concept or the practice that liquidators, because of their duties, because of their responsibilities under the Corporations Act, are required to undertake work which in many cases is not remunerated, and in many cases ASIC simply doesn't have the resources when you're seeking to triage which cases to take forward or not to take forward to progress matters. In paragraph 228 to 230 of ASIC's submission, you raise the issue of the relevant thresholds which apply. So at the moment, threshold of misconduct which triggers a reporting obligation is a mere appearance of misconduct, and there's some commentary, some postulation as to whether or not that threshold should be increased. I'm just reflecting on this. I'm interested to know if there are any, and again you could take this on notice, Mr. Day, whether or not there are any other analogous thresholds or benchmarks which apply in this space that could perhaps inform a decision as to how high the bar should be raised, because clearly the appearance of misconduct is a very low benchmark, but interested in any suggestions or just even analysis of other benchmarks that apply in similar processes which could provide a guide to the committee in terms of considering this. Would that be possible to take on notice?
Well, it is, but I might assist in the first instance, though, Senator Scarr. Can you just remind me the paragraphs of our submission you referred to, please?
Paragraph 2. You're right.
Could you state that again, please, Senator Scarr?
228 to 230, page 58.
Thank you.
Thank you. I mean, look, I'll take on notice what you've asked, but because I think we might want to give some thought to that in terms of the thresholds for misconduct to be reported to ASIC. I mean, the matters that are referred to in paragraph 228, must lodge a report if there will be a dividend of less than 50 cents on the dollar. I mean, I think we said on the last occasion that's a very low bar, because when you look at the statistics, it captures virtually all, the majority, if not all, companies in that way. So I think there is some sense in that. I think that the thing I would say is, and I think they probably won't want to comment on this, but my friends at the ATO would think that we want as much data and information as we can get, because certainly when we look at it through a Phoenix lens, anything that the independent person who is the registered liquidator looking at the activities and the conduct that went on in the company, anything they might share with us right across all companies when they go into liquidation is a useful data point for anything we might take into the future. I'll give you an example. And it's one of the things that I think is misunderstood about the matters we might not take on where we have a 533 report. If we get a 533 report that says in relation to a single director company, we might say thanks, and we just record that, keep it, and it's on file, so to speak. But 2 years afterwards, if the same thing happens with the same person being a director of a single person company, then the interest goes up. So even though the debt, the impact on the community or the debt might be low, what we have is starting to form a pattern of conduct by an individual that we want to know about. So it might not be a big impact on, say, the tax base, but it's certainly an impact on other small business that person who is being a director of companies about is causing the community. So we want to make sure that we know as much as we know so that we can take out bad actors. And that's what we know the small business community wants us to do. So it's not as straightforward as saying reduce the amount of workload by lowering the bar for these reports. because there actually is a public policy question about is it valuable for the regulators, not just ASIC, but the ATO and others who could benefit from our information, to know more about the people who are in control of a legal entity being a company. So I think it's got to be weighed up against that. So we can give some thought about and take on notice where we might think it might be better set in terms of the bar that you refer to, Senator Scarr. But I just want to put forward that there's a broader public policy in some of these reports that sometimes is lost in the conversation.
Sorry, Senator Scarr, Steve Georgianis here, just on that
Mr.
point.
Georgianis.
Can I ask, currently are there pathways to have that information accessed when something triggers an alarm in your area, for example?
Oh, absolutely. I mean, we talk about antecedents.
So freely, I suppose you can go to the ATO and get information whilst you're in that investigative process.
Yeah, and I mean very much, and I think it's a matter of public record that through the Phoenix Task Force lens, this is data that's being shared on a regular basis for that purpose. So between us, I mean, it's a team sport. Yeah. So we are sharing that, through one of our Phoenix Task Force projects, and Mr. Montanez might be able to say more about this, but for our own purpose, given we're charged with taking out directors who are acting badly, it's a really important data point for us. So, I mean, again, it's not a 2 or 3 strikes you're out type rule, but we want the information to say, well, what is this person doing? Because then it might be matched about other things we know. So if we see someone who's done it twice, we might see, because of other information that's provided us by the ATO, or in fact, a large number of other departments, agencies and regulators that say that person, it could be from the Liquor Licensing Commission or others, saying we have someone acting badly in the community. So when we take all that into account, we say actually there's benefit in that person being disqualified from managing corporations. So there's a wider purpose for some of these reports. And I know it's frustrating for liquidators because they'll say, oh, I did a lot of work and I gave you this report, and then they'll say nothing happened. But some of it is about pulling together effectively a database of antecedents so that when we see other things go wrong, we say this person should, sit out the game of being a director for a period of time, until they sort of, can show they can improve.
Thanks.
Yep.
Back to you, Senator Scarr.
But notwithstanding that, Mr. Day, you do recognise that there is, and I agree, and there's logic in everything you said in terms of your response to the question, but you do recognise that in some situations liquidators feel obliged, they're acting conservatively to do the right thing in some cases in terms of providing reports, and in many cases they're not being compensated to do that. There is that dynamic we're also dealing with.
Yeah, absolutely. I mean, that's undeniable. I mean, there's a cost in this, right? And clearly, they've been able to, the liquidators through this hearing have been able to explain what the nature of that cost is and the quantum of that cost is, and we know that. I mean, we, through all of our direct liaisons, through Mrs. Enyu's group and others, direct with practitioners, we know that. But that's what I'm saying. There's a trade-off between the two, and it's probably something that obviously this committee might want to give some thought to.
Mr. Yanko.
Just moving to a
I think we've got a response.
There's a lot of evidence given with respect to trusts and information available on public registers with respect to trusts. And I note ASIC made observations in this regard in paragraphs 217 to 219 of ASIC's submission. So I'd just like to give you the opportunity to perhaps give your views on the utility of more disclosure, public searchability around key data points with respect to trusts, so that people dealing with corporate trustees have a resource that they can go onto and check, so they know who they're dealing with and what authorities there are with respect to who they're dealing with.
So, Senator Scarr, I'm sure ASIC have noted your question, but Mr. Yanko was attempting to just respond to your last question before we move on to the trust question. So, Mr. Yanko.
Thanks. Thanks, Chair. I was just going to say that the concept of reporting to ASIC when there's less than 50 cents in the dollar, or where there's a suspicion of some a breach of something. It's not dissimilar to reporting to AUSTRAC, where you report transactions above a certain level, or you suspect that there's been a crime. Now, the people reporting those, they're financial services organisations. They don't get paid to do that. It's basically a cost of being in that business. But similarly, AUSTRAC has got a big database, and it's available there to be looking, trawling through for, patterns of behaviour or specific instances where there might have been a crime reported that needs to be addressed urgently.
Can I just make the point, though, Mr Yanko, that might be apples and oranges rather than apples and apples, given the technical capacity to look across a large amount of data with AI technologies, but the differentiated nature of the inquiries into individual businesses mean that it's a very different nature of a task to fill out specific forms for ASIC that relate properly to individual businesses.
That's right, although we do get, when some of those reports to AUSTRAC are quite a lot of work. In fact, we introduced a light version of it to accommodate faster reporting through to ASIC for suspicious activity reports.
Okay. But I guess I'm seeking to confirm that ASIC understand the evidence we've received and to be mindful in any changes going forward about the duplicative, time-consuming nature of what is currently required for people to comply with licensing requirements that is being responded to by AI with nothing following it.
Sure.
An unnecessarily churn, cost, impact on business models, impact on professional capacity, slowing down. That seems to be an ecosystem that's operating in your world that needs some review.
Maybe in a neat move, Senator, maybe if I connect that to the question Senator Scarr's just asked just before. Senator Scarr, in relation to trust, I think what you're effectively saying is, can the database show whether or not the company is actually a corporate trustee? And can we build that in? And I think you're pointing to the fact that there's some real benefit in that. Is that right?
Well, I think it even goes further than that, Mr. Day, to the extent that the trust itself, it's recognised in equity or in law as a trading trust, and the trust itself should potentially be registered as a particular type of trust. So not just the corporate trustee being recognised as having that status, but the trust itself actually being registered. So you've got things like the trustee potentially, just as you'd have a constituent document of a company registered.
Yeah.
So I think it goes further than just recognition of the status of a company as having also being a corporate trustee.
Yep. No, I thank you. I understand now a bit more deeply. So going back to where I said it neatly, I'll try to bring these things together, where's in response to Senator O'Neill's remarks. I mean, I think there's a real issue about a number of corporate-like forms that the legislation across a number of pieces of legislation have created. You've got the same thing with managed investment schemes. There's these things called CSIVs, which I can never remember what the acronym stands for. Anyway, so there's a whole range of
collective investment vehicles.
Thank you, Mr. Yanko. Corporate collective investment vehicles that as the Parliament's looked at. So there's a number of these things that nearly seem to walk and talk like a company that people need to know who they're dealing with, and then that raises issues about their winding up rules, those types of things. So I'll park that. I mean, certainly when we talk about trust specifically, what we really need is a consideration by the Parliament. Do they want to basically have them registered and searchable the same way as companies? So I don't really have a view about that. That's a policy question for government, Treasury, and I would say probably for the Parliament to decide whether or not they want that. There's some functional things though that go with that. Obviously then there would need to be a separate register set up for them, and that would have to be through, and I would expect what is the Australian Business Registry Service, which I think as members of this committee would know is connected into this modernisation of business registers. Committee members might know that the Assistant Treasurer, Mr Jones, has announced a review of that program, and that review is to be led by Mr Damon Rees, and with it reporting back in the next few months. So, any new register of things such as trusts, acting like corporates, would have to be done through that. The thing I would say is I think until we get the current registers of companies and business names modernised, I can't see how you would find time to then push in another register of those things. The last thing, picking up what Senator O'Neill was asking, once that's done, we're really excited for that to happen, because once that's done, we think then the sharing of data on a more modernised platform will actually allow us to understand a lot more of the interrelationships going on involving individuals, being directors, the individuals who are involved in our financial services licensing laws and credit licensing laws, and obviously then those people who are acting as directors of corporate trustees, beneficiaries of trustees, those types of things. But until we get to that point, which I think is a couple of years away, until that's all enacted, I don't think we can move that way. I hope that helps bring together, Senator O'Neill, what you were asking, but also what Senator Scarr was pointing at.
Thank you. Senator Scarr, is that your last question?
I just had one question to the ATO, if I could.
Yes, go ahead.
And that is in relation to this issue of disclosure of ATO debts to the broader credit market. And there was a submission received from the Australian Institute of Credit Management, and they spoke about the thresholds whereby I think the threshold's at least $100,000 of debt to the ATO has to be in place before there's a disclosure trigger to the broader credit market. So I'm not prejudging this issue in any way. I'm just interested in the ATO's views with respect to the transparency around debts to the ATO, so that potentially other creditors, people dealing with businesses, have some sort of visibility as to what the liabilities are potentially.
Thank you, Senator Scarr. Ms Kitto from the ATO. I think it's a really important point to note the intent and the policy behind the disclosure of business tax debt measure. It's really about ensuring that other businesses that are dealing with companies can make informed decisions about terms of trade. And I have seen the evidence provided in the submissions that the lower the threshold, the more businesses that will be potentially disclosed under this measure. There is something there about being able to rely on the disclosure to provide that transparency to businesses that I certainly recognise the sentiment there. Just particularly in relation to the proposal or the idea to drop the threshold from 100,000 to 10,000, I don't think as the ATO it's really appropriate for us to comment on what the threshold should be. I think that's a policy question for our Treasury colleagues. But I do recognise the intent that suggestion is trying to achieve.
Okay, thank you, Chair.
Thank you. So many questions and so little time. Can I just, so there'll be a few on notice, but can I directly go to ASIC? We had some evidence that said there was no action of ASIC checking with the ATO prior to deregistering a company. Is that correct? Because we know that you undertake 13 of the 14 registrations and one actually proceeds through insolvency. So
it's not the case. Obviously now the ABRS is running the register for ASIC at this time. My understanding is that the list of companies that are in what we call strike-out or strike-off mode is available to the ATO so that they can see that before that occurs.
Okay, so is the ATO and ASIC, are you talking about the best practice with regard to observation of this register?
Without a doubt.
Okay. So if you could just take on notice some
We can give you some
clarification for
detail.
us
We
about
can give you some details about
how
that
it's
happens.
operating and what,
Yep.
because this is evidence we received. We also received evidence that indicated ASIC rarely, if ever, takes enforcement action in relation to insolvent trading. Could you give us some numbers to give us the sense of that?
We'll give you some numbers about that, Senator. We'll take that on notice.
Do you think that's a fair assessment?
I think it's harsh. I mean, I think as been indicated probably by the previous witnesses, insolvent trading is actually a difficult offence, and there's a whole range of things involved in that. Is there a chance for us to do more insolvent trading matters? Yes, there always is, just like any of the areas that we regulate. But, you know, we assess at all times for, you know, the opportunity to look at insolvent trading. I mean, most of the time, insolvent trading might stop a director, but it might not get any money back. And often, you know, there's a question of you have to take that into account as well, which I think is sometimes lost on people. But we'll take on notice the statistics.
Yeah, and I guess in terms of its intersection with director identification numbers and practice, and we'd be interested in getting a sense of that. In sense of getting that. Just going to your opening statement, you indicated there's a change of sequence that you think might be appropriate for directors having some say about the appointment of liquidation and the process that follows. Is that live or is that being considered? Or is that just a recommendation for this committee to give consideration to?
Yeah, we would say the latter, Senator.
Okay, thank you. With regard to the insolvency statistics, we noted that, you know, you've advanced those. Why were they delayed? Why was there a gap in releasing the data that has been sought?
Ms Esney speaking. It's interesting, the last ones that were published in 2020. We then, at ASIC, as we've pointed out, had a new form, so there was a new reporting regime.
Yep.
So the two data sets were not contiguous. Then there was a little thing called COVID, and we were then...
Really?
We were then...
I wish I missed it.
We were then publishing statistics weekly on the number of insolvencies, so we pivoted towards making sure that those key things about industry, about how many insolvencies were happening, because...
So more real-time reporting.
Real-time reporting of the real core data.
Yep.
We kept working on the data sets in the background, and I did. We did have on our website that they would be published by the end of last year, so they were a little bit over that, but they are now published. There is more that we continue to work on, as I think a few people have alluded to. So, again, if people ask us what are they interested in, we can then look at what we can provide or a proxy for what is being asked.
And we don't
or collect. So
Yeah.
can I just put on notice that there was evidence today from Professor Jenny Buchan with regard to franchising, which is 8% of the economy, data to get clarity around franchisors, franchisees. Her evidence today I think would be of interest to everybody about what's going on in that space and responsibilities. So
We'll take that on notice. It may be more difficult to identify those through the statistics, but we'll take that on notice.
especially if they're not required to reveal that they are actually operating a franchise business
Correct.
model, which changes quite a lot about insolvency.
Correct.
So if you could look at that and give us a response to that, that would be helpful. On notice also, you indicated progress with regard to applicants being able to get around the 4,000 hours in a way that was still going to provide integrity in their registration. Could you indicate how many and how was their suitability, like how was it determined? What was the criteria for basing an assessment that liquidators should be acknowledged without the 4,000 hours?
Yeah, we'll do what we can. I mean, it's the committee's decision and their criteria, which isn't us.
Yep.
So, you know, we may have to write to the committee and ask them to see if they'd support us with answers along those lines, but we'll take the question on notice in any event, Senator.
Thank you. You're all familiar with the Whittaker Review. I'd just be interested if you have a view about how long it might take to implement the recommendations of the Whittaker Review. Mr Day?
I don't know that we can answer that, Senator. I'd say it's more an answer for AFSA, given we're talking about the PPSR, which is under their control and responsibility. So I just don't think we can, certainly from where we sit, I don't think I could answer that.
Thank you. Several witnesses have recommended the creation of a government-run liquidator, given the high amount of public service work done by current liquidators for free and the high rate of business being wound up by ASIC for non-payment of registration fees. How long would such an office take to establish, in your view, if such a policy were to be enacted? Like,
I don't know that I can even answer that. Because it would depend on what the office is doing, who's running it, where it's from. Is it its own thing? Is it under, is one of those agencies that actually acts under our umbrella, like we've seen in the past with the former Superannuation Complaints Tribunal or CAMAC or those things.
Yep.
If it operates that way, then I think it could be relatively quickly. If it operated as its own thing with its own appropriation, etc., then that might be a longer period of time.
that's a very helpful answer. Thank you very much, Mr. Day.
Okay.
And can I just go to the ATO? I think when we were last here, there was some questions about DPN notices, action and timing of that. Can you give me a bit of an understanding of the timing and how that works when a DPN is served? I note you had some notes here on page 285 about that.
Of our submission, Senator?
Yes. It's 285 in my notes. It's probably page 5 or something in yours. So you refer to DPN at point 20. The issuing of a DPN. Could you take me through the timeline on that?
Sure. So when you say the timeline for issuing a DPN, do you mean the steps that we take prior or the actual issuing of the DPN?
So you indicate that there's a number of points that might be undertaken before you get to the issuing of a DPN. So when you get to that point and you're going to issue a DPN, what's the sequence and the timing there, just so that I can understand that clearly, because we had some pretty interesting evidence around it.
Yeah, so I think it's important to note that there are a number of steps or a number of points before we get to that point of actually issuing a DPN. So I mentioned in my opening statement that we take a lot of early engagement actions.
Yes.
So our approach is all about transparency and awareness of the obligations. Probably just like to note as well that over 70% of tax liabilities are actually self-reported. So they're not a surprise as such to the businesses, to the directors, in the majority of cases when these DPNs are issued. And then before we get to the point of actually issuing the DPNs, there has been multiple attempts to engage. There's been SMS reminders about upcoming due dates, and then there are reminder letters that can be opted in for post-due date or payment plan reminders. There are then what we call our early intervention or blue letters, which are really early warning letters. And then we move to what we call our firmer action warning letters, our orange letters, which really make it clear what the next steps may be if no engagement is undertaken or no action is taken to engage the ATO to address the debt. It is only then, once we reach that point of firmer action, that we may consider issuing a DPN. And another point I think that's really important to note is the types of taxes that the DPNs relate to. I think I provided evidence at the last hearing that they are in relation to predominantly pay-as-you-go withholding, GST and unpaid superannuation.
Yes.
SGC. The point I'd like to sort of highlight there is that they are not a tax on the profitability of the business. They're actually amounts that are required by employers to withhold either from their employees' wages or on behalf of the employees for their super or on behalf of the states in the case of GST. So I think that's quite an important point to make as well. I'm not sure if that answers your question around the actual, once we issue the DPN, the steps we go through. Are you looking for more information around the decision-making process of the
Maybe
staff?
I'll notice just the timing. This was like by the time people were advised. Yeah, I'm just trying to understand from a small business point of view. You've given a really clear indication of how carefully you are attempting to engage with people. Once that hits, how long is there a response period of time, right? And what could happen then? And we're running out of time, so I'll ask you to give that on notice so the committee is clear on it. I also ask you to look at evidence that we received yesterday from the Financial Counselling Support Services, who made a point in particular about coercive practices with regard to directors in domestic violence situations or elder abuse, where directors might be receiving these notices from you in a sociological reality that is very different from what might be happening if it's a business where things are functioning but the business is failing because of financial reasons rather than power and abuse reasons. So I just seek your comfort and information on how you respond to that. Finally, registered liquidators, you talk about how important it is that there's ethics involved in the action of those registered liquidators, and then you make a comment about pre-insolvency advisors. Critically, the accounting bodies, CPA, CANS, and I expect the Tax Practitioner Board are involved in that. Given the level of concern about very dodgy, to use a very technical term, practice by pre-insolvency practitioners, I'd be interested in getting the ATO's view about what you're seeing with regard to that, and seeking your comfort and comfort from ASIC as well, because you interact with those bodies, that there is sufficient notice being taken of a burgeoning business of pre-insolvency practitioners.
I don't think it's fair to say it's burgeoning. It's been something that through Phoenix Task Force and others we've been looking at for a number of years. I mean, I won't say the market's mature, Senator, but we're happy to take it on notice and give you a look at what the activities separately and together have been in relation to pre-insolvency advisors and what the difficulties have been, but also what the successes have been.
We've got the whole scheme.
Yep.
And I note that, in your opening statement, you indicated that you're keeping your fingers on the pulse, literally, of what's happening. It'd be interesting to understand how successfully these pre-insolvency practitioners are operating and how that's compromising the fair tax that all Australian businesses and pay-as-you-go owners should be paying, because the last thing we want is, I think, what the AMWU might have had in their submission in relation to construction, a statement that businesses thrive on using everybody else's money in that sector, and it shouldn't be the Australian taxpayers' money any more than it should be unsecured creditors' money. So in the light of that observation, I seek your input on pre-insolvency advisors and your sense of integrity of the current registered liquidation model. Thank you.
Thank you. Thanks, Senator.
And the committee will break now for a lunch and return at 2:15. Thank you. Thank you.
Committees has been provided to you. For the Hansard record, will you please state your full names and the capacity in which you appear today?
Thank you, Acting Chair. Alexandra Matthews, First Assistant Secretary, Employee Entitlements, Safeguards and Policy Division of the Department of Employment and Workplace Relations.
Thank you. Sue Saunders, Assistant Secretary of the Fair Entitlements Guarantee Branch in the same division and department.
And good afternoon. Henry Carr, Assistant Secretary of the Recovery and Litigation Branch. I manage the FEG Recovery Program.
Thank you and welcome. I now invite you to make a short opening statement, and at the conclusion of any remarks, I'll invite members of the committee to ask questions. And we have a couple of members on the line and on the internet as well. So I'll hand over to you for a quick short statement.
Thank you very much, Acting Chair. I do have a 2-minute opening statement, but equally happy to go straight to questions if that's the committee's preference. I do have a 2-minute statement, but happy to go straight to questions if that's the committee's preference.
If you'd like to, is
Sure.
it a long statement or a short?
It's 2 minutes.
Got it here, so it'd be good for the others that are on the line to hear the statement as well.
Thank you. Look, thank you for the opportunity to provide evidence to this inquiry. As outlined in our submission, the primary interest as the Department of Employment and Workplace Relations in this inquiry lies in the protection of unpaid employee entitlements in the event of corporate insolvency and in ensuring the impost on taxpayers of our funded programs is managed appropriately. We note from the outset that our submission and views expressed today represent those of this department only and may not necessarily reflect the government's position or indeed that of other Commonwealth government departments and agencies. As outlined in our submission, this department administers 2 programs which are relevant to this committee's terms of reference. The first is the Fair Entitlements Guarantee Program, or FEG, which is a legislative scheme introduced in 2012. The FEG program fulfils a significant community need in protecting employees who would otherwise stand to lose their entitlements upon losing their jobs due to the insolvency of their employer. Over the last 4 full financial years under the FEG program, the government has advanced an average of $134 million to 8,272 former employees each year. In assessing claims for payment under FEG, there are a range of checks and investigations undertaken to confirm the amounts owed to employees, which takes into account information from company books and records and documentation provided by applicants and insolvency practitioners. As a legislative scheme, it is incumbent on the department to make best efforts to finalise payments as quickly as possible, while also ensuring such payments are correct and comply with the legal framework. In administering this program, the department comfortably meets its key performance indicators for both timeliness and accuracy, with the average claim processing time over the last 4 financial years being 10.2 weeks. When an advance of FEG is made to a former employee, the department stands in the shoes of the former employee as a creditor in the winding up. This introduces our second program, the FEG Recovery Program, which was established in 2015 to maximise the return of FEG advances and thereby reduce the impost borne by the taxpayer. Since the recovery program was established, the recovery of FEG as dividends in liquidations has increased from 14 cents in the dollar to 34 cents in the dollar. Since its inception, the program has recovered $233 million in FEG advances and cost recoveries over 641 matters. These directly attributable recoveries represent a return on investment of 514% for the recovery program over its lifespan. In addition, the recovery program has also recovered $24.08 million in non-FEG priority creditor employee entitlements and $21.83 million in superannuation guarantee amounts that have been distributed to superannuation funds. The recovery program plays an important role in maintaining the integrity of FEG as a scheme of last resort that is not intended to relieve employers of their obligation to properly fund employee entitlements. Thank you, and we're happy to take questions.
Thank you very much. And if anyone else would like to add to it? No, we'll go to questions. I'll start off with a couple of questions. We also have on the line Senator Scarr and Senator Molino. Just in your opening remarks, you speak about the last 4 financial years under the FEG program, and the government has advanced an average of $134 million to 8,272 former employees each year. Are those figures have been on the rise or on the decline if we go back 4 years?
Ask Ms Saunders to address that.
Yes. So the costs of advances paid under the Fair Entitlements Guarantee have been decreasing over the recent last couple of years, primarily due to the impact of the COVID situation, which saw from about mid-2020 onwards a decline in the number of insolvencies that were occurring across the Australian landscape. And because the trigger for FEG assistance is that a company has gone into liquidation, that in turn resulted in a decline in the number of FEG matters that were brought forward. So in terms of the year-by-year amounts paid, is that what you're interested in? Okay, so in 2019-20, for example, we paid out $162.3 million. In 2020 to 21, we paid out $103.8 million. In 21-22, we paid out 95.7 million, and in 22-23 to the 31st of December, we've paid out 60 million. So there...
What was that last figure?
60 million.
60.
Yeah. So there has been a decline in the number of claims and therefore a consequential cost reduction as well. But we're seeing demand return back to normal post-COVID. And so, we're anticipating that we're going to be returning to pre-COVID demand levels over the next 2 years or so.
And if I now go to the bit about the superannuation guarantee amounts, has that been declining or increasing?
We don't actually cover unpaid superannuation under FEG. We only cover the 5 basic entitlements of wages, annual leave, long service leave, payment in lieu of notice and redundancy pay.
So the recovery program doesn't include the figures that you gave us in your opening remark. Doesn't include. That's not part of your recovery program. Is that correct?
It's not part of our core focus. We're an important bookmark to the FEG program itself, but in pursuing recovery of FEG advances, incidentally, but very welcome, we may also recover, and we have recovered those extra amounts beyond recovering FEG for super.
And ATO, isn't it, that recovers?
Correct. Yep. It's typically SGC, which is paid in favour of the employees but to the ATO.
Okay. Thanks. I'll ask Senator Merlino if he's got any questions, or Senator Scarr.
I have
Senator Scarr.
questions, Chair. Senator Scarr here.
Fire away, Senator Scarr.
Thank you very much. I'd like to really drill down into the Ovato Group case and the use of the scheme of arrangement provisions in the Corporations Act to effectively, it appears, to pass liability, if you like, with respect to employee entitlements onto FEG in circumstances which I suspect were never envisaged when FEG was first introduced. So if I could ask our witnesses first if they could just walk us through what happened in the Ovato case, and also what action did the department take as the scheme of arrangement was being considered by the court. And I should note, just by way of background, in a previous life I've been involved in schemes of arrangement, but only in the context of them being implemented to facilitate a change in control, which I think is a very legitimate use of the scheme of arrangement provision. So I was quite surprised to see how the scheme was mobilised in the Ovato case, and I was quite concerned when the AMWU raised concerns about how the interests of their members and employees with entitlements were considered as part of the scheme of arrangement process. So very interested to drill down into that case and what the department's view is.
Okay, so in terms of the Ovato Group, I guess the potted history from the FEG perspective was that the Ovato Group restructured in 2020 through the innovative use of schemes of arrangement, which separated assets that transferred to businesses that continue to trade from certain employee entitlement liabilities that were then left in entities that were wound up. The scheme of arrangement was considered in the New South Wales Supreme Court, and they held hearings to approve that arrangement. Ovato, in that proceeding, filed an independent expert report prepared by McGrath-Nicol, which expressed the opinion that absent the restructure, 1,200 employees would be made redundant, with the bulk of the entitlements to be borne by FEG. As a consequence, 4 members' schemes transferred the bulk of assets and liabilities of 4 companies within the Ovato Group to other group companies that continued to trade. Not transferred were 205 employees, some equipment, and approximately $2 million in retained funds. Those 4 entities were then wound up with the express intention of relying on FEG to pay the outstanding employee entitlement liabilities. So in approving the schemes of arrangement...
Sorry, if I could just interrupt there, and I'm interested in the postscript because reading the department's submission, it then appears that on 21 July 2022, voluntary administrators were appointed to the group. So it went through this scheme of arrangement structure, but then in any event, voluntary administrators were appointed to the group in shortly thereafter. Is that correct?
Certainly, it was shortly after the schemes of arrangement. As I understand it, the voluntary administrators were appointed before the final court decision relating to the scheme of arrangements, but very, very shortly after that court decision, the company, the shed companies, shall I call them, the 4 shed companies, moved into liquidation, and that's when the FEG, the Fair Entitlements Guarantee Program, was triggered.
Okay, understood. So did the department actually appear before the court? Did the relevant legal entity that represents FEG, did it actually appear before court and make submissions with respect to the scheme of arrangement?
We didn't, Senator. We did look as a department closely at that option. We could see that there was an opportunity for us to appear, and whether that might, most likely that would have been to inform the court about the FEG program and the risks that a scheme could represent to the safety net policy underpinnings of the scheme. We briefed our then Minister and Attorney to seek his view on that option, and it was determined that we wouldn't pursue that option. So we didn't appear as it panned out.
Okay, and what were the reasons for not appearing? What was the and I don't want to take you into places where it's difficult for you to go as members of the department, but I'm interested to know what were the considerations in terms of making that determination as to whether or not to appear? Because on the face of it, I would have thought a judge would be extremely interested in terms of what the view of the department was.
I can't
Senator,
assist,
I think
Senator.
we might need to take that one on notice. I mean, obviously, the long and the short of it is that it was a decision by the then minister. I think we'd need to take on notice whether or not there's anything more that we could provide in relation to the reasons as to why.
Can you take that on notice? And if I can give you this added context, one of the other aspects about this case that disturbs me is that the AMWU, in its submission, bringing this case to this committee's attention, also brought to our attention the fact that they'd received advice that they didn't have legal standing to make representations in the court with respect to the interests of employees and workers, whose interests were arguably compromised and prejudiced by the scheme of arrangement. So I'm interested to know whether or not, in terms of the department's assessment of whether or not it should appear, it considered whether or not the AMWU or another union representative, someone representing the interests of the workers, was appearing and making submissions to the court, which I would have thought the judge would have been particularly interested in. So could you take that nuance on notice as well as to whether or not, in terms of the considerations, the department considered whether or not anyone else was appearing representing the interests of the workers?
Senator, I know we looked at the issue of whether the department on behalf of the Commonwealth representing the FEG scheme had standing, and we were confident that we had standing. Of course, ASIC has a statutory standing to provide a view, and of course those documents filed by the practitioners were filed with ASIC, who I understand did respond to the court. But if you're asking me whether we ought to look at the standing of other third parties, I'm not sure whether that's within our purvey, but we can certainly take it on notice and respond in due course.
Senator Scarr. I think Senator Scarr's dropped out. You there, Senator Scarr?
Yeah, I can. You got me now?
Okay. I think
it's not so much looking at the legal standing per se of unions and employees. It's more considering whether or not the fact that they weren't appearing provided an additional reason potentially for the department to appear. Do you understand what I mean?
Yes, Senator, I'm not sure we would have been aware whether the union was appearing until those, perhaps even until immediately prior to the hearing, but we understand the question.
Well, and I guess that raises the question as to whether or not there was any communication between the AMWU and the department with respect to the matter prior to the hearing and whether or not the union brought it to the attention of the department. So if you could also have a look at that, please.
We'll take that on notice. Thanks, Senator.
Okay, thank you very much. We've had witnesses from the ACTU this morning and everyone's concerned, I think, about the position with respect to Scott's Transport, and we heard evidence today. Well, let me first ask you, when a company of that magnitude with so many employees goes into receivership, what does the department do? Is the department watching the situation? What do you do from a practical viewpoint?
So certainly when there are large potential company collapses hitting the media, we do start taking a very active watching brief on how that scenario develops. In larger cases, we, under the FEG recovery program, generally reach out to the insolvency practitioners just to try to start gathering whatever information we can about what's happening with the company, you know, what plans there are moving forward in terms of, you know, from their initial investigations of the company's financial circumstances, what likely scenarios may play out in the future, so that we can start considering the extent to which the Fair Entitlements Guarantee may be called into the frame if the company does collapse. But oftentimes in fairly early days, like this particular example that you're talking about is literally days old. So, excuse me, it's probably going to be a matter of, you know, a week or two before there's any real valuable information that gives us any kind of indication of what the future is for this particular company. But we certainly do reach out and open communications with the insolvency practitioner so that we can stay abreast of things as they develop in real time.
I've just got a message from, we often leave them alone for 24 hours, Senator, to get their heads around their challenge, but I understand our team has spoken to both the receiver and the voluntary administrators.
Okay, do you also speak to unions or worker representatives? Because in a situation like this, I'm minded that if you're an employee, trying to put yourself in the position of an employee who's been working there, and we heard examples potentially of people who may have worked at this company for 30 years and would have had a lot of accrued entitlements. Is there a mechanism for employees to contact the department and I guess just receive at least some comfort that FEG is there and the intention is to make sure that they get their entitlements up to a certain amount at least?
Yes, so there's a range of information that is available publicly on our external website about what the FEG program is, how it operates, etc. We also have on our FEG website a FEG hotline contact number where we encourage people to contact us directly and ask any questions, and we'll provide advice to them based on what their current circumstance actually is. The insolvency practitioner themselves, we have quite heavy reliance on insolvency practitioners in terms of how we manage a Fair Entitlements Guarantee case in any event. So all insolvency practitioners will be very across the brief around what the Fair Entitlements Guarantee is, when the appropriate time is to start sharing that information with employees based on what they're thinking the future of the company will be. And they can also start providing information to employees that make clear what steps they will need to take in terms of their interactions with the insolvency as well as their interactions with the Fair Entitlements Guarantee. So, you know, it is really, really early days and, you know, at this point, we simply have to wait to see how things move forward based on the investigations and inquiries that the receiver is undertaking at the moment. Certainly if it gets apparent, if it becomes apparent.
Yep, sounds very reasonable to me. I'm just trying to get an appreciation of what you do when something occurs like we've seen this week.
Yep.
And your answer is very fulsome, so thank you very much. The ACTU in its submission called for an expansion of the entitlements or amounts which workers could have access to. So I'm interested to drill down into how the caps work in practice and whether or not FEG has any, or the department has any data with respect to the amounts which workers aren't receiving as a result of the operation of the cap. So just to provide more context, an example was given of, say, a truck driver who's worked for the same company, loyally worked for the same company for 30 years, has a lot of accrued entitlements. I'm interested to know how we as the committee can drill down to get an appreciation of how much of the accrued entitlements, unpaid wages that truck driver is going to receive through the FEG scheme as a proportion, and whether or not there's any data you can share with us in that regard.
So we don't have the specific data of what we don't pay under the scheme. We can take that on notice to see if we can draw that information from our business system. The stats I have with me are only related to what we do pay under the scheme. In terms of the caps themselves, for the 5 entitlements that we cover, all of them are capped by a maximum weekly wage amount, which is it's equivalent to $134,000 per annum. So that's a fairly, that's a fairly decent kind of maximum weekly wage at which we cap the rate at which we pay entitlements. For unpaid wages, we capture 13 weeks of unpaid wages. For annual leave, there is no cap other than the maximum weekly wage amount. So if someone's owed 8 weeks, we will pay them 8 weeks. If someone's owed 108 weeks, we will pay them 108 weeks. For long service leave, same story, uncapped. Only cap is the maximum weekly wage amount. For payment in lieu of notice, we cap the payment at a maximum of 5 weeks based on whatever the entitlement is in the employee's governing instrument. So if their terms and conditions are that they accrue only in line with the NES, then we'll pay the National Employment Standard entitlement. But if their entitlement is that they're entitled to 4 weeks payment in lieu of notice, then we'll pay the 4 weeks. If it's beyond 5 weeks, we cap the payment at 5 weeks. With redundancy pay, we have a cap of 4 weeks per year of service. And again, that is based on whatever the entitlement is in the person's employment arrangements. So if they have a entitlement in their enterprise agreement or contract of employment, etc., that provides them with 4 weeks redundancy pay per year of service, then that is what we pay in the scheme. If they have an agreement that they only get paid 3 weeks per year of service, then that is what we pay under the scheme. If it's more than 4 weeks, we cap the payment at 4 weeks per year of service. So,
okay. So the one gap that you've identified in your submission is that FEG does not cover unpaid superannuation guarantee contributions required to be paid by employers under superannuation law. Can I just ask, what was the policy intention or reason for not including unpaid superannuation guarantee contributions?
So the original policy intention was that The Fair Entitlements Guarantee and its predecessor schemes, which actually commenced back in 2001, were intended to be a scheme of last resort where no other funds were available for basic employment entitlements. And the 5 basic employment entitlements that were envisaged as being within the scope of the scheme at that time were the five entitlements that I've just spoken to. The rationale for not including unpaid superannuation is primarily, I imagine, down to the fact that there's a separate compliance regime in place that is administered by the Australian Taxation Office that manages the compliance arrangements around payment of superannuation. So the Superannuation Guarantee Act, there's already an existing mature compliance arrangement in place that the ATO administers to follow up where employers are not making their SG payments on time, and they have director penalty notices in place, etc., to manage that part of the entitlement. So it's administered in a different portfolio. It has never been part of the wages owed to employees on termination. And, rightly or wrongly, that's simply the policy basis of the scheme.
But there's no reason in practice, and again, I don't want to take you in the policy areas, I'm just trying to work it through in my own mind from a practical point of view. I can't see any reason in practice why the ATO couldn't pursue the remedies it pursues through director penalty notices or whatever else. But at the same time, if those efforts weren't successful, there's no in principle reason why FEG couldn't be expanded to cover those unpaid superannuation guarantee contributions, is there?
Can I just add, Senator Scarr, if you allow me, on that same topic? The superannuation guarantee payments are administered, as you said, by the ATO. In your view, would it be better off if they were administered, as Senator Scarr suggested, under the one roof whilst you're doing your investigations? Because even though superannuation is separate from wages, we have had negotiations, if you look back at the history of it, where an increase in super has been given in lieu of an increase in wages. So it is part of the payment scheme that you get paid for working. Wouldn't it be better off, in your view, I don't know what your views would be on that?
I think ultimately on that one, Acting Chair, it's a matter for government about what's appropriate for taxpayers to fund. So the FEG scheme is a taxpayer-funded scheme. Ultimately, it would be a question for government as to, and clearly there is a recovery program in place, but nevertheless the cost would be substantial if superannuation was added to the FEG scheme.
To complete the answer, that's the...
Do you have any data in terms of the cost? So obviously they don't fall within your bailiwick, but at the moment, but can you, because of the associated data you have with respect to unpaid wages, etc., do you have any visibility in terms of the amount we're talking about?
Senator, I think we'd prefer to take that on notice. There's sort of anecdotal figures, but I'm hesitant to rely on them. So I think we'd prefer to take that on notice and see if we could provide you with something more current.
Yep, if you could, that would be very useful. I think I'm just having a look here in terms of potential reform issues. Could you walk us through the issue relating to circulating assets and the need to preserve those for the benefit of priority employee creditors, and what the issues are in that respect that we should consider?
Yes, Senator. So to start at the beginning, because there's been a lot of commentary on the circulating fund and whether, for example, a practitioner ought to be able to throw their general costs against that fund. Of course, a practitioner, a liquidator, a voluntary administrator can throw their costs met right off the top of the general estate, but they can't throw their costs typically against any charged assets. They belong to the financier. But there's an exception in the Act both in section 433, which applies to receivers, and section 561 that applies in a winding up. And section 561, if we focus on that for the time being, provides the ability for employees to be paid their outstanding entitlements where the estate fund is insufficient to meet those entitlements. So it's an impost against the bank or the secured creditor before they leave the room, as it were, having scooped up those secured assets to the credit of their lending facility. Would you please pay the employee entitlements out of just those circulating assets? So the circulating assets are typically cash and or stock and the debtor book. And so it's a very important concession that is steeped in history, but is essentially a concession that the employees are particularly vulnerable in an insolvency. It's a concession to the employees, and if you look at some of the early case law, the concession, which is against the bank's interest, is that particularly those liquid assets, it's likely to be the case that the sweat and the blood and tears of the employees were committed to create that value, and so it was seen as only fair, pursuant to section 561, to create that impost upon that circulating security.
Okay, but there's an issue with respect to uncertainty and complexity in this area, is there?
There is some complexity, yes, Senator, on some issues, more or less. We think that we're getting there, and some of the cases we've been involved have settled some aspects. There's complexity certainly around a question: is a secured interest circulating or non-circulating? There's certainly some complexity there in the PPSA Act, which governs that issue. And yes, there's some other issues yet to be resolved around the Section 561 issues in particular.
Okay, just last question. That issue around the PPSA, was that considered as part of the Whittaker Review, and did that review make some recommendations to clear that up?
I don't believe that the Whittaker Review, amongst all those many recommendations, went to the heart of some of the issues that we experience in Section 561, Senator. But we'll check that answer and take that one on notice.
Okay, thank you very much. Thank you, Chair.
Thank you, Senator Scarr. I've got a couple of questions, but before I go to mine, I'll ask if Senator Molino has any questions. Senator Molino?
I'm right for the moment, thanks, Chair.
Okay, thanks. In section 3 of your submission, starting on page 11, you identify potential areas for reform. And I'd like to know which of these areas would be addressed or should be addressed now, and which would be better off referred to a root and branch review of Australia's insolvency laws. And are you able to indicate whether such reforms have been pursued in other agencies, jurisdictions, states, etc.?
Senator, Acting Chair, I'll ask Mr Carr to address that, but just perhaps if I could open by saying, we completely recognise that this is a highly complex area. The reforms that we've put forward here are this department's views. Obviously, our priority concern is the protection of employee entitlements. So our policy reform ideas have been made with that lens. Clearly, other stakeholders will have different views. I think we've put these forward, but they would benefit from perhaps more rigorous testing, and also certainly from hearing the feedback from stakeholders and other different perspectives. So with that qualifier in mind, I might ask Mr Carr just to talk through some of the ones that we've put forward.
Well, you asked me to group them into, is that in a question of urgency, whether...
Which ones do you think should be referred to a root and branch sort of investigation? Which ones I suppose, which ones would be better off referred to a root and branch review of the laws
I think they could all.
They could all be?
I think
Okay,
they could all be contemplated, and perhaps better when you hear about the mosaic of issues affecting the stakeholders in this area. I expect that all of our suggestions could be factored in and considered as a root and branch review.
And are you aware of any other jurisdictions conducting such reviews, or?
I could take that on notice, Senator.
Yep. Be good to know that one. On
Typically
pages 11 and
there's
12 of your submission, you also suggest preventing schemes of arrangement that compromise integrity of the fair entitlements guarantee. How could that be done, and what legislative or other changes would be needed to actually accomplish that or achieve it? And would that be supervised by courts, regulators, agencies?
That's indeed an open question.
Very open-ended.
It's a very wide open question. You know, there's probably a range of methods that could be adopted, but, you know, I think that we don't have any pre-formulated solutions, ready-made solutions ready to roll out. It's something that probably needs to go through the process of consulting with stakeholders, what would work well, what wouldn't work well, what does this mean in terms of the fundamental policy basis of the Fair Entitlements Guarantee or not. There's a whole raft, I guess, of issues that need to be considered in terms of determining how and to what extent changes might be made to, I'll say deal with, it's a very crude word, but deal with whatever issues are arising out of the use of schemes of arrangement.
My other question is on your submission on page 13. You also suggested codifying the High Court's decision in re Amerindt. Could you advise by codify, do you mean to legislate provisions that have the same effect?
Yeah,
and
yes,
if that's, in that case, more generally, what are the advantages and disadvantages of codifying a court-made law?
Well, Senator Amerindt, Acting Chair, sorry. Amerindt answered a question which was, do the ordinary rules that apply to winding up a company apply to a company that's acting as a trustee? And ultimately, the High Court resolved that, and in particular, importantly for employee entitlements and for FEG, that when you wind up a trustee, the assets of the trust will be dispersed in that Section 556 manner, which gives the employee entitlements their priority. And just as importantly, that section that we refer to, Section 561, which gives the employees a priority over the circulating asset before they're paid to the financier, that is also enjoyed by the employees in the context of winding up a corporate trustee. But the case Amerindt, and there was an analogous parallel case called Kalani through the federal courts, they certainly answered many of the questions in respect of winding up a corporate trustee, but perhaps not all. And so the codification would provide for perhaps those questions that have still been answered, perhaps, for example, where a corporate trustee trades on its own behalf but also trades as a trustee. The Amerindt case didn't entirely resolve the proper approach for winding up a trustee with that mixed trading motive, whereas codifying or legislating that result would allow all those refined issues to be...
So it would be through legislation in a situation
yes.
like the example that we used. So, yeah. Okay, on pages 13, 14 of your submission, you suggest reforms to inform and empower priority employee creditors. Are there any new technologies that you're aware of that are potentially available to liquidators that could enable some of those reforms of lower costs? Pages 13 and 14.
Yes. We're not aware whether that particular proposition could be united with an opportunity whereby those accounting firms and practitioners can avail themselves of information more cheaply. You might expect that that's a general theme, Senator, but I can't assist in that regard.
And I have one last question before I go back to Senator Scarr or Senator Merlino. Just going back on the superannuation guarantee, obviously there's two separate procedures. One is that you guys look at the wages, etc., then the ATO looks at superannuation. Do you report matters to one another? Like if obviously someone hasn't been paying the wages and there's action brought against them, you're investigating, would you notify automatically the ATO that there could be outstanding superannuation claims as well, which most probably is the case if you're investigating a...
We do, Senator, and just to go back to the earlier question and answer, I think some of the response that we provided was still looking at the question of step one, which is the payment that FEG makes on behalf of those other categories of entitlements. But if your question is there efficiency, not in FEG paying and somehow uniting that with a super payment, but the recovery of FEG united with the recovery of superannuation, undoubtedly there's an efficiency in that. Yeah. Because we look at the moment when we're recovering FEG at the return on investment, if you like, of funding a claim to get FEG back. We're pleased that we recover super along the way, incidentally, but it's not part of our core computation about whether this is worth taking a risk. Of course, if you combine two amounts owed to the Commonwealth, the FEG advance and the super, and you say, well, overall, it's a different investment decision and it would be more subject to other considerations. There would be an efficiency to be gained if they were united. And yes, we talk to the ATO very, very frequently about all of the actions where there is a potential outstanding superannuation, and so we're in constant contact. We've done some limited co-funding arrangements, but certainly the lines of communications are open.
If I could just add something there in terms of context. Our involvement is really in that small proportion of companies that fail and end up moving into liquidation and not being able to pay their employee entitlements. More broadly, there are solvent and other insolvent companies that may continue to operate but don't pay their superannuation on time that we will never know about because we're only concerned with that small proportion, I think it's 10 to 12% of employers that do go into liquidation and are not in a position to pay their employee entitlements. More broadly, across the broader landscape, the Fair Work Ombudsman has a role for providing information and advice and support to employees where they have unpaid employee entitlements where the company isn't in liquidation. And so that is, the Fair Work Ombudsman would be I guess the arm of the workplace relations kind of regime that would be advising employees about what their rights and entitlements are, how they can pursue recovery, and whatever information sharing protocol exists between the ATO and the Fair Work Ombudsman that shares information and intel around unpaid superannuation.
Thank you. Thanks. Senator Merlino on the line. Senator Scarr, any further questions?
No, I'm good, Chair.
Okay, being no further questions, that concludes this particular session of today's hearing. So thank you for your informative information and participating. Responses to questions on notice should be provided by the 23rd of March 2023. Thank you, and that ends this session. We are a little bit early on time, so okay. On that note, we'll call the next page. Yeah. Okay, we now welcome the representatives from Treasury and the Attorney General's Department. If they're all here, I suspect. Are they all here? Yeah, they're all here. So we'll start a bit earlier.
Yeah, that's fine. And Dr. Merlino is still on the phone.
So we'll finish early.
So we have these guys for an hour. I can let the chair know that we're running a bit early and see. I'll let the chair know that we're running a little bit early.
Running a little bit early. The way normally it's always the other way around. Look, can I just start off by welcoming the representatives from Treasury and the Attorney General's Department. I understand that information on is on parliamentary privilege and the protection of witness giving evidence to Senate committees has been provided to you. For the Hansard record, will you please state your full names and the capacity in which you appear today? Perhaps we'll start down this end and work our way up.
I'm Tom Dixon. I'm Acting First Assistant Secretary of the Market Conduct Division in Treasury.
Thanks.
Ms Zoe Owen, I'm the Acting Director of the Financial Reporting and Insolvency Unit in Treasury.
Alice Lineker, First Assistant Secretary, Courts, Tribunals and Commercial Division, Attorney General's Department.
Jenna Priestley, Assistant Secretary, Commercial and Copyright Law Branch, Attorney General's Department.
Thank you. I now ask you to make a short opening statement, and at the conclusion of any remarks, I'll invite members of the committee. We have on the line Senator Scarr and Senator Molino, and our Chair, Deb O'Neill, will be attending soon as well. So I'll now invite members of the committee to, members to make an opening statement.
Well, thank you very much.
And you may wish to make two statements, one on behalf of the Attorney's General's Department and one on behalf of Treasury, if you wish.
Well, thank you very much for the invitation. We're happy to start answering questions. We have no opening statement to make.
And
Thank you, Senator. We don't have an opening statement either.
Excellent, thank you. I might throw over to Senator Scarr to kick off with the question. Senator Scarr?
Sure, thank you. And welcome to our friends from Treasury and the Attorney General's Department. And I might just walk through a number of issues because in light of the evidence we've received on a number of issues, I'm just keen to get an update, I guess, from the departments with respect to certain reforms that have either A, been implemented or B, foreshadowed to see where they're up to. Firstly, in relation to Treasury, in relation to the Insolvency Law Reform Act and the introduction of new registration and disciplinary processes for liquidators, I'm interested to know what is Treasury monitoring how those processes are going. There was some evidence given to this committee with respect to the participation of particular representatives in terms of those processes. Does Treasury have any ongoing practice in terms of or procedure to monitor that process and whether or not the reform that was introduced in 2016 is working as intended?
Well, thank you for this question, Senator. So it's Tom Dixon from Treasury speaking. In terms of how we track things that are transpiring in the world of insolvency, we do have regular ongoing stakeholder engagement that we participate in. We always receive and are always happy to receive feedback from stakeholders on how reform progress is being made and what the impact of those reforms is. In relation to whether we have like a formal mechanism where there's a program of work where we're tracking things, we don't have such a system in place, but we do have, as I said, just a normal ongoing stakeholder engagement practice.
And in terms of that, so understood, thank you. In terms of that particular reform area, is Treasury's understanding that the new registration disciplinary process is working as intended? and have any substantial concerns been raised with Treasury, or are you reasonably satisfied that it's working as intended?
So I don't have anything specific in relation to registration processes. So it's not an area that we've recently spent a lot of time analysing, but we are aware that there's been evidence that's been given to the committee in relation to registration processes. So, but beyond that, we don't have any sort of independent analysis on that to offer. My colleague Zoe Owen may have some more to elaborate on that.
Oh, I was just going to add, Senator, that in terms of that sort of general stakeholder feedback that Tom referred to, it is something that we would discuss from time to time with ASIC as part of our regular engagement with them, as they do essentially administer those committees and form one of the 3 members each time one of those ad hoc committees is formed. So they're obviously quite extensively involved in that process. So they are someone that we do hear from about how that process is going, or how those committees are going.
Understood. In relation to the insolvent trading safe harbour reform, I note that the former government gave a response to the report that was published on 24 March 2022, and out of the 14 recommendations, the former government agreed to 9 and noted the remaining 5 recommendations. I'm just interested to know whether or not Treasury is engaging with the current government with respect to revisiting the other 5 recommendations, and whether or not there's any work going on in that regard.
Well, yeah, thank you for the question, Senator. So in relation to measures that were announced by the former government but are not yet enacted, it's been a decision taken that we would wait for, I suppose, the outcomes of this parliamentary inquiry to avoid prejudicing any of the inquiry's consideration of any matters. So at this point in stage, those sorts of deliberations are on hold.
Oh, okay. So perhaps, so just to be clear in relation to that, the department's taking the view that it's appropriate to wait for this committee to consider all of those 14 recommendations, I guess, and see whether or not this committee considers that any of those recommendations should or shouldn't be implemented. Is that correct?
Correct.
Okay, understood. Thank you. The next issue I'd like to move on to is in relation to clarifying the application of corporate trusts in insolvency, and we had the benefit of very extensive evidence from Dr. D'Angelo, who I would presume is known to the department as a leading expert in respect to this matter. Again, there was consultation undertaken from 10 October to 10 December 2021 in this regard. Is it a similar position with respect to that consultation that the department's waiting for the outcomes from this committee?
Yeah, precisely, Senator. And of course, part of that consideration for the deliberations of this committee is that there may be different emphasis given to different measures and recommendations in relation to priority. So it seemed to make a fair bit of sense to wait for the deliberations to conclude.
Okay. Moving on to schemes of arrangement, I'm not sure to what extent you've had an opportunity to consider or become aware of the evidence given in relation to the Ovato scheme of arrangement. Do you have any background in relation to that scheme of arrangement?
So we have an awareness of the Ovato case, yes.
Okay. I put the question to the department. They've taken Department of Employment, etc., with responsibility for FEG, and they've taken it on notice with respect to their decision not to participate in that court proceeding, and we'll wait to see what information we get from them. Did the department have any active consideration with respect to, Department of Treasury have any active consideration with respect to that case as it was going through the court system, or was that something which, from your perspective, properly remained within the bailiwick of the Department of Employment, etc.?
So I suppose there's two considerations. So one is that obviously we don't involve ourselves in regulatory activity, so we make sure that there's independence on that, so we don't interfere. So our consideration really is one from a distance, where we're looking at what the circumstances were and then the outcomes and how, you know, whether or not that represented a good public policy outcome or not.
Okay, could I maybe, let me ask you in the first instance whether or not you've got any views in that regard, especially given taxpayer dollars within the FEG scheme, of course, and the way in which the court considered recourse to that scheme as part of its consideration with respect to whether or not to approve the scheme of arrangement. So I guess that's the first question. And B, whether or not it's an area which you are in the process of considering and coming to a view from a public policy perspective.
So, Senator, if I understood the question correctly, I'll perhaps venture to say that, you know, it's a very complex area in terms of how you weigh up the different competing interests in a scenario like Ovato. What we hear is that there are trade-offs from various different policy approaches. So, for instance, you know, you could take one view which is around the need to, I suppose, preserve the interests of taxpayers, if you like, which is to limit the scope of calls on the FEG unnecessarily. And there's and there are other views as well in terms of what sort of impacts should take precedence. Another perspective on that is that in weighing up all of the different competing factors, sometimes it's a case-by-case approach that's required, and there needs to be judgment brought to bear on what would deliver the greatest net benefit to society in terms of outcomes. And in that world, we've heard the view that the court system is one mechanism that would enable people to do that, and that's the system that currently exists, where there's a view that perhaps the court system enables the prospects of greater job preservation, for instance, where it can take into account all of the factors, including whether or not the FEG has been unfairly exploited or inappropriately exploited for that kind of use. So there's a mix of views, and there's pros and cons on each side of the various different policy options.
Yeah, and I think that's a very reasonable analysis as you put it forward. Just to give a bit more context to the discussion, the concern I have is we heard evidence from the AMWU that they received advice that they didn't have standing to make representations to the court with respect to the position of employees. And we also had evidence from the department with responsibility for managing the FEG that they considered whether or not they should appear and decided not to appear. So my concern is, from a public policy point of view, is whether or not the court had the benefit of all the information and all of the evidence and perspective it needed to have as it went through the balancing process, which you outlined. So I'm interested to know whether or not Treasury is looking at the Ovato situation from a helicopter point of view, from a policy point of view, and whether or not there's any views with respect to how the federal government, I guess, should respond to that sort of situation in terms of appearing in court, making submissions, not making submissions, whether or not there are other factors which should be added, explicitly referred to in the Corporations Act. I'm very happy for you to take it on notice because, as you said, it's a very complicated matter. So is that something you could perhaps come back to the committee with some more information on, given that particular case has been raised by a number of stakeholders?
Yeah, happy to do that, Senator.
Okay, thank you very much. My last area of questions relates to the Modernising Business Registers program, and we've received quite a bit of testimony from different stakeholders with respect to the merits of enlarging that business register program, enhancing it to include information with respect to trusts, specifically with respect to trusts. So there are hundreds of thousands of trusts which are trading today. Different stakeholders, customers, suppliers, financiers are dealing with those trusts, and there appears to be an absence of searchable information with respect to trusts, including authorities, who should I be dealing with, who can I deal with, etc. Is that something which Treasury is considering as a potential reform, or which it could consider? And if so, would you be looking to bed down the existing program of modernising business registers first before looking to expand upon it?
So in relation to the Modernising Business Register program, as you'd be aware, that's an area that isn't within my bailiwick, but what I can say in relation to that is that there is a great deal of emphasis being given at the moment to the core of that system, which is to migrate the current asset company register and other professional registries onto the brand new platform. And so I would anticipate that would be the first area before we look at expansion, but of course we wouldn't preclude the ability for that technology to be expanded at a future date.
Okay, thank you. If I could turn to our friends from the Attorney General's Department. So I'm champing at the bit to get an update with respect to implementation of the Whittaker Review reforms, which have been outstanding for quite some time, and I know they were outstanding for quite some time under the previous government. I duly acknowledge that, but we are getting a lot of feedback from stakeholders that there are some recommendations there which would make a difference to real world decisions which are being made today and things which are happening in the commercial market today. So keen for any update that our friends from the Attorney General's Department could provide.
Thank you, Senator. We have recently briefed the government on the Whittaker Review and it's under active consideration.
Okay, excellent. I'll leave it there. All right, thank you, Chair.
Thank you, Senator Scarr. I've got a couple of questions. If this committee was to recommend Harmer-style root and branch review of Australia's insolvency laws, in your views, both agencies, which body would be best placed to undertake that review? And should the review follow a similar process to the Harmer review?
So I'm happy to perhaps answer first. So in my perspective, the question would arise as to what kind of capabilities and skills you would want to bring to bear. If you're doing something in relation to a root and branch review in the space of insolvency, I think a couple of disciplines would be really important to make that successful. I think having a legal discipline involved in that would be extremely important, as well as an economic discipline brought to bear. And I know that when we think about, which agency, I wonder if that's like a false dichotomy, but often the two agencies that are kind of thrown around as potential candidates would be something like the Productivity Commission, or would it be the ALRC? And in my view, what you'd be looking to try and do is just get a mixture of both of the capabilities of those agencies, if it was possible to achieve, because obviously, a lot of what drives insolvency law is not just the economic components around the strategy and what you're trying to achieve in terms of economic growth, but it's also really important that the execution of that is done really well, and that the systems work from a user perspective, so that people who are, for instance, small businesses or individuals that are working their way through that system, that the perspectives of those people are brought to bear in conjunction with that. So I think it's probably it's a multidisciplinary exercise in my view. I'm not sure if we have to sort of confine ourselves to asking which particular,
The AG's department?
I think we would endorse what our colleagues at Treasury have said, and to add to that, I think it would depend on what the terms of reference for that review would be, what you were trying to achieve out of it, which, if you were tossing up between the Productivity Commission, ALRC or some other body, which one would be best placed would really depend on what you're trying to achieve out of it.
Do you think the review should follow a similar process as that of the Harmer review?
I wasn't involved in the HAMA review, so it's hard to say what the process looked like at the time. But you know, if you were to characterise that as a process that involved extensive consultation, the ability to do some deep thinking, deep diving into particular policy areas, then I would say, yeah, it's something that would definitely merit an extensive involvement from as many people that are connected to the insolvency system as possible.
Sandra, we were not involved in that review either. I think that any review would need to take a fresh look at what the industry needs right now. I agree, broad stakeholder consultation would be critical, particularly if you're considering root and branch, that with an intention of some form of harmonisation, given the two different roles that the systems play. So you wouldn't want to exclude consideration of one system in the light of the other. So it would be a very careful balance to ensure that outcome, I think.
To just back to the departments here again, what would the departments that are here today and agencies need from the committee's report and evidence to assist in establishing a root and branch review? What would the things that you'd require from our recommendations?
So in one sense, it would be a matter for, so I apologise, but it would be a matter for government as to whether it wanted to, take forward a root and branch review. So in one sense, it's more about what would the government need more than what the department would need to support a recommendation. But I suppose there are a number of considerations that are relevant to whether you would undertake a root and branch review, and one is in relation to, what would be the overall expected net benefit from undertaking the exercise? And that's probably a very Treasury type of answer to give, but there are a lot of competing priorities for the government. It has an ambitious reform agenda, and one question that would need to be answered is, well, how would this sit in relation to the other priorities that the government has? And then other considerations would be, again, in relation to what you think the priority areas of reform would be. So if you were to outline, for instance, what the biggest bang for buck could be in terms of potential terms of reference for a review, that would be the two things that spring to mind.
We would endorse what our friends from Treasury say. I think that you would need to understand from your report what in root and branch review goes to, whether it goes to harmonisation and finding points of similarity and points of efficiency across the systems, or whether it goes to more fundamental objects and outcomes achieved by each system. So I think it would be quite important to understand what stakeholders and submissions to this process are seeking to achieve through that root and branch outcome review.
Thanks. And that takes me to the other question. Should the review body be given freedom to cover policy matters and not be limited to non-policy matters like, for example, the ALRC review of the legislative framework for corporations and financial service regulations?
I think it's probably fundamental that it looks at policy issues, because I think the questions that have arisen all throughout the committee have largely been in the area of policy. So I would imagine that would be the primary focus of any review.
And I think we just endorse what our colleagues have said.
Thanks. Should reassessing the purpose of the insolvency system be a first stage in a root and branch review, or done first in a separate process to inform the terms of reference for a root and branch review? So in two stages.
I'm not sure if I'm just thinking this through for the first time, but if you were to establish the objectives of the system and those objectives were agreed by government first, then the review team that comes after that has an easier time of then thinking about how those objectives would be achieved. So I'm really just thinking from the perspective of the review teams itself. I imagine a review team that then was, in contrast to that, was given both the task of setting an objective and then figuring out how it achieves that objective. If it didn't get the first part of that exercise correctly itself, then it would find itself off course, potentially. So there's pros and cons. So there's There's obviously advantages and disadvantages to each approach. So off the cuff, I couldn't give a conclusive answer as to whether one approach is better than the other.
I think it would depend whether this committee had a view that the objectives were unclear or required recalibration. So if that were the view, then I expect that would be important to set in place before any further work. But I do note that previous reviews that have referred to root and branch have been very careful to say we must always keep an eye as to whether that is a useful use of the reform agenda in this space, rather than, and you don't want to just do a root and branch for the purpose of doing a root and branch. It would be important to understand the failings and gaps in the systems as opposed to launching into a process without understanding that. So yes, I think we would want to understand if there's a concern around the objectives of the two systems.
Two separate. The other question I have, so far the inquiry, we've spoken to many departments and agencies, and many have been very generous with the information and their submissions providing all sorts of suggestions for reforms, and however others have declined to actually submit to the inquiry altogether, or put their ideas and suggestions for insolvency reform to us. What do you think is needed to ensure that such important information, because the agencies hold that important information, would be made available to a root and branch review? How do we do that?
I suppose it's probably not the area for me to provide a comment on, but in one sense, different fora do lend themselves to having different conversations, and I suppose the question is, what would be the right fora to create, and what's the right environment to create around those conversations that enables regulators to be able to provide their fulsome view, or others to provide their fulsome view. So it might just be a matter of just crafting the right environment.
I don't think we can speak to others' motivations in that place, Senator.
And I've got to say, both agencies have been very good with the information that are here today. The last question I have before I go back to Senator Scarr, who may have some questions, is the committee's received suggestions for reforms that need implementing now rather than waiting for a root and branch review, such as the Whittaker PPSA recommendations, Safe Harbour review, adjusting liquidator qualification requirements, regulation to pre-insolvency advice that goes on. Is there a way in which the government could pursue such reforms while referring other more complex matters to a root and branch review?
So perhaps one way to look at that issue is through the lens of a stakeholder. So Treasury does a lot of work in the policy change space, and so we do a lot of engagement with stakeholders. One thing that we're acutely conscious of is the impost on stakeholders' time when it comes to reform processes. So when a stakeholder is asked to do something, even if we were doing a change that you could consider to be relatively minor, if you're changing the law, then you're necessarily needing to consult with people to make sure that that law is going to work as it's intended to. It means engaging with a range of stakeholders who then need to, in some cases, consult with their membership, write briefings, prepare reports, prepare advice, lodge submissions. So even for what you might consider to be relatively minor reforms, there could be quite a material impact on stakeholders. If you're doing a root and branch review, my suspicion is that from a stakeholder point of view, they actually might prefer to spend that time, those precious hours or days that they have, focusing on that once-in-a-lifetime opportunity. So that's one perspective. Of course, the other is that perhaps you look at from the point of view of what the reform potential is, and whether there's an urgency to any reform. In relation to urgency, I suppose some of the key takeaways from what you might have heard so far is that we do have a system that's functional, and it's not a system that is broken. It's not a perfect system, and so perhaps from the perspective of both stakeholders and urgency, perhaps it might lean you one way or another.
Would you like to add?
Yeah, I think from the Attorney-General's Department perspective, specifically in relation to the Whittaker Review of the Personal Property Security Act, we have briefed the government on that review and it's under active consideration. And separately in the personal insolvency space, the Attorney-General will be convening a roundtable with a number of key stakeholders from the personal insolvency sector tomorrow. And that will be looking at, amongst other things, if there might be any critical reforms that sort of need to progress urgently in relation to the Bankruptcy Act.
Thank you. That's it from me. I'll go to any of the senators online.
Chair, I've just got some follow-up questions in relation to the round table the Attorney-General's Department just referred to.
Yes.
So if I could ask those questions, can you hear me?
Yes, we can hear you, Senator Scarr.
Thank you. That round table, will it actually potentially include consideration of the issue of whether or not the personal insolvency laws and the corporate insolvency laws should actually be put into one all-purpose insolvency law? Is that one of the issues which may be considered through that roundtable process?
So we do expect it will be a broad discussion, largely driven by the stakeholders that will be in attendance. The focus will be on critical reforms to the Bankruptcy Act itself, but yeah, it will be a broad-ranging discussion, we expect.
Okay, so it could basically, it just seems to me through the processes of this committee, there are two categories of potential reforms. There's the critical, we need to do it now, we can do it now, sort of area of reform, but then there's the more, what we're referring to as root and branch, more fundamental reform of the whole space, which is a once-in-a-generation activity. So in terms of your roundtable discussion, that's the sort of context in which you're looking at things?
Senator, the Attorney is hosting a roundtable tomorrow to meet with stakeholders to consider any moves forward in terms of reform that'll be a broad-ranging discussion that will include both immediate pressure points and concerns from stakeholders, but may also traverse into longer-term reforms. We are very conscious that this committee's report will be delivered over the coming months, and that will be a critical piece of information in considering any longer-term reforms. So we hope that they will work in concert, so to speak.
So just in terms of that hope for working in concert, which I think is a very good idea, is there going to be a summary paper, or would it be possible for this committee to to obtain a summary of some of the issues which are raised at the round table? That would just give us some context in terms of themes as we're preparing our report.
Yes, Senator.
I'm happy for you to take that on notice.
No, Senator, yes, there will be a public communication summarising the discussion put out after the roundtable and available on the Attorney-General's Department's website. But once that's available, I'm sure we could provide a copy to the committee as well.
And the timing of that summary, would that be available before this committee finalises its thoughts and prepares a report?
The roundtable's tomorrow, so I would expect that we would be working on that over the next few days. So I hope that would be available shortly.
Okay, excellent. Thank you, Chair.
Thank you, and I'm pleased to welcome back our Chair, Senator Deb O'Neill, and I hand the chair over to Senator O'Neill.
Thank you very much, Mr Georgianis. Thank you for stepping into the breach there and keeping the show on the road. Speaking of shows, I am very, very sad that I will not be able to attend the roundtable tomorrow because the Trade Committee is meeting and I've got other responsibilities. So I'll be waiting with bated breath like Senator Scarr to get the summary notes that you'll provide to the committee. So thank you for undertaking to do that. If I could just ask a general question. I get the feeling you've been watching what's been happening in the course of this inquiry. Is that a fair assumption?
Senator, I must confess parts, but not every single piece of evidence.
Okay, I might have to even say that, even though I've been there, because there's so much moving parts when I'm trying to chair things. But nonetheless, I think you probably captured the flavour of it, and there may be some pieces that have definitely attracted your interest. So what do you believe are the key takeaways from your department's point of view at this point of time from the evidence that you've been observing?
From the Attorney General's department, Senator, I think we will be very interested in the committee's view as to a root and branch review and any views about harmonisation across corporate and personal insolvency.
What's your view of the evidence so far? Because it's been a bit mixed, but looks like it's been landing more and more on the call for a root and branch as the days have gone by.
That certainly seems to be the balance of evidence so far, Senator.
Mm-hmm. And in terms of the personal and corporate insolvency, my view is that the evidence is leaning towards some efficiency in integrating those because the context has changed so much since Harmer. Does that accord with the Attorney General's observations of the evidence to date?
I think that, yes, that indeed reflects the evidence to date. I think that there is a very fine distinction in much of the evidence between harmonisation and a root and branch and review of the entire system. So I look forward to seeing the committee's view on that point.
Thank you. To Treasury, essentially the same question. Key takeaways from what you've been seeing so far, and have you been paying even closer attention than the Attorney General? It's a competition to see who's doing the most work.
Well, my answer on that is that, we've observed that through the commentary that people would regard the system as functional, but not perfect. And we do have in place or acknowledgement that there are systems in place to support restructure, there are systems in place to support wind-up. There does seem to be a view that we're striking a balance there that's reasonable, and perhaps there's a degree of refinement that would be warranted. But when we talk about, or when we hear evidence that it's not perfect on a range of fronts. So we hear that perhaps there is appetite for smaller changes through the law, but on a wide front, for instance, things around definitional issues in the law, safe harbour technicalities, ILRA definitions, things to do with unfair preferences. And then we hear, as we've seen, there's appetite as well for something more significant, more substantial, like codifying trusts, and then questions about merging personal insolvency. So we recognise that there seems to be a number of stakeholders that have appetite for examining that further, as well as then people that are advocating for more of a holistic review. So we see, a variety of, I suppose, appetite for change in the space.
Can I put it to you, Mr Dixon, it sounds like you've picked up some of the major themes, but my observation in general would be that people like the ABA and CANS and those who have been operating in the system and it's their business model and the secured creditors indicate a greater degree of delight in the way things are than those who are speaking for unsecured creditors or less sophisticated participants who get caught up in the insolvency project. So, which is large in number, much larger in number, if sadly much smaller in voice. So I would just put that on the record at this point of time as my observation, no reflection of where the committee may land, but that seems to be the shape of what's emerging. That for some, it's everything's looking fine. Regulators don't seem to be too distressed. People are happy that there's been some change, but on the ground, there seems to be a dissonance for me with that set of observations for those who are less deeply engaged with the current processes. So I offer that for what it's worth. If the committee were to indicate that we encouraged a root and branch review to be considered by the government, I've asked this morning people, do they think the PC should do it or the ALRC? We've had some interesting comments. How long would such a review take, regardless of who it went to, or would it make a difference if it went to one or the other?
So perhaps picking up on an answer from earlier on, it does depend a little bit on the terms of reference. So it depends a little bit on what kind of scope that review body was provided with. I do know that, as you mentioned, like we talked about earlier on, the need for a multidisciplinary approach, because you need to bring to bear a whole range of disciplines in order to, I suppose, make the most of the review. And I do hear that Productivity Commission and ALRC are two sorts of bodies that each have their own advantages when it comes to, and strengths when it comes to doing this sort of work. But typically what we would do is we would go to a body and we would present them with a draft terms of reference and get their view on how long something would take. I don't know if looking at other reviews would be as instructive. So I know that if you looked at the PC's review history, where you would see there's typically like a 12 to 18 month time horizon on one of their reviews. ALRC is typically like a multi-year exercise. I don't know if that's as instructive in this case, because I think it all comes down to the uniqueness of each terms of reference and what's required.
That's actually really helpful advice. Did you want to add anything to that, Ms. Lineker?
No, I endorse that response.
Thank you very much. Is there anything you could add further to the answer you've just given with sort of the different focus that might be enabled by activating through the ALRC or the PC? Do you want to add anything to what you just said, Mr Dixon?
Are you able just to help me with the question a bit more?
What sort of advantage would you get by referring it to the ALRC?
Okay.
What sort of advantage would you get if you referred it to the PC?
Sure.
And I'm just sort of thinking from a business point of view, given the scale of number of people involved and the productivity impact and the economic impact, that, it would, based on that evidence to us, the PC would look like a good place to go. Yet we've had lots of commentary about, a significant need for a review of Chapter 5 and the complexity of undertaking that, which is an ALRC role, really, in my understanding. So what would you get as the benefits from each one?
Perhaps the way I would look at the question is to ask whether or not those are the only two choices that you have available to yourself. So if you wanted to perhaps expand the opportunities that you have to nail what you might consider to be a once-in-a-lifetime review, you might want to think about not confining yourself just to those two agencies, but just starting with the capability, because each does have advantages. For instance, the Productivity Commission does have excellent expertise in relation to thinking about things through an economic lens. And we know that the ALRC is excellent in its capabilities in relation to looking at law reform too. So, in an ideal world, you'd be able to take advantage of the various disciplines and not be confined.
In fact, that was one of the recommendations from one of our witnesses this morning. Ms Irwin.
Oh, I was just going to note, I think as the committee's aware, they both obviously also have sort of history in this space. Obviously, the Harmer Review, which you've heard a lot about, was the ALRC, but that's obviously over 30 years ago now. And more recently, the PC obviously had their significant 2015 review that looked into this as well. And then I guess you're also obviously aware that the ALRC obviously has its current work on foot in relation to the Corporations Act, so that could be, I guess, seen as a benefit, or at least a connection, that they've got that current experience in looking at the Corporations Act more broadly.
Okay, thank you. Did you want to add anything, Ms Lineker?
I would just say that, again, the terms of reference will be really critical. So we talk about a root and branch review in general terms, but what that review is seeking to achieve is quite critical in determining who would be undertaking it, what you're trying to get out of it. If you're trying to look at the economic impact of the system and determine on that basis whether law reform is appropriate, then that may lead you down one path. But if you've determined law reform will be an appropriate mechanism to manage harmonisation or the experience of stakeholders, that may be different. But I think these are things that the committee will need to consider in terms of why you are recommending a review and what the purpose of that is.
Thank you. We've had some evidence about the Whittaker Review, and I don't know if Senator Scarr's asked questions about that already. Okay, so mine was going to be how long would implementation of the Whittaker Review take?
So there were a number, 394 recommendations in the Whittaker Review, and so each of those requires careful consideration, and it has been quite a while since the review was tabled in Parliament as well. So I think obviously a matter for government, but I don't think we could put a time frame on how long implementation would take, but...
I think, Senator, there are a wide range of recommendations in the Whittaker Review. Some require short-term implementation, some are much more fundamental in terms of ledge amendment. And so it varies on what government decides to do. We have already given evidence today that we have very recently briefed government on the Whittaker Review and possible ways forward, and that's currently actively being considered, and it will depend on which parts of that review are picked up and which parts are no longer relevant. It's really not a question that's very easy to answer, I'm afraid.
Okay, but that was helpful nonetheless. Could I just ask about the feasibility of the introduction of scalability in terms of business size for the regulation of corporate insolvency?
So, in terms of the various advantages and disadvantages, I imagine that people that would be attracted to the idea of scalability could imagine that in some way it would accelerate the process, or they might feel like they'd be able to be subject to less requirements as a result. One thing I would note though is that sometimes that isn't always the case when it comes to implementation. So for example, in the insolvency space, where I imagine if you created a scalable system where, for example, small businesses were able to meet some sort of threshold test for size and therefore find themselves in a different process, and then subject to a whole range of different requirements. As you create tiers, one thing that you would also try to avoid is a situation where it actually adds delays to the system by, for instance, requiring like an eligibility step to be, or an eligibility threshold to be met at the beginning of that process, particularly in a situation where it might be difficult to discover the paperwork associated with the business and discover its financials and its employees and other things. So there are a range of advantages and disadvantages. We do, I suppose, in one sense, have a simpler system in Australia in that we don't have the complexity of different tiers. I am aware of overseas jurisdictions that do have multiple levels of special conditions and carve-outs for their insolvency system, which does create a whole range of challenges in terms of figuring out eligibility and other criteria. So, in one sense, perhaps the simplicity, it's sometimes a trade-off between simplicity overall versus adding additional complexity overall.
You make me think about the reality of what information lies in different government entities and how intransigent and difficult it is for insolvency practitioners to get the information that they need, which must be held often in BAS statements and other documentation that the ATO would hold about employees in businesses. Perhaps there's a gap where there are contractors, whether they're willing or non-willing contractors to participate in particular industries. There might be a gap where there's labour hire, but they should still be reporting who they're paying. So it seems to me that there are data-rich sites that are not being accessed in any efficient way at all by insolvency practitioners when insolvency is triggered. And there's huge cost embedded in inability to access that. Now, I know privacy matters to all of us, but once you hit that point, there would be potential technological advantages in making information available in ways that are novel currently in this country. Are you aware of any jurisdictions where insolvency might trigger better access to information, if not for private insolvency, for in the case of personal bankruptcy, the relevant body or the entity, and if we were to establish a corporate insolvency equivalent to that relevant entity?
I think I'd have to take that one on notice unless my colleague has anything further to add on that. But
No, more just to note that I think we have, I guess, prior to this committee process, have heard some feedback from stakeholders along those lines, including, I think, another example was difficulties in obtaining information from banks or financial institutions, even that it takes quite some time after they're appointed and they make a request to get that information. And obviously, as you can imagine, that's often quite a crucial source of information as well that they need to continue with their role.
Yes. Did you want to add anything, Ms Lineker?
The regulator in our space is obviously AFSA, who's appeared before this committee, and they have a strong public education facing, their website's very informative. They have a lot of information for individuals who are engaging in personal insolvency or investigating it. So they are currently the source of that kind of, they hold the regulatory information in that space.
Mm-hmm. Okay. Do they share their insights with you?
So recently they published State of the Personal Insolvency System, so they prepare publicly facing documents that speak to the general trends that they see across the across personal insolvency. Yeah. And
sorry, I'll just think about some more questions after I'll hear here. But one of the things that I wanted to ask about was the creation of a government-run liquidator. Several witnesses have given an indication that they thought that might be appropriate in the corporate insolvency space, in line with practice in the personal insolvency space. And part of the argument was there appears to be a high level of public service work done by private providers who are, in fact, the insolvency practitioners who are cleaning up at a loss to themselves that was described yesterday by Cairns as a insight into the debt, the need to write off bad business debts that's built into the business model. Other evidence we've had, and I'm sure that you've heard it, is that is a corrupting process in terms of the insolvency practitioners, and that they would hang on then to other entities where they might be able to get paid, and that the fees that are associated with that are amplified, exorbitant in some cases, and unjustified according to some of the evidence we received. Is that necessarily because there's been a failure of government to provide the public good of a government-run liquidator in the corporate insolvency space?
So in relation to, the questions of the merit of having a government-established liquidator, there would be a range of pros and cons associated with that. So the first one being a classically trained Treasury officer, as we would think about the fiscal implications of that. And so, obviously you'd want to make sure that you're operating an efficient service if you were to do something, what that would cost. But in terms of the other things that you'd have to consider would also naturally be the onboarding of risk and responsibility to the Commonwealth and what that would involve. So there's those things to consider. And as you point out, on the other side of the equation is the potential benefits, which is around would there be benefits in terms of how liquidations are conducted? Would they be more efficient or less efficient? Would there be sufficient independence to make sure that those things are conducted in a certain way? So there's, as you point out, there's a whole range of different sort of factors that you'd need to bring to bear before you could sort of come to a conclusive judgment on it, I would imagine.
You have insight, though, into the benefits and the disadvantages in other jurisdictions. What are the observations that Treasury's taken with regard to this in other jurisdictions?
So we are aware that other jurisdictions do take this approach, and we haven't, I can't say that we've spent an amount of time doing an in-depth amount of analysis and research on the different implications in comparison to the Australian system, but it does seem like the sort of thing that would be worth merit, like it would be worthwhile doing that analysis.
Mm-hmm. Ms Lineker? No, Ms Priestley?
Ms Priestley.
Oh, I was just going to note, as you've already mentioned, that we do have the official trustee in bankruptcy in the personal insolvency space, although I think the profile of insolvencies in the personal insolvency space is quite different as well. In the report that AFSA produces that Ms Lineker mentioned earlier, that suggested that around 50% of personal insolvencies are for debts less than $50,000. So the official trustee is dealing with sort of bankruptcies of that type in the personal insolvency space.
And in the corporate insolvency space, we've had evidence that there's a very wide range of businesses, that many small businesses that would be carrying a similar kind of debt burden to what you've just described, Ms Priestley, is that in fact, you know, the shape of quite a bit of the corporate insolvency population.
So we are aware that, you know, a number of people that are in the personal insolvency space may have been connected to the corporate insolvency space at one point or another. So yeah, we do understand that there is a degree of overlap.
And the implied difference between personal and corporate insolvency is always that there's a lot more money and it's a lot more complex in corporate insolvency than that's kind of the embedded subtext all of the time that we hear this. But it seems to me, and please correct me if I'm wrong, that in the course of these hearings, it's become more and more apparent that the complexity of much of the corporate insolvency is actually pretty similar in shape to what's happening in the personal bankruptcy space in terms of level of debt, but is caught up in an entirely different system without any access to a government-run liquidation.
It might be worthwhile for us to try and see if we can find any data on that. I'm not sure if it exists, but I'd be happy to take that on notice. I do think back to like one of my earlier jobs in my career, which is the collapse of HH, which was definitely a different order of magnitude. Yes. And we have seen other, you know, very large scale insolvencies. So we are aware that there are different, as you point out, different categories. And the question is, well, to what what does the distribution of assets and potential losses look like across the entire cohort over time?
Because you're Treasury officials and from the Attorney General's department, I'm going to assume that there's extremely high levels of literacy around law making and, you know, around issues with regard to finance, Treasury and the workings of business. We don't have any capital requirements or education requirements for people to commence businesses, and we've heard pros and cons from a range of witnesses about that. You know, having not too many barriers allows entrepreneurs to get in and get going, and some people can learn on the job very, very well. Others commence reasonably capitalised, can access the information and intellectual property from others that they employ, accountants, etc. But that when things go bad, they lose that capacity. They can't rely on their accountant anymore. They are falling back on their own resources. So that shape of what's happening for people who have signed up, you know, after a conversation at the pub with somebody, how do I set up my company? Well, go for a proprietary limited company with nothing other than the say-so of, you know, Jack, who they have a drink with on a Thursday night at the end of the hard-working day, or, you know, at the basin while they're getting their hair washed and they're set up a business. So what is an appropriate level of protection for the Australian economy in terms of what basic skills do people need to have other than to be able to go to a website, open it up, put their data in and get an ABN? Is there a case for or against the ease with which companies can be established, particularly with the limitations of proprietary limited stature?
So there's probably a lot of dimensions to the answer to that question.
It's complex.
But perhaps just sort of to take through some, I'm sure that there are people that have been enormously successful in business with no qualifications, and it would have been unfortunate had we forced someone into some sort of education program which might have, you know, stifled their appetite and enthusiasm and motivation. So in one sense, you know, there's that aspect to it. Another aspect
Sorry,
is...
Mr Dixon, before you go on, there's always an assumption that there's an education program that people have to pay for to get into. There are other ways where I think Amazon and other companies might use it, where there's documents that you're required to read.
Yep.
before you go in and you can tick them, or you might have to answer a question in response to a piece of material, which can be provided in multiple languages. I'm talking about, that level, down to that level is possible. It's not a pre-qualification.
Understood. So, as you'd imagine, there would be various, advantages and disadvantages of different approaches. In terms of what defines someone as being in business, it's I think from memory, it's actually defined in tax law rather than in any other law. So it's not described as having a particular business structure. So you can be in business and you can be of a pretty substantial size and not have any structure formalised through either a company or other arrangement. So business, it's actually possible to conduct business simply by offering something for sale and then meeting the other criteria that are specified in the Tax Act. So in one sense, perhaps the narrower question is, should there be any sort of pre-screening or pre-commencement exercise for entering into a formal structure and understanding what the responsibilities and obligations are in relation to that. And that's a question I'd have to delve into a little bit more deeply, because I'm just aware from my own personal experience, having gone through an exercise, I did feel like certain responsibilities were pointed out to me in the process of going through that documentation. So it may be the case that there is some degree of that might exist, and the question is whether there should be more. But I couldn't, it's not an area that I can offer anything more on.
Thank you. Ms Irwin, nothing? Ms Lenica?
The only, I think the committee's aware that obviously there has been evidence that it sometimes can be quite challenging, particularly, I guess, more in the small business space, for company directors to be, familiar with all of their obligations, but also, I guess, familiar with all of the, the opportunities. So whether it's the safe harbour or other processes, there's the law as it currently stands, there's a lot to be aware of and familiar with, and sometimes it's that that can be part of reasons why certain processes might not be utilised separate from the actual law itself. Is about the awareness and the understanding amongst the director population.
Nothing from us, thank you.
Could I go to Safe Harbour, as you've just mentioned it there? Yesterday I was able to get a sense that Safe Harbour is actually being used. You may or may not be familiar with the evidence we received regarding Ovato.
Yep.
Which made me really think about Safe Harbour potentially as secret harbour, and there's a reason it's very confined in who knows about it, because businesses collapse very quickly from the contagion effect of reputational damage. But there is the potential for Safe Harbour to actually become a vehicle for a lot of debt to be incurred and expanded over a period of time without anybody watching. What provisions are there for anyone in any oversight responsibility in Treasury or in the Attorney General's Department to have a sense of how many Safe Harbour provisions have been activated, an indication that there's a particular sector starting to use it as a tool, assessments of whether this is being abused or used, because conceptually, there's nothing wrong with it, but practically, what might the outcomes be is my question.
Sure. So the Safe Harbour, just going back to its roots, it's really just the opportunity to create a defence, so that if you've got a genuine restructuring plan in place and it's credible, that you won't be prosecuted for insolvent trading. So nothing removes the prosecution. That's the baseline. The baseline is that if you believe that someone has not acted in the right way in relation to that restructuring, so as in the circumstance you described, recklessly taking on new debt with really no intention to restructure properly and the plan doesn't look credible, that defence no longer exists for that entity as far as I'm aware. So,
but it's got to be proven,
and
then there's got to be some outcome. So if you use the device to rack up debt or to take dodgy pre-insolvency advice, strip the company of assets while it's under the cover of darkness under a Safe Harbour provision,
So
people could be incentivised to that.
Yeah,
right?
so I'll invite my colleague Zoe in to say a little bit more, but the starting point for that is that what you're describing there seems to be in breach, because it wouldn't seem to be a genuine restructuring plan if that was the case. So the question does come down to, as you say, you would need to prove that the restructuring plan actually
and who's
wasn't
doing
credible.
the policing and who's doing the prosecuting?
Exactly. So I might invite my colleague just to elaborate on that.
Oh, I was just going to note that one important thing to note is that the safe harbour is only giving you, is only, as the name suggests, only a safe harbour or a defence in relation to insolvent trading. So all of the other directors and the company's other obligations, so there are other general directors' duties which you might be aware of, they all continue. It doesn't provide you any protection from any of those. So it's quite unlikely that if you were sort of deliberately, as Tom said, deliberately not engaging in a plan, or if you were trying to engage in illegal Phoenix activity or some other misconduct, then the safe harbour is not going to provide you any sort of protection from that sort of... the other thing to note is that there are important safeguards built into the who's able to rely on the safe harbour, which is around the payment of employee entitlements, but also being up to date with your reporting around your taxation obligations. So not being up to date with the actual payment, but at least up to date with your reporting about your obligations. So that comes from, it was a very core part of the design, that only sort of, only companies which are already sort of good corporate citizens, generally doing the right thing in terms of those fundamental requirements, should be able to rely on the safe harbour.
And I think that response answers some questions that were asked along the way. But how many directors have suffered significant personal consequence for acting, unethically and illegally, and been stripped of their director responsibilities? How many Phoenixing companies? We heard evidence this morning. I think it was just over 100 odd individuals had established 4,100 companies for the purpose of a model of illegal Phoenixing. I guess my question really goes to the determined abuse of a well-intentioned piece of legislation with safe harbour, how protected it is from fraudulent and corrupting behaviour.
Yeah, so I think the question that you raised there goes to the enforcement of the provisions and general provisions in the law, which I imagine would be really worthwhile questions for ASIC.
And we didn't get any data from them today about how many prosecutions, and we have had evidence from the liquidators saying that they are reporting over and over and over and over and over to ASIC that people are trading while insolvent, and that there is little or no action. In fact, they are saying that they are they're filing as required, detailed documents that take many weeks, sometimes months to compile in accordance with their licensing requirements. And then an AI entity at the other end spins them around and turns them back a response within 40 seconds, we heard. It says nothing to see here, basically, no action. So again, my question comes in that context, because if a business model can be established that's going to exacerbate the problems that we're seeing with insolvency and non-payment to unsecured creditors, then I am interested in Treasury's view about how safe is our current legislation from exploitation.
So we did have the recent Safe Harbour review that was conducted independently of the Treasury, which in its view didn't find evidence of it being used inappropriately, and actually did conclude that it was working as it was intended, subject to perhaps some technical amendments to improve definitions in some places. But so in one sense, I draw some degree of confidence from the fact that it has been subject to a degree of scrutiny, and it may be the case that we're hearing some new evidence coming to light in this case, and perhaps it's about identifying the extent to which those areas are systemic and widespread.
So if I want to be comforted by that review, and I have to confess I haven't read it, how many instances of safe harbour since the legislation's been in place did they review?
So that's something I'd have to take on notice.
Yeah, is it a handful or hundreds? And, you know, what did they find in all instances? And were there any differences between different industries? Because we've seen phoenixing really significantly in a couple of fields, and the ones that have been mentioned, building and construction and transport and hospitality, all of those three. So I'd be interested in your response to that, because we wouldn't want to be facilitating more problems than are already being described to this inquiry. Ms Lineker, did you want to say anything about these matters?
It's not a matter for AGD. I'll leave it to Treasury.
The only thing, that I wanted to add was, as Tom said, because it is a defence to any prosecution that might be brought, in practice, if a company was relying on the safe harbour and everything, I guess, went as you would hope, as planned, and it enabled the company to successfully restructure, then it would never, in the ordinary course, it would never come to the attention of ASIC or any other regulators, because, as you said, that inherent sort of confidential or non-public nature of the process, which is a fundamental sort of aspect of it. So it's not something where ASIC or anyone else is really able to gather sort of comprehensive data around its usage. So obviously the review that took place was, I guess, reliant on stakeholders being forthcoming, firms who'd provided that advice service, that them being forthcoming in providing sort of anecdotes or feedback about how it had gone. So,
thank you for that. That's very helpful. But I guess the question is, non-public, non-known to any government entity are two very different propositions. You know, if it's happening, how much is it happening? Where is it happening? Where is it delivering positive outcomes? Where is it delivering? Where is it not delivering? Who's watching? Where is that information? Is anybody watching? Do you know, Mr. Dixon?
Well, I think, the points you make in terms of the confidentiality, that is a tension. So it is a tension that exists in relation to preserving the intent of the provisions, which is to enable turnaround, and of course what sits in conflict with that, as you make the distinction, is if that information is public, well, there are going to be issues that arise into whether or not the safe harbour provisions would work at all. And as you point out, perhaps there's a case to examine whether or not there's cause to give notice to someone in a confidential capacity to be able to do the monitoring, and that could be an area that's worth investigating more.
Thank you very much. Back to corporate and personal insolvency, if the recommendations were to move towards merging those two, what would be the benefits of either ASIC or of AFSA, being the regulator, if it went to one entity? What would be better about ASIC as opposed to ASFA, or are there competency similarities, differences? Do you have a view about that?
Sandra, I think that would be a question for ASIC and AFSA primarily, but I think that the two regulators obviously operate under very different legislative schemes at present. As we've already discussed, there is a public trustee involved in AFSA. AFSA operates the PPSR, that they are not the same agency by any means. They have quite different legislative frameworks. So I think that it would be a question best put to them. But I think, as we have previously discussed, there is a question as to the recommendation for this committee in respect of whether there is an approach for harmonisation, for finding of crossing points between the schemes, and then there is a different recommendation which is a merging of the systems, and I think the two are different things and would warrant different outcomes in terms of regulatory oversight.
Thank you. Aligned to that, we had a suggestion this morning from Professor Mason and Mr Murray about consolidating insolvency policy into one policy department. Do you have a view on the proposal, and what kind of legislative and administrative challenges might that create? Ms Priestley?
Senator, I don't
Ms.
think we
Lineker?
caught that evidence. I think we were busy preparing for this afternoon, so we would need to take that on notice, I'm afraid.
All right, that's okay. Mr. Dixon, do you have
Yeah, if I could have the same grace extended to me, that would be nice.
I don't know if they call it grace when you leave the building, really. But, yeah, absolutely. In this instance, we're happy to hear from you later. The committee's also received evidence from a number of witnesses about the operation of unfair preference claims. I'm sure you've been hearing of that. We've been told that at present the provision as it stands is disadvantaging creditors that legitimately trade with companies and eventually become insolvent. Are you able to explain the policy basis for the unfair preference claim regime as it stands at present?
Certainly. So actually, I might invite my colleague Zoe Irwin to talk a little bit about that.
Thank you, Ms. Irwin.
Yes, thank you, Senator. So essentially there's a general fundamental principle in insolvency that all of a company's unsecured assets will be collected in by the liquidator and equally distributed amongst the company's unsecured creditors. So this is a general sort of equality principle. So for this reason, the Corporations Act contains a range of mechanisms which allow liquidators to claw back payments that were made prior to the insolvency for the benefit of all creditors. They're collectively called voidable transactions, and unfair preferences are one type of those voidable transactions. I guess an interesting thing to note, an important difference between unfair preferences and those other types of voidable transactions is that usually with the other types of voidable transactions, there's something else to, I guess, suggest some sort of impropriety with the transaction, whereas with an unfair preference, it's really just the proximity to the company entering into external administration. So under the current law, it extends into the 6 months prior to when the company entered into external administration. And as the name would suggest, what it's getting at is that creditor in getting a payment close to the company entering into external administration is getting an unfair preference over other creditors, in the sense that, for example, if they're repaid their debt, which, as you said, they're properly owed, and they're just collecting potentially from their perspective in the normal course of business, if they receive 100 cents in the dollar very close to the company, for example, entering liquidation, then they've obviously obtained a benefit or are being treated preferentially to other unsecured creditors who, after the company goes into liquidation, may receive, as you're aware, on average, a much smaller return in terms of cents in the dollar, in terms of how they're owed. So that it's a
response to ageing debts that are owed by creditors in a way that makes sure that the most recent one doesn't sort of trump the ones that were previous. And you talk about 6-month limitation on that.
So that's about when the transactions are entered into. That's right. So it's in close proximity to there's some other statutory timelines. It is quite complicated. Other statutory timelines in the other direction in terms of how long the liquidator has to pursue a claim. So that's obviously different. And I think there's been some evidence, as you have seen from stakeholders, about that in terms of how long, because we are aware that that's another one of the things that stakeholders, and this is again prior to this committee process, that stakeholders had raised, that sometimes that can create a perception of sort of unfairness or of increasing the sort of their negative experience, and that there might be some time after they received that payment that they're receiving the letter from the liquidator about the sum.
Yeah. So this is the practical consequence that, you know, like it potentially leads to considerable mistrust in terms of payment. And, you know, the keeping of accurate records of your financial reality, I mean, people would be potentially trading insolvent and have been trading insolvent unknowingly when that money was not owed to them. So it's another complication. And I can imagine people going, oh my God, when will this ever end? You know, and just who's going to ring tomorrow that's paid me $100,000 that I'm going to have to give up for my business? Surely that must be concerning also for banks who are lending to businesses on their books as they stand, yet there's a clawback that's occurring that can lead to confusion. I mean, the policy intent is very good, but practically it seems to me that there are some very significant challenges that have been revealed in the course of our inquiry, from my point of view. Does Treasury have a view about what you've heard with regard to that? And is that something that needs...
We acknowledge the evidence that's been provided in terms of the challenges. And you might be aware that there was a previously announced by the former government intention to look at reform in this area. So yeah, we're very well aware that there are potential opportunities that you could consider if you wanted to prioritise action in that space.
Okay. Have you done any work on that yet?
So in relation to prior announced reforms in the insolvency space, they're on hold while the PJC is underway, so that we don't have sort of a prejudice of your deliberations and findings.
Okay. So just for clarification, you are not currently considering any changes to the unfair preference claim regime, for example, to the relevant time periods or the threshold of knowledge or suspicion of insolvency, because you're waiting for this committee to finish its work before you do anything?
Well, in one sense, I think it's a matter of prioritising what actions the government might want to take. So it's entirely a matter for government as to what it would like to do in this space. And of course, if it was to take any action, I imagine it would want to take into account the findings of this before allocating resources to different competing priorities.
Okay. And could I ask if you're familiar with the Bryant v Badenoch logging case? No. So just for the record, there were lots of heads nodded and one no, so they're all no's. Could I ask you to take on notice then? The High Court recently handed down its decision in Bryant v Badenoch logging, which has implications for the calculation of peak indebtedness in unfair preference claims. In your view, what impact will this decision have on the unfair preference regime?
Happy to take that on notice.
Thank you very much. There was also a case recently with regard to insolvency practitioners and their access to recompense through trusts. Are you familiar with that case?
Not the case specifically, but I am aware of issues surrounding trusts in general, but I'd be happy to take on notice a question in relation to a specific case.
Yes, okay, so we'll construct that. I think I might have provided you with the judgment.
I think we haven't had an opportunity to look at it in detail, but I think it's the Ozafintech case. It's a federal court.
Yeah, it is. It's quite significant because it's quite a shift.
So yeah, depending of course on where the case is at. So yeah, obviously we don't comment on cases that are underway. But
okay, finally, and we've already discussed that there's going to be a personal bankruptcy roundtable tomorrow. Ms. Lineker, what is it, do you think, that is the purpose of that tomorrow? What is it that the Attorney General's Department is seeking to have occur as a result of that?
So the Personal Insolvency Roundtable tomorrow is being hosted by the Attorney, and the Attorney is bringing together stakeholders across the personal insolvency system to discuss current issues facing them with a view to either any short-term reform or to longer-term reform. So it is a genuine consultation with stakeholders and an opportunity for the Attorney to hear from them directly.
Great. Well, good luck with that. I wonder if we'll be having one about corporate insolvency soon. Thank you for your evidence this afternoon. And today's hearing is concluded. Thank you to all witnesses who appeared, to Hansard Broadcasting for their assistance, and to our very professional and very helpful Secretariat. We really appreciate the work that they do and the care that they put into these inquiries. Responses to questions on notice should be provided to the committee by the 23rd of March 2023, and the committee now stands adjourned. Thank you.